Good morning. It's 9 a.m. on Friday, February 18th. This is Yahoo Finance Live. I'm Julie Hyman, along with Brian Sozzi. Let's take a look at futures here this morning. We have seen some bouncing around on headlines out of Russia and Ukraine. We're going to get to those details in just a moment after we saw a steep decline for the major averages yesterday. And even though we're seeing a little bit of a better picture today with that mixed picture, the carnage is continuing in individual names that disappoint investors and are being punished severely. One of them, Draftkings, it's the latest casualty after a weaker than expected forecast. Those shares are tumbling by 16%. Roku is another where we are seeing a steep decline after that company's projections missed estimates. We'll have details on that in a moment. A potential European energy crisis, that's what's at stake if Russia does indeed invade Ukraine. We'll check in with a professor of global energy policy. And amidst all this gloom, a silver lining. Sals is going to have the charts for us that show the pandemic impact on the economy is receding. But before we get to all of that, we do have to get the latest on the Russia-Ukraine situation and how the U.S. is dealing with it in terms of sort of political leverage, if you will. Our Jennifer Schomburger has been following all of this. And Jen, this as we get also some headlines out of the eastern Donbas region of Ukraine. Headlines that indicate they are evacuating women and children to Russia. Be that as it may, talk to us about what we're hearing out of Washington.
Good morning, Julie. President Biden is set to speak with Western leaders this afternoon about the Ukraine-Russia situation as we see more shelling in Ukraine and as the U.S. and its allies try to band together to persuade Russia to back down. The president is set to hold a call with top officials, including French President Emmanuel Macron, German Chancellor Olaf Scholz, and British Prime Minister Boris Johnson to discuss Russia's continued troop buildup on the border. Biden told reporters on Thursday that the threat of an invasion remains, quote, very high, and that a Russian attack could happen in the, quote, next several days. U.S. Secretary of State Antony Blinken has accepted an invitation to meet with his Russian counterpart, Sergei Lavrov, next week on the condition there is no invasion of Ukraine. But U.S. Defense Secretary Lloyd Austin said during a press conference earlier today with his Polish counterpart that the United States has still seen no drawdown of the Russian forces amassed on Ukraine's borders.
Although Russia has announced that it is moving its forces back to garrison, we have yet to see that. In fact, we see more forces moving into that region, that border region. And we also see them going through, continuing to prepare by doing things that you would expect elements to do, military elements to do, as they were preparing to launch an attack.
Now, Vice President Kamala Harris is in Munich today for a major security conference where this morning she met with NATO Secretary General Jens Stoltenberg. Harris reaffirmed the U.S. commitment to NATO and reiterated the U.S. is open to pursue diplomacy with Russia, but if Russia attacks, severe sanctions will be imposed. Harris set to meet now with representatives of NATO's 3 Baltic states, Latvia, Lithuania, and Estonia. She will meet with Ukraine's President Zelensky on the margins of this conference this weekend. So, guys, a very fluid situation. Back to you.
And a very tense situation as we get all of these competing and conflicting headlines. Jen, thank you so much. All of those competing headlines have been affecting the markets, and the backdrop is that individual stocks are really being punished when they miss estimates. So let's look at Exhibit A this morning, Brian Sozzi, and that has got to be Roku. The stock is tumbling more than 27%, almost 28%. Let's run through the numbers real quickly here. You see their earnings per share actually beat analyst estimates, but revenue fell short of estimates in the fourth quarter. And also the first quarter sales forecast is short of what analysts had been predicting. Roku seeing some weak advertising trends, so that is not helping matters here. That first quarter revenue forecast is for $720 million. $751.5 million is what analysts had been predicting. Now, some analysts are still optimistic that the company's issues here are temporary, but the market is not, right? We're not seeing a lot of patience, Brian, being expressed this morning by investors.
Julie, there's no other way to summarize this quarter. Market response, just oh my OMG. That is the only thing I think you can really say here off of this market response to Roku. This is terrible, absolutely terrible. You're seeing slowing growth here in average revenue per user from Roku. They're noting that margins are under pressure because of ongoing supply constraints in the TV industry. Keep in mind, it's not just those plastic sticks that Roku produces. They're also integrating their operating systems into many TVs. It's been a key growth driver for this company for about 2.5-3 years. But it's harder to get those TVs to market because of the fact that TVs now are smart and need semiconductors, which are in short supply. But the real problem here, Julie, is the adjusted operating profit outlook, which Roku didn't put in its press release, but they sure did mention in their earnings call last night. They're looking for about $150 million this year in adjusted operating profits. The street was about at $540 million. So that is a horrific outlook for Roku. And I think a friend of the show, Steve Cahall, over at Wells Fargo, analyst that covers media, he put it perfectly. Roku is now likely a dead money stock, dead money. They just don't see any catalyst to get Roku shares moving here. I have a little more on Cahall's call now on the Yahoo Finance homepage. But still, this quarter stinks from Roku. The outlook stinks. It, in fact, probably is dead money.
And yet, interestingly, Cahill still has an equal weight on the stock, so I guess he's willing to ride it out. MoffettNathanson and Morgan Stanley were the only two firms that were sells, or the equivalents of sells, on Roku going into these numbers. And Michael Nathanson over at MoffettNathanson says Roku will have to win from here against rivals with bigger checkbooks, deeper teams of engineers, and better content. So we're looking at increased spending potentially in order to keep up with competitors. Some of the other analysts talking about a late entry into the international market for which Roku is being penalized. And there's one other comment that I thought was really interesting from Nathanson. He said the stock will likely hit a bottom, quote, when the equity value gets low enough for rumors of an accretive takeover to be considered possible. So I don't hear any of those right now. So maybe the stock is still going down here in the short term.
And Chad, I appreciate it. We've heard in the past before Roku as a potential takeover acquisition, but Anthony Wood remains a significant shareholder in Roku. He, of course, the CEO and founder of Roku. It's up to him if he wants to put the company up for sale, but it's hard to believe that will happen after a quarter where you're seeing the market response almost down 30% here. I mean, it's just not a good outlook. But again, Julia, I mentioned in the story here on the Yahoo Finance homepage, Roku looks to be going into an Amazon-like investment cycle, and clearly the street doesn't like it.
No, and we've seen Amazon get punished for that in the past, but Roku is no Amazon. So this punishment looks to be a lot more severe. Now, this really feeds into a theme that you and I have been talking about this week, which is that there are really some individual companies that have been punished so harshly when they miss, and not even necessarily when this is not a risk or a miss across the board for Roku, to be clear. Yes, it is a very negative outlook, but on things like gross margin, the company met estimates. And so this brings me to my next point, which is just to kind of take a pause here, look at where we are in the earnings season and look at the underperformance we have seen. For that, I want to take a look at some charts in the Yahoo Finance Interactive, the charts that you got to keep your eyes on this morning. One of them is just simply the Nasdaq Composite. Yes, the Dow yesterday had its worst day of the year, and in fact, its worst percentage drop going back to late November. But the Nasdaq has really been the epitome of the negativity that we have seen thus far this year because we have seen so many underperformers within tech specifically. So that 12% drop for the Nasdaq for the year to date is definitely notable. And of course, a bigger drop when you go back to the highs where it was in late November. So that's the first chart that I am watching. Now, as part of that Nasdaq underperformance, of course, you have Exhibit A within that, I guess, which is Meta. So here's yesterday's drop for Meta platforms. That meant, and Bloomberg flagged this, that the stock fell out of the top 10 largest publicly traded companies in the world. And we have a graphic of that as well, looking at those 10, because this isn't just limited to the US. This is looking globally as well. Apple, of course, remains the largest. Tencent now, and TSMC, Taiwan Semiconductor, edging out Meta in those top 10. Now, it's still in the top 10 in the US, but again, going back to the Wi-Fi Interactive and just the incredible underperformance and turn downward that we have seen in these Meta shares. The shares are down 38% year to date. They're down about 24% over the past year. And this kind of tells the story about the changing mindset in some ways. Yes, it's partially meta-specific, but it also has to do with the sort of changing mindset about growth more broadly. And then finally, the other chart I want to check on has nothing to do with tech, and it's oil, because I think we have to keep our eyes peeled for what's going on in the oil markets based on what's happening in Russia and Ukraine. And you can see here, obviously, oil has been climbing, and you and I have been talking a lot with folks about potential $100 oil, $150 oil even. Oil is pulling back a little bit today on the latest headlines as people try to game all this out. Natural gas, by the way, is still heading higher. At the moment, it's up by 3% today, but I think we have to really keep our eyes on commodities. That's not even talking about gold, by the way, which I know we're going to get into later in the show, but commodities really front and center right now, Saz.
Julie, I'm afraid to even go fill up my car this weekend. I don't even want to go to the gas station. Do not want to go at all.
I mean, but again, it's this sort of changing regime, right? Changing regime. We saw it last year, by the way. Energy stocks outperformed last year sort of quietly, even though we were still talking about tech and growth stocks. Energy did very well. And then going into this year, we have just seen this incredible rollover in tech. Can we talk for just a moment about the Archiverse as well? By the way, Brian Sazzi, speaking about a rollover, we saw Kathy Wood on CNBC yesterday defending her strategy, really offering a robust long-term defense of her strategy. Here's this so-called Archiverse and what's in that ARK Innovation ETF and what these stocks did yesterday. Here's an equal weight look at that. It's all red. And there are a couple of, and let's look at the extended session as well, because you can see what these guys are doing this morning. And there's a couple that stand out to me. Roku is in her portfolio, right, is in this, and it's obviously down this morning sharply. And then look at the stock right next to it. That's Draftkings, and that stock is down 16.5% after it had disappointing numbers this morning.
Julie, and I'll just add this too. And I think what the move we're seeing here in tech and big cap tech, it's not just, you cannot blame it on the fact that, hey, interest rates may rise starting in March, and that's bad for tech stocks. You're really getting the sense coming off this earnings season that big cap tech players, and a lot of tech players, I should say, finally realized they have to start investing even more in their businesses. Look at what Facebook is doing with the metaverse. Roku last night ramping up its pace of investments. So many tech companies right now are trying to crank up these investments to, I think, support some of the valuations that the market has assigned to them over the past few years. So again, it's a big adjustment process, I think, on Wall Street, trying to understand and figure out how much these companies are in fact going to spend.
And it's one that investors clearly are not going to be patient about, at least at first blush, right? We may see people coming back in over the coming months. We shall see. Well, we're going to take a quick break. When we come back, we're going to have much more on today's market action, looking back at what we've been seeing, and of course, looking forward. Charles Schwab Chief Investment Strategist Liz Ann Saunders will be with us after the break.
Roller coaster of a week for markets. Traders have had to digest everything from calls, more calls on Wall Street for 50 basis point rate hikes in March, to blowout retail sales reports, to uncertainty continuing between Russia and Ukraine. Let's welcome on Charles Schwab Chief Investment Strategist Lizanne Saunders to get a pulse on all things markets heading into the weekend. Lizanne, always nice to see you. Mentioned in the break that you were on fire again on Twitter with a whole bunch of helpful stock market related charts. One that caught my attention from you was the declining price to sales ratio for the Nasdaq, or in other words, tech stocks getting cheaper. Do you think tech is a place investors should be looking now, or that trade is still off the table given everything we are seeing with more volatility in the markets?
I don't think any area in the market, whether it's at the sector level or at the category level, call it, the FANG type stock, should be viewed with a monolithic lens. And I think that's one of the mistakes that investors could make this year, even if monolithic lens was the appropriate way to look at groups of stocks. If you look within tech and you look at the last 3 months or so, and the reason why I use that time frame is it takes you back to the point at which the Fed started tapering its balance sheet. So call that the start point of this move toward policy normalization. Value factors have been dominant performers even within sectors like tech. So you can be a lowercase v value investor and not limit yourself to only the sectors that happen to be housed in the value indexes, like energy or financials or utilities, whatever it is. So I'd say look for value, but that shouldn't limit your search to places only outside of tech. You can apply that to tech, consumer discretionary, communication services. And I think a factor-based approach makes a lot of sense in this kind of market environment.
And so, Lizanne, we have been observing lately that we have been seeing just utter disasters of stock reactions to earnings in what feels like an increasing number of cases. So, and it feels like, as Brian and I were just talking about, some of it is lack of patience on the part of investors that with sort of investment cycles by some of these high growth companies. Do you think that is the right way to view that? In other words, do you think people should be coming in here and looking for some of these disasters as potential opportunities?
Well, it depends on what the underlying fundamentals are. I wouldn't just try to bottom fish a disaster simply because the stock has gone down a lot. In an environment like this where growth has slowed, we've got negative earnings revisions ratio, you've got the valuation issues that come into much more clarity when you're in a tightening cycle, longer duration, higher beta, higher risk, higher multiple areas are the ones that tend to take it on the chin. So I wouldn't be a bottom fisher if the only thing you're using is a drawdown percent. I think what we're seeing is more discernment on the part of investors. It's part of the reason why equal weight is performing better relative to cap weight, why active managers are performing much better now than they have in years. And even among the FANG type stocks, the big five, the super seven, the grade eight, whatever, categorization, those sort of top 10 largest names in the cap weighted indexes, including the S&P and the Nasdaq, huge divergences in terms of how they're performing, drawdowns as much as 40% in some areas, much more resilient in other areas. And I think that's going to persist. I think quality value fundamentals matter. And if you happen to see a drawdown and the fundamentals are still there, absolutely. But I wouldn't bottom fish purely based on price decline.
Is this the new environment, Lizanne? With so many investors we talk to, they have not. I guess it's a little bit of a next generation investor. They have not seen or lived through or traded or invested into rate hiking cycles. But when you see a stock like Roku, down 30% is mind-boggling. Are moves like that more likely as the Fed starts to move higher rates?
Well, quite frankly, the lower quality, high spec trade has been under massive pressure throughout the past year. This is not a brand new thing. You look at these cohorts, whether it's non-profitable tech or the SPACs, even the D-SPAC index is performing worse than the SPAC index. Weak balance sheet companies, heavily shorted stocks, the meme stocks, you could throw crypto in there too. So these high spec, high beta segments of the market, those are the ones that tend to come under significant pressure. So you can find examples on a day-to-day basis, but in those aforementioned cohorts, over the past year, you've had drawdowns anywhere from 50 to 80%, depending on what cohort you're looking at. So that's not a prospective thing. That's an environment in which we've been living for quite some time now.
And so I guess, let's say, and the question then becomes, how long is that environment going to persist? Is this for the foreseeable future now that, and a lot of this, again, has to do with, well, it was anticipation of the Fed. Now it's that the Fed is actually going to move and that you just don't have that speculative liquidity that is in the market.
At some point, I'm guessing speculative juices will be revived. I don't expect it in the near term. I think what's interesting about the reaction to Fed policy is it's coming not because the Fed has actually started to tighten policy. They're still at the zero bound. They haven't, given us the first rate hike yet. They're still adding to the balance sheet. And what's interesting is this parlor game of how many rate hikes will occur this year. And market has priced in 7. You have folks out there with numbers higher than that. Yet every time I hear those analyses, there's almost no attention on the balance sheet portion of it. When you are simultaneously trying to shrink a $9 trillion balance sheet, and you can apply the equivalency of call it maybe, somewhere between $400 and $600 billion of shrink is the equivalent of a rate hike. I think there's just the number of rate hikes misses the bigger picture of a tightening cycle that is unlike any that we have seen in the past, because of that need to shrink the balance sheet in addition to rate hikes. So it's the combination of what they do. And the fact that unlike in past periods, they're not giving us a playbook. They're not telling us in advance, well, here's what we're thinking in terms of balance sheet shrink, the amount per month. Here's what we're thinking in terms of rate hikes. Data dependency is what they're emphasizing, which means we're all kind of living day to day in terms of what the data is going to look like and ultimately how the Fed has to behave.
Lastly, Lizanne, we have, investors are clearly nervous regarding the situation between Russia and Ukraine. What should they be doing right now? If an investor is mostly allocated to stocks here, what should they be doing ahead into the weekend?
I don't think there's one answer. I mean, that's a trading question. If given the end of your question, it's into the weekend. And I'm not a trader. The advice I give is not trading oriented. I would say that if you're thinking, if you're thinking in extreme terms, should I get out in advance of a 3-day weekend? I like to always remind investors, if they're thinking about or talking about all or nothing kind of decisions, get in, get out approach. That's not investing. That's just gambling on moments in time. And that's investing should always be a disciplined process over time. I think what is most important probably about the Russia-Ukraine situation is not so much the volatility it's causing on a very near-term basis. We see it pre-market, we see it intraday, but the impact any protracted military event would have on energy markets, an environment where oil prices are already high, natural gas prices have been volatile but high, not so much because of a surge in demand, but because of geopolitics. And we know in the past that surging oil prices, especially in a waning growth environment, alone have caused recessions. So you add that into the mix to energy crises happening around the globe already, and the fact that we're now heading into a tightening cycle, I think it would probably elevate the fears about recession if indeed we see some sort of protracted military event. But to try to game it in terms of portfolio shifts in advance of a weekend or any other point, I wouldn't attempt to do that. I certainly don't have advice on that front.
It's always a treat to get some time with you. Charles Schwab, Chief Investment Strategist, Lizanne Saunders. Have a great weekend. We'll talk to you soon. All right, traders are tossing shares of Shake Shack in the waste bin after a weak outlook. We'll have more on that straight ahead.
This is Yahoo Finance Live. We are watching futures kind of bounce around here. Nasdaq futures still in the green just a bit. S&P and Dow futures indicating slightly lower open here as we see traders continue to react to various headlines coming out of Russia and Ukraine and the European and U.S. interaction with that situation. But we also have to keep an eye on some individual movers that we've been talking a lot about. Draftkings is one of those movers, and it's another mover to the downside, sharply off by 14%. Earnings per share coming in below what analysts had been anticipating, even as revenue did beat estimates. So let's talk about the other numbers here that we're watching as well. 2 million monthly unique paying customers for Draftkings. 2.1 million was the estimate. So a little bit light of estimates there, but it seems like the biggest disappointment has to do with the 2022 adjusted Ebitda forecast, which is not actually an Ebitda forecast, it's an Ebitda forecast, I guess. It's for a forecast of a loss of $825 million to $925 million. That is much, much wider than the loss than analysts were expecting, and it's much wider even than the biggest loss, the highest estimate for a loss that was coming from the street. And it seems as though, again, here, it is partially a spending story. We've been talking about all these spending stories. Draftkings is spending to get customers. The question is, how much is it spending, and is the street deeming it worth it?
Well, Julie, you say Ebitda, I say Ebitda. I guess you could say it either way. Everybody comes up with their own metrics with these publicly traded companies. Oh, look, no, you're exactly on. Another company, richly valued tech company, which I think Draftkings is, in fact, a tech company investing more than the market thought, and the shares are being absolutely punished for it. Also, too, another company that is not making any money.
Well, hopefully somebody's making money, because there's a lot of cheering going on here this morning as we get underway on this Friday morning. It's been another wild week, right? We had the Dow drop yesterday, the most in a single session that it has all year. And in fact, going back to November 26, on all of this trepidation over the Ukraine-Russia situation, the knock-on effect on commodities and beyond. And then, of course, mix in some of these earnings reports that we've been getting, and you definitely get a not so great picture. Stocks right now, not much change, right? We're seeing a little bit of a mixed picture this morning, but just to put a pin in it when it comes to Draftkings, to your point about the company not being profitable, this goes back kind of to what Lizanne was saying. And she's right, it is a shift that has been ongoing, right, over the past 6 months, even longer, that there has been less tolerance for that sort of thing, right? You had in the beginning of 2021, just money, thirsty cash, I was calling it, pouring into speculative names. And clearly that era is done.
No, and I think a lot of these tech companies, Julie, were able to get away with quarterly misses like this and disappointing outlooks because rates were low. That's how the market took these things. Even if a tech company missed, it was okay because the stock would likely bounce back because of all the liquidity sloshing in the system. Well, guess what? That dynamic is now starting to change, and it could be changing in a big way starting in March when the Fed has their meeting and decides whatever they're going to decide with rates. It's just a different market environment. I think Lizanne was spot on.
So let's move to another company that's getting punished this morning. This one's not a tech company. It's a fast food company. Talking about Shake Shack here. Shake Shack this morning is another one that is being punished in the wake of its numbers. Here, though, if you look at the quarter that just passed, the numbers weren't bad, right? It's more the forecast that seems to be responsible here for the downdraft. So comp sales last quarter up 20.8%. That's a little better than estimated. That overall revenue of $203.3 million, a little bit better than estimated as well. Even restaurant level operating margin, 16.4%, was better than the 15.9% that was estimated. But if you look at the forecast for revenue for the first quarter, the company says at most it's going to see $201.4 million in sales. The estimate was for $211 million. So just again, no patience with that kind of thing in this market.
No patience for that, Julie, but also Shake Shack not providing any full year guidance, which was interesting. Of course, they're pointing to continued volatility in their sales, but something really that caught my eye is just another restaurant company warning about inflation. I have the story right now on the Yahoo Finance homepage. looking at where Shake Shack is raising prices, they are raising delivery prices for their food 10 to 15% because of higher levels of inflation. That is a big increase. Now, they're not pushing through those types of increases if you go into the restaurant and order. This is just for delivery. Now, overall, they took a menu price increase about 3.5% in October. They also said on the call there will be another menu increase because of inflation coming very shortly. So prices are going up at Shake Shack. Prices are going up at McDonald's. They're going up at Burger King. They're definitely going up over at Chipotle. So it's a very interesting time in the restaurant industry.
It really is. And let's talk about the ingredients that go into the stuff that you eat in the restaurants. I'm trying for a segue here. I'm talking about deer.
Wow, so good. You're such a pro.
The equipment that's used to harvest the stuff that goes into the, yeah, okay, you get the idea. All right, here we had first quarter earnings per share coming in at $2.92. That's better than estimated. Revenue also coming in ahead of estimates. The stock, though, trading off here about 1.7%. And this is even after the company also raised its 2022 net income forecast to $6.7 billion to $7.1 billion. But here, obviously, this is not as much of punishment as what we're seeing from the other companies. But the stock was trading higher initially after the report and now has turned lower.
Yeah, I'm not feeling very emotional about this quarter from John Deere, Julie. I think this is a company that remains on the cutting edge of farm technology. I do like what they're doing there. Probably take a couple quarters for them to overcome the lasting effects of that labor strike they had to deal with a couple months ago. But by and large, what John Deere does from a technical standpoint is incredibly useful, and they're helping to power the future of the ag industry.
They are. I mean, the question here is also with pricing, like it is with everything else right now, because yes, farmers are able to sell their crops for more right now, right? But the question is how much, what's the replacement cycle look like for their equipment? How much are they willing to pay for that equipment? So that all of that important questions, as well as Deere makes construction equipment too. So that's also a part of the calculus here. So all of this, something to keep an eye on for this important bellwether, right, when it comes to the economy. We're going to take a break after all of that. And we're going to check in with Jared Quigley on the other side of the break. He is watching. Ooh, look at that sunny yellow tie today. Maybe it can give some hope to the markets. We'll be right back with Jared on the floor of the NYSE next.
Welcome back to Yahoo Finance Live. Let's head down to the New York Stock Exchange and check in with our very own Jared Blickery. Jared.
I was just checking out the Wi-Fi Interactive, and we see the S&P 500 slightly in the green today, but just checking out the charts here, for the week-to-date price action, we're down about 1.2% in the Dow. In the Nasdaq, we are off, let's see, 0.64%, so about 2/3%. And in the S&P 500, we are down about 0.75%. And I just want to bring our attention to this 2-month chart that I've been tracking. We did get this little relief rally earlier in the week, but we are selling off right where short sellers would be expected to. So that's a negative price action right there that I'm looking at. Also want to take a look at the VIX because the VIX has been elevated recently. This is a 2-month chart. Let me put the candlesticks on here so we can see the spikes a little bit better. Here's that big spike that we got in January, and it looks like we're heading up again. Now, so far we haven't been able to rise above 30, so you could say that's a little bit of a positive development. But even if we go back and test the 2022 lows with some momentum, it doesn't mean that the VIX is going to eclipse these highs here. So what I'd be looking for as a buying signal, if we do get some downside price action, is a lower low on momentum that's quickly reversed to the upside. And we've seen that a number of times. The question is, how much farther down is that? We got to let the market tell us. And then conversely, if the market goes up to, let's say, 4,600 in the S&P 500, then I'm going to take that as a sign that we're progressing to all-time highs. So kind of still in this critical zone for the markets. Now, checking out the sector action today, we got financials, materials, and communication services in the lead. Those are all in the green here, but one sector that's not doing so well are these let me look for this. Chinese stocks. We're also tracking the ARK Innovation stocks as well, but Didi having a rough go of it. Chinese authorities looking into the ride-hailing companies over there, saying that they have to be a little bit more fair with their pricing. So you take a look at what Didi has done since its IPO date, down 70%. So the negative news out of China is still flowing here. And also want to check out those ARK components. Roku, just an absolute disaster. You check out what's happened over the last year. A lot of these stocks peaked 1 year ago. You can see Tesla's a standout, Intellia Therapeutics, but Ebitda down 80%, Teladoc down 75%, Roku right there with it. A lot of these stocks just keep getting hammered. I want to end on the futures market because we've seen some positive action in a lot of these guys here. Let me get back to an intraday basis. Now, gold is particularly, I'm tracking gold today. This is a 1-year chart, and we can see that it's finally broken to the upside here. And in fact, if we put a 2-year chart on, it becomes even more clear what's happening. It broke through this negative trend line here and is marching upwards. So given the length of consolidation here, we're talking over 1 year, I would expect this move in gold to have some legs, guys.
Yeah, perfect time for our chat with Barrett Goldseal, Mark Bristow, Jared. That's coming up in the next hour. All right, we'll check back with you soon. All right, from gold to Apple. There are some new reports out here this morning, mostly from the Washington Post, that there might be a wave or workers at Apple stores looking to potentially unionize. Let's bring in Yahoo Finance tech editor Dan Halley for more here. Dan, how big would this be for Apple's bottom line if we do start to see a union effort here inside Apple stores?
Yes, Ozzy, it's really, at this point, still a little bit unclear because it only looks like there's a handful of employees that are actually trying to unionize. According to this Post article, it's 2 stores in particular, though they don't really go into which ones. Now, there's more than 200 Apple stores across the U.S., as well as their global stores. That is a large number of potential employees. We're talking in the thousands. And the issues here seem to be similar to what other retail workers have brought up over the past year or so, basically stagnating wages, the issues with inflation, meaning that essentially they're not earning as much as they used to, and the fact that the wage increases that they're looking at, if at all, are paltry compared to what they would otherwise want. So it's really about how they're getting paid and how they're sharing in the wealth that Apple has managed to generate. It's the first publicly traded company in history to hit that $3 trillion mark, which is just wild to say out loud as usual. And they want to be able to see how they can get a part of that huge gold rush that Apple's managed to push. And I just want to throw gold in there because you were talking about it.
You know what? You are a true team player, Dan Halley. Thanks so much. We'll talk to you later. All right, here's a pretty stunning Yahoo Finance stat of the day. Headed into the long weekend, Zoom is now 1/10 the size of ExxonMobil after passing it during 2020, points out Ritholtz Wealth Management Research Director Michael Batnick. Zoom's market cap currently stands at about $38 billion versus $330 billion for ExxonMobil. All right, still to come, the world is anxiously watching the situation between Russia and Ukraine and what it could mean to global energy markets. More on this next.
We continue to see energy prices buffeted by headlines out of Ukraine and Russia, particularly acute perhaps when it comes to natural gas, because Russia is an important supplier to the rest of Europe. Of course, it's an important crude oil supplier as well. So what are the implications of this brewing conflict for the energy markets? Dr. Pierre Noël is a global research scholar at Columbia University's Center on Global Energy Policy, and he joins us now. So Pierre, as we watch all of these competing headlines, what do people need to keep in mind about the significance of Russia as a supplier to the rest of Europe?
Thank you, Julie. Well, they need to keep in mind perhaps one number, which is that the flows of Russian gas to the European Union are worth about a third of global LNG trade, right? So if we were to lose, if we were to have a disruption of the total supplies of Russian gas to Europe, you would have a massive transfer to the LNG market, which would trigger a global energy price spike. So you're talking about potentially the largest energy supply disruption in the history of energy markets.
Frame this for us a bit. When you say crisis, a lot of the numbers we've been hearing as the situation has unfolded is $150 a barrel, at least from the oil markets. Would that be high enough?
So the spike would start, of course, from the gas market. It would migrate to the oil market via interfuel substitution in Europe and in Asia, as the market looks for any molecules of natural gas that can be shipped to Europe. So people in Asia would shift to oil if they can, to free up some LNG, some natural gas for Europe. And in Europe, of course, any oil that can be substituted for natural gas would be. So that would be supportive of the oil price. However, the macroeconomic implications of the crisis would of course go the other direction and would put pressure, downward pressure on the oil price via inflation and lower economic growth.
At this point, it looks like there could be sanctions imposed on Russia, right? And so it seems as though it may not be Russia cutting off the flows. It would be potentially the West that is sanctioning Russia, which would result in cutting off flows. Is that correct?
Yes, and this is something that is not widely discussed and is actually overlooked completely, I think. Russia has never mentioned, ever since the start of these tensions, Russia has never mentioned or let alone threatened to cut off Europe. We've had, on the other hand, a lot of talks from the US and its closest allies pointing towards financial sanctions that would be so wide-ranging, so disruptive of the Russian financial system that perhaps European buyers of Russian gas would no longer be able to pay for it. And so you're contemplating a situation where it's not Russia that would cut off Europe. It's actually Europe that would stop buying Russian gas, including to comply with US imposed financial sanctions, which I think would be unprecedented indeed and probably conducive to significant political tensions within the West as well.
So, Pierre, I'm going to put you in an unfair position then and ask you how likely you think all of this is. And I say unfair because, I mean, who can tell at this point what the outcome is going to be? But from where you sit, what do you think is most likely?
Totally unfair of you, Julie, indeed. No, I'm not going to pretend that I have insight that I actually do not have. What is clear to me is that even if there is no full-scale war this time, we have entered a new era. The post-Cold War era is over. Russia has indeed launched a campaign which will not abate, a campaign to obtain new security arrangements in Europe that would accommodate their so-called red lines. The West, the US and European powers will have to decide whether they are prepared to negotiate over those red lines with Russia or whether they prefer to enter into a state of permanent confrontation with Russia. If they choose the latter, this is bad news for Europe, bad news for Russia, but this is extremely bad news for Ukraine, which will be unable to go back to economic growth and will drift into a state of increasing political instability and ungovernability. The energy implications is that if we move into a period of permanent confrontation with Russia, there is no way that the Russia-Europe gas relationship can move back to stability. Nord Stream 2 will probably not come online. The Ukrainian transit will be under permanent threat of being disrupted by a new military crisis in eastern Ukraine. And therefore, this is bad news for natural gas. This is bad news for Europe's climate policy as well, because gas makes it cheaper and easier to reduce carbon emissions. And this is basically a lose-lose situation for everyone.
Well, hopefully the prospects of that will be enough to avoid all of it, but we shall see. Dr. Pierre Noël, Global Research Scholar at Columbia University Center on Global Energy Policy. Thank you so much for joining us. Appreciate it. When we come back, of course, we're still in earnings season. While some companies have warned about inflationary pressures, continued impact from the pandemic, there are signs the pandemic pressures could be easing. That could be starting to help corporate America. Saz is going to be here with some charts that tell us how. Cancellations too. Brian Sozzi, you have some charts brought to us, I think, via one of the firms on Wall Street. Now I'm forgetting who, that show us this story.
Goldman Sachs, yes. Let me rip through this, Julie, because life is brief. First up, good Goldman Sachs chart looking at the average number of virus cases in the U.S. or new cases. You can see right there from that lovely chart from Goldman Sachs, that has really fallen significantly in recent weeks. That is good. Check done. Next chart, really looking at worker absenteeism amongst corporate America. That looks to have peaked according to that fancy cool chart from Goldman Sachs right there. Worker absenteeism in factories has been a big problem, causing a lot of shortages, notably in the food space. So that perhaps might have peaked. And I have to give a shout out to my friend and former boss, Jim Cramer. I think he said this a little bit tongue in cheek on Twitter in response to me putting this chart out there. Said, this is good for Jerome Powell, ... Not necessarily. More workers back at home, more consumer spending, hotter inflation than what in the world would actually do with interest rates. Last chart here, looking at flight cancellations. Goldman Sachs, the airlines, amongst the airlines it covers, flight cancellations look to be declining here. Of course, the peak was really the holiday season when it was an all-out disaster, but still good to see that there as well, likely because more workers at airports and airlines are back there working post getting their vaccine.
Yeah, all of that stuff is good news. And by the way, we're going to talk to a hotel analyst next hour as well, so we can talk to him about the perhaps waning effect of COVID on that business. We heard from a lot of the hotels this week. Coming up after the break, though, we are going to give you a check on stocks and bring you the latest home sales data. That's coming up at the top of the hour here as we see all three major averages now in the green by a smidge, but we'll take it. We'll be right back.
It is Friday. Welcome back to Yahoo Finance Live. I'm Brian Sazi alongside the Julie Hyman, and it is a little bit of a risk-on type of morning after Thursday's 600-plus point drubbing on the Dow, seeing the major indices slightly in the green. Of course, all eyes remain on the situation between Russia and Ukraine. Markets might be in the green now, but they could very much end up today's session in the red. Now, here are some other things we're watching for you right now. The tech wreck continues. Shares of Roku are being smashed as the streaming giant served up a brutally bad profit outlook for this year. Meanwhile, cloud player Dropbox is seeing its shares being swept up into this tech wreck despite beating on earnings Thursday night. All right, the luster is back. Gold prices are breaking out as investors fret about the outlook for inflation. We'll talk with the CEO of Barrick Gold, which is one of the largest gold and copper producers in the game today. Speaking of games, one guy is not playing them. Activist investor Alta Fox has launched a new campaign to install 5 board directors to Hasbro and is pushing for a spin-off of its key division. We're live with the founder of Alta Fox coming up. Julie, over to you. Breaking news on the housing front.
Yeah, we got existing home sales coming in at 6.5 million annual pace in January. That is better than estimated. 6.1 million was the estimate from economists, but there was a downward revision the prior month for December. We saw existing home sales at an annual pace of 6.09 million, down from the initial read of 6.18 million. All of that means that month over month existing home sales rose by 6.7%. So coming in here again, better than estimated. So the housing data that we've gotten lately has been somewhat mixed. Yesterday, we got some building permits numbers that were not quite as robust. And so, you know, it's a little bit mixed here what we are seeing as we see mortgage rates start to go higher, as we have seen housing prices really surge, which affects affordability, which of course affects whether people want to make offers on homes. So that's something to keep in mind. There you see the mortgage rates and the increases that we have been seeing in those mortgage rates. So all of that in the mix here. That existing home sales number, by the way, that annualized pace of 6.5 million is the highest that we have seen in a year, which is pretty fascinating here, given the already robust demand that we've been seeing. And by the way, there's one other economic data point that also came out in the past few moments, and that's leading economic indicators. This is an index, a compendium of different economic indicators, and it fell by 0.3%, which is interesting given that we have seen a lot of other numbers that have been coming in before ahead of estimates, retail sales, inflation, for example, all of that higher than estimates. So Brian, it's interesting here. People still buying houses.
Julie, I got one for you. LEI in the house. See what I did there? Like that?
Sure. Leading economic indicators. I like it. I like it. I'll take it.
No, well, look, I think you've seen some pressure, some relief being blown off of shares of a lot of these home plays, Julie. Sherwin-Williams been warning about inflation. Home Depot, Lowe's off their highs. You know, there's concern that with these rates going up, we might start to see just different sales and profit trajectory for a lot of these home plays. But really, with rates going up, we're also seeing a different narrative in the tech space, Julie. I think Roku remains the stock story of this morning. Of course, that Draftkings earnings whiff for this year is trying to reclaim some market share for Roku here, but still, this is an ugly market response. Stock's down about 22% here from Roku. They came out on the earnings call last night, highlighted that they may hit $150 million in adjusted operating profits this year. Street was looking for about $550 million, a really big, ugly, nasty whiff there. And I'm looking at really some good research by the folks over at Pivotal, Julie, calling out content inflation, more headcount hiring for Roku, starting to clip away at the company's bottom line. They're rating the stock a sell here with a $95 price target.
Yeah, and this is, they're not the only one on the street to come out and get more negative on the stock today. A lot of different price target cuts is what we saw for Roku on the disappointment in this number. As we talked about earlier, Roku is both a platform and a hardware company. Roku is like the little thing that you attach to your TV to get the streaming. And like many companies, they've been having trouble with their supply chain. They talk about those issues maybe getting better as the year goes on, but nonetheless, that's still something that's weighing on the company, and one of the many things that seems to be causing people to sell the stock this morning.
And really, it just continues this harsh reaction to all things streaming, Julie. Netflix, go back a couple of weeks ago, they reported earnings, disappointing first quarter outlook. And Viacom CBS, Julie, we talked to the CFO, Naveen Chopra, earlier in the week, and they're putting so much new content out there on their platform. Big outlook for them, 2024, looking for 100 million streaming subscribers, up from about 65 to 70 million target this year. I mean, the growth is there. It's just the market doesn't care about it anymore.
Well, and in some cases, the growth is there, but there are sort of two issues. One is the issue of people staying home more now because of what's going on, right? Wait, is that Viacom CBS today? Is it falling another 18% today?
I'm trying not to look.
That's pretty incredible if that's what's going on today, because the stock already, as we know, got hit hard when it came out with its numbers. So the fact that it's down another 18% is pretty astonishing. So what we see here are
Julie,
two
that
things.
looks right.
To go back.
That looks right.
Sorry, I had to do a double
right.
take there. I did like a triple take there. So there are two things going on here, I think. One is obviously the migration away from the stay-at-home trade, which is significant. Roblox is another example of that. Kids are actually going outside, imagine that, and not perhaps spending as much time in front of their computers. And of course, the audience base for Roblox is also migrating older, which, I guess is a good thing or a bad thing, depending on what analyst you talk to. So that's part of it, right? So it's that migration. And then there's the spending piece, which we've been talking a lot about this morning, that there's this investment cycle on the part of many of these companies to deliver and to continue to deliver on the robust growth that they have been delivering on. And the street's not here for it. I mean, that's just the bottom line for many of these companies.
Yeah, and if you can't drive the growth internally, go out there and make a big deal. And one you were watching today or flagged, Julie, was Celanese pulling out its wallet and spending big on a division from DuPont.
Yeah, exactly. So this is something that was reported on initially by Bloomberg, and then it actually happened. So Celanese is buying the majority of DuPont's mobility and materials arm. $11 billion is the price on this. It is the biggest ever acquisition that Celanese had made. And it seems like there was a little bit of bidding from it from private equity as well. Celanese, not exactly a household name, but it makes chemicals and other products that are components for things like paint, for example. And DuPont, the unit it is buying, makes polymers and resins that go into a lot of different stuff: cars, electronics, consumer products. So definitely bulking up the business here. And Celanese says, you always hear about synergies with this kind of a deal. $450 million, it says, of synergies within 4 years. And it's going to add $4 or more to its adjusted earnings per share by 2026. This is one of the biggest deals, by the way, that's been announced thus far this year. Obviously, this year has not gone on for very long yet, but
it feels like
it is. You got that right. But yes, it is a pretty sizable deal that we are watching this morning.
And just something to tuck away before we head to break, Julie, we continue to see the unwinding of very old manufacturing companies here. Of course, you see the Celanese deal with DuPont. So GE planted its stake in the ground. They're splitting up into many different companies. 3M recently sold off division. So a lot of these companies, I think internally, those old school industrial powerhouses are really having a coming of age moment where they realize that conglomerate model probably is not getting the love it deserves here in the market. So why not try to spin off some divisions here and boost market value in that way? All right, well, speaking of boosting market value, an activist investor is taking aim at storied toy maker Hasbro. We're back with that activist clamoring for big changes next. Our next guest isn't playing games. Activist shop Altifox says toy maker Hasbro is, quote, empire building without financial discipline. The firm has put forth a slate of 5 potential new board members to Hasbro and is pushing for a sale of the company's Wizards of the Coast digital property. Let's dive right in here with Altifox managing partner Connor Haley. Connor, good to see you this morning. Very detailed 100-page slide deck from you on why this is the right move, that Hasbro should sell off this division here. Make your case.
Well, first, thanks for having me on. Hasbro, first, we love to play games. We're consumers of Magic the Gathering. I've played for over 2 decades. Other people at my firm play. We love all of Hasbro's properties, and the company has tremendous potential. Unfortunately, the company has also underperformed the S&P 500 by nearly 100% over the last 5 years. Look, this is a pivotal moment in Hasbro's history. Most investors still perceive and value the company as a legacy toy business, but this is really deeply flawed. The vast majority of the company's value is in their Wizards of the Coast segment, which is the fastest growing, highest margin, and ultimately most valuable segment within the company. Investors are not giving the company enough credit due to poor disclosure and poor capital allocation. We believe a spinoff of this unit would create tremendous upside. We believe over 100% over the next few years.
Connor, I've talked to a lot of good folks in the toy industry over the past 12 hours or so since the campaign was launched, and they all collectively say that the board members that you put forth, 5 of them, are not qualified to be on Hasbro's board. They really have no toy experience. Someone I spoke to highlighted that one of the names is someone who has spent a lot of time in the insurance industry working for AIG. What do you say to that criticism?
I think that's a Hasbro PR slant and could not be more wrong. If you look at our nominees, first of all, we interviewed over 100 people to find 5 amazing candidates, and I believe we have a world-class slate. I'll give you just a couple of examples of our amazing candidates. First of all, Matthew Calkins. He's the CEO and founder of multi-billion-dollar company Appian. He has tremendous digital experience. He also is an award-winning game creator, having created multiple games, has participated in the World Board Gaming Championship successfully several times. You have somebody like John Finkel. He's widely considered the greatest Magic the Gathering player of all time, and also has a very sharp quantitative mind, being in the finance industry. Who better to repair the severed goodwill over the last several years with the Magic the Gathering community, which is the largest segment within their most valuable business segment, Wizards of the Coast, then John Finkel. We've got someone like Marcelo Fischer, who is the CFO of IDT, who has done a tremendous job of capital allocation and is a true spinoff expert, having overseen over 5 spinoffs in the last decade. We've got Ryan Hublot, ex-McKinsey, deep strategy experience, also a marketing mind. We've got Carolyn Johnson, no nonsense, excellent in corporate governance, has led multiple value creation at several different companies. We have a world-class slate. To say that they don't have board game experience, clearly flawed. To say they don't have Wizards of the Coast experience, clearly flawed. To say that they haven't created value, clearly flawed. We have an excellent board of directors nominees. And I also believe that, look, they have plenty of consumer experience on the existing board. They don't have Wizards of the Coast experience. That's the most valuable business segment. We need incremental board members there with a refreshed perspective, given the underperformance over the last 5 years.
Connor, it's Julie here. So there's unlocking value at a division without potentially spinning it off as well. And I ask this question because looking at a D&D business, looking at a Magic the Gathering business, like many toys and games, this stuff tends to be cyclical, right? It waxes and wanes in popularity. And I say this as amazingly as a nerd. I don't know how I haven't played Dungeons and Dragons, but my kids certainly play Magic the Gathering. And so doesn't it being part of a larger organization help hedge against some of those trend changes when they do happen?
It's a fair question, but I would disagree. Magic the Gathering and Dungeons and Dragons, they've been around for roughly 30 and 50 years respectively. They've seen many different economic environments. They've seen many competitors come and go. But the reality is this business segment as a whole has grown at a double-digit revenue CAGR for the last decade. And that's increased over the last 3 years. In the last year alone, Wizards of the Coast grew revenue 42% year over year with roughly 47% Ebitda margin. This is an incredible level of profitability and consistent growth. Ultimately, what Hasbro has done with this asset is They've distracted them from investing in their core franchises. They've tasked them, for example, with creating a G.I. Joe AAA video game. They've tasked them with creating a Transformers card game. They've tasked them with doing these various things that have not created value, that we believe will not create value. And ultimately, it's distracted them from their core players, and the players are frustrated by it. We've received an overwhelming number of support from players giving us ideas, saying this is the first time they've really felt their voice heard. Our nominees can really be part of positive difference here. And I think by separating Wizards of the Coast, you can have a much more focused company with improved capital allocation and a better valuation.
So Connor, where do talks stand with the company right now?
Look, we've attempted to collaborate with the company for several months leading up to this nomination. It's no coincidence we nominated right before the company deadline. We were hoping that we could still collaborate with them. And to be clear, we remain open to collaboration with the company. But we need to first start by facing the facts. Hasbro has underperformed the S&P 500 by nearly 100% over the last 5 years. They are also losing significant market share to Mattel within their core consumer business. And this has accelerated over the last 3 years. Things are not going well, but there's tremendous opportunity. That is a case for change. And I think the existing board needs to face the reality of the underperformance and say, what can we do to improve this? We want to support Chris Cox, the new CEO. That's a very important message. But he has a big task ahead of him, and he needs really qualified directors that better reflect the business mix of Hasbro, which includes Wizards of the Coast today, to help him take the company to the next level.
Connor, I appreciate your passion. And clearly you have done your work, but let's take a step back here. How much consideration have you put into the fact that, look, one of the most respected toy executives in the industry, in Brian Goldner, he just unexpectedly died. Chris Cox, he doesn't start as the new CEO until next week. Have you put consideration behind why you launched this attack now?
Well, first of all, this is not an attack on any individual. It's obviously extremely tragic what happened to Brian Goldner. And this is not an attack on Chris Cox either. This is really about improving corporate governance and making sure that there's alignment between management, board, and shareholders. That has not been the case. Over the last 5 years, the management and board have extracted more than $180 million in compensation, while the stock has underperformed the S&P 500 by nearly 100%. Okay, that is not good corporate governance. We want to improve corporate governance. We want to align shareholders with the entire ecosystem. And ultimately, we want to support Chris Cox with highly qualified nominees. If we have the exact same strategy and the exact same board with a first-time CEO tasked with running 3 completely different businesses, that is a recipe. That is a recipe for failure. And we think Chris Cox is very qualified. We think he has a tremendous opportunity ahead of him, and we think our nominees can help him be successful. And we hope the company does the right thing for shareholders by trying to collaborate with us and finding the right path forward for this company. Because the current path over the last 10 years, it just hasn't worked. And that's just, those are the facts. It's math, it's not an opinion.
Connor, we're always curious when we talk to activists to find out at what point do you sort of take it to this level, so to speak? In other words, you talk about wanting to help Chris Cox. Have you had dialogues with the company? Have they, entertained some of these ideas that you have in order to change?
We've had a lot of dialogue with the company, their senior management and the board level. They haven't allowed us to talk to Chris Cox despite several attempts. I think they've shielded him from us, which is unfortunate. And we're an open line. Chris Cox can call me anytime. I think, frankly, we have a lot more in common. We're both Harvard guys who are strategy nerds who love board games and strategy games in general. I think we're actually a lot more aligned than he probably thinks. But, look, we tried to collaborate with them. But I think the biggest issue to date is I think the board has not acknowledged that the company has underperformed. If you read their press releases, you listen to their conference calls, they are very self-congratulatory. They love to tout how well the brand blueprint strategy is going. They love to tout continuing strong shareholder returns. The reality is they're guiding for low single-digit growth in overall next year in terms of revenue and flat adjusted EBITDA. These are very disappointing metrics, and they significantly lag rival Mattel. And this is despite the fact that they have an amazing Wizards of the Coast business, which is deeply undervalued inside of Hasbro. So look, this is a very pivotal time in Hasbro's history. Our nominees are extremely well qualified to help take it to the next level. We're an open line. If the board wants to collaborate with us, we're very open to that. However, we cannot stand idly by if the company decides to continue the exact same strategy with the same leadership and expect different results.
You know, Connor, there's if I've learned anything from covering these activist campaigns, there's always different layers to it. And in many respects, I would say you've just fired the first shot at the company. So you have a 2.5% stake in Hasbro. Are you inclined to raise that stake even more? What's your next move here?
You know, we're already a top 10 shareholder of Hasbro. I'd point out we own many multiples of the cumulative ownership stake of the current board, none of whom has bought stock in the open market in the last decade. So we think we're significantly already more aligned with shareholders. I would also point out a majority of our nominees have bought stock in the open market in the last month, which contrasts significantly with the existing board of directors. So look, we're very focused on driving shareholder value here. The initial reception, both from the player community as well as shareholders, has been very positive. There's tremendous opportunity at Hasbro. We're not a scorched earth activist. We're not trying to embarrass anyone. We're not trying to make it about any one individual. We're trying to drive positive value here, both for shareholders and all constituents. As a player who deeply respects the Magic the Gathering community and many of their other brands, it's upsetting to see, for example, Hasbro cutting the prize pool, right, for the most important Magic the Gathering tournament, right, of the year last year from $1 million to $250,000, trying to save a de minimis $750,000. They ultimately restored the prize pool back to $1 million after significant backlash. But look, the damage had already been done in terms of goodwill with their customers. These are the types of short-term moves that a large conglomerate makes, but it ultimately has long-term ramifications. Our nominees can come in and help improve the goodwill with the community, which is ultimately important to the long-term success of Hasbro.
All right, let's leave it here for now. Altifox managing partner Connor Haley, we'll stay in touch with you. I'm sure this is just the first thing in to come here in this situation. All right, coming up, Joe Rogan's deal with Spotify may be more lucrative than most people thought. Julie is back with the details next.
Brazilian meatpacking giant JBS has pulled out of a deal to buy U.S.-based chicken processor Pilgrim's Pride. The deal had valued Pilgrim's Pride at around $7 billion. JBS currently owns 80% of the company, but was unable to reach an agreement for a full buyout. Pilgrim's Pride announced earlier this month it had rejected 2 offers by JBS, the most recent at $28.50 a share, which Pilgrim said undervalued the company. Those Pilgrim's Pride shares, by the way, are plunging today on this news. They're down by 14%. A new report by the Wall Street Journal shows investigators have widened their probe into Activision Blizzard's leadership and its handling of workplace misconduct claims. The California Department of Fair Employment and Housing has subpoenaed Activision's directors related to the handling of workplace issues. It's also subpoenaed LA area police departments for any records they may have relating to Activision CEO Bobby Kotick and 18 other former and current Activision employees. Activision responded to the subpoenas, calling them a, quote, extraordinary fishing expedition. This comes as Activision is working to complete its $75 billion sale to Microsoft. And a cargo ship filled with cars headed from Germany to the U.S. is on fire, with no crude aboard in the Atlantic Ocean. That ship caught fire Wednesday, prompting the 22-person crew to abandon ship. Left behind, a cargo of Volkswagens and Porsches. They're currently burning with that ship. The 650-foot-long vessel has a carrying capacity of 4,000 cars. Luckily, all members of the crew were rescued by the Portuguese Navy, but no telling what's ends up happening when you've got a ship on fire like that, Brian Sozzi.
Yeah, well, Julie, I think my Porsche I order is on the ship behind that, so I think I'm good. But look, Joe, more news out this morning, Julie. Really in-depth report out of the New York Times on Joe Rogan. His overall contract value might be $200 million. You know, everyone was saying in the industry that he really was signed to a $100 million deal, but this is this is a potentially big step up in how much he's making.
Yeah, indeed. And we're talking about a contract over 3.5 years. And this also explains to some extent why Spotify has been such a staunch defender of Rogan as part of its platform, even though they have taken down some of the older episodes of his podcast, some of which showed that he used racial slurs, for example. The most recent podcasts that have caused controversy have been interviews between him and vaccine effectiveness deniers, for example. So all of that causing a lot of controversy at Spotify. But again, it sort of emphasizes the point that the company has bet the farm on podcasts. Of course, most people turn to Spotify for music. That's how it built its business. The musicians on Spotify, by the way, get paid very little per play of their songs. So it now seems like that the podcast portion of the business is accounting for more of the listenable hours as a proportion of the total on the platform. And obviously a lot of the spending as well that Spotify is doing. But I think there are still big questions about whether Rogan's going to end up being worth it at the end of the day.
Julie, who has time to listen to all these podcasts? They're all over the platform.
Me. I wonder that very consistently, actually, Brian Sozzi, because I don't have that time. But I'm glad that there are people out there who do, and certainly Spotify is hoping that. Speaking of streaming, by the way, we just had to offer a bit of a correction here. When we did our double and triple takes earlier at Viacom CBS's decline, well, silly us, it's because it's not Viacom CBS anymore. It's Paramount now, of course. And not only has the company changed its name, it changed its ticker. Para is the ticker, P-A-R-A. The stock is down, but it's not another 17% decline.
We were in the
It's off about
ballpark.
2% today. We were directionally correct. Magnitude, not so much. So just to flag our viewers for that, it's down a little bit today. Well, coming up next, gold prices, they are not down a little bit. They've been breaking out to the upside more consistently. That's good news to producers like Barrick Gold. We are back with the company's CEO. That's next.
The luster is back for the gold sector. Gold prices are breaking out as investors fret about the outlook for inflation, and that is sending shares of producers such as Barrick Gold higher. Let's check in with Barrick Gold CEO Mark Bristow. Mark, good to see you here this morning. I was joking with the team this morning. You've probably seen a good number of cycles, a real veteran of this industry. What does it feel like right now, just given all of these high levels of inflation we are in fact seeing, which tends to be good for gold prices?
Yes, Ozzy, thanks for having me. Of course, and one of the things about these big corrections in the markets, and that's where gold does really well, is you only see them when they're upon you. And we're certainly, if you go back to the end of last year, everyone was really bullish, and it was always all going to be fine, and things were transitory, and suddenly things are a reality. And we've got hot markets, inflation, a lot of conflict around the world, and a global economy that's not in sync. So that's always good for gold.
And so one of the other things that has been affecting you guys, just like it's been affecting anyone, is not only do you have to get your product out of the ground, you have to get it to where it needs to be. And I know that you all have been very focused on supply chains. So talk to us about the latest and sort of give us a status report on that front.
So, Julie, that's true. I think I grew up in northern Africa, and I understand supply chains. And so, the sort of sophisticated developed world has been caught flat-footed on supply chains, has been caught flat-footed on many things related to COVID, and so, the importance of being agile and being able to manage supply chains is absolutely critical, particularly in the mining industry, because we rely on it. We move a lot of stuff to the mines to mine the ore and then move it all back out again. So it is a challenge, but it's absolutely manageable. And, that's going to be the separator. And I think it's going to be the separator in many industries, those who can manage the supply chain and those who can't.
Mark, I don't tell you this, but these are tough jobs working out in gold mines. It's not like putting on makeup and going on TV here. I mean, no offense to what me and Julie do, but mining for gold, it is a tough gig. Are you having trouble finding the next generation of workers in this tight market to get in those mines and work them?
Sozi, the important thing is we pay well, and the big challenge, and when we did the merger with Randgold, the big focus there was let's focus on the best assets and, more importantly, the best people, because mining has always sort of been in the back of the queue when it comes to quality people, and we can offer fantastic careers, and that's what we've done, and we feel that there's a huge opportunity to access young people and give them a real career in mining.
And the opportunity that you guys are seeing, not just that you're offering to people, but that you're seeing for the company, prompted you guys to announce a share buyback program as well. Do you think that as we start to see gold prices recover, that Barrick is going to be rewarded as well? I mean, how do you think you convince investors to see the value like you see the value in the company?
Julie, we come we did a big merger in 2019, a couple of deals in Nevada. We consolidated Newmont and Barrick's assets. We took out a problem child company in Africa called Acacia. We merged with Randgold. And my ambition is to build a modern mining company acceptable to future generations, and we've been underperforming the market, particularly recently. It couldn't have been a better time. We've focused on delivering high quality assets with the best people, delivering quality and financial results, and we were lagging in the market. And so we came out with a revised dividend policy. We indicated that we got approval to do a big $1 billion share buyback because we felt that our share price was undervalued, and it couldn't have come at a better time. Get everyone focused on the stock, and now everyone is focused on gold because of the situation globally.
I like what you said on the earnings call the other day, Mark. You said, quote, competition for M&A at the moment is competition to survive. Now, this industry has a long history of boom and bust cycles as it pertains to M&A. Do you feel heat to make a big deal here?
You know, we looked at all those, and one thing that's sort of kept me in this industry is the things that I didn't do rather than the things that I did. And it's so easy to do big deals at Premier at the top of the market. It's much more difficult to exercise that discipline. And you're right, Sozi, we have a great history or tradition of buying in the top and going bust in the troughs. And we have that discipline. And also mining is a consumptive industry. So it's very important that you invest in your future all the time, not only when the going's good. And you know, that's what we in Barrick have done. And we were one of the few companies this year in our results to point out that we've replaced all the gold that we mined last year. That's a significant step forward, and it's a standout performance in an industry that's always battling to keep its asset base intact as it mines it away.
Well, lastly, real quick, Mark, somebody who wants to get into the gold market, just given if they have concerns about inflation, how do you recommend they do it other than buying shares of Barrick Gold? How should they go about it?
So the ETFs are probably the easiest way to get it, and you can buy equity ETFs, and you can also buy the physical gold. And you know, the physical gold is a very safe bet, but you don't get the premium that you get in a good equity. At the same time, in a bad equity, you're exposed to the risks, operational risks, and you don't sometimes get the full benefit of what gold brings to a portfolio. And, you know, over time, and I'm talking, you know, the last 50, 60 years, gold has always been a stabilizer in a portfolio. And you should have around 5% of your portfolio in some sort of gold package. And that really helps you through difficult times.
Spoken like a true veteran of the industry. Barrick Gold CEO Mark Bristow, good to see you. Good luck this quarter. We'll talk to you soon. All right, it's a wrap for earnings out of the major hotel chains. Is it time to buy these stocks ahead of the summer travel season? We'll dive into the space next.
we've got a story out of Bloomberg talking about Ford potentially considering ways to maybe spin off its electric vehicle operation. Now, according to their reporting, and they're citing people familiar with the situation who are not named, the CEO, Jim Farley, wants to, quote, wall off Ford's electric operations from the traditional car business, and has even considered spinning off one or spinning off the other. But it sounds like it's not imminent. Might not happen. It's just something that is sort of a topic of conversation there inside the automaker. Brian Sozzi, you've covered Ford pretty extensively here, and we've both talked a lot about their electric vehicle efforts, and they've emphasized them a lot. But I don't know how this works exactly if they did end up doing it.
It reminds me a little bit, Julie, of what we're seeing in the retail space where Macy's is getting pushed to sell off its e-commerce operations. Things like this are great on paper. They're great running through an Excel spreadsheet and you come up with a fancy valuation. But, in practicality, it's tough to see Ford slicing itself in half. It's Ford. They're making the same car, making cars. In many respects, are using common parts between electric vehicles and regular cars. So there's a lot of minutia here to even consider before this would even happen. Now, what would make sense, Julie, is internally you can hive off those EV operations, allocate resources specifically to the EVs, so there's no sharing per se between the two companies. But still, this is not something that's going to happen overnight.
Definitely not. Well, we're going to keep an eye on it, though, and of course continue reporting on Ford's general efforts on this front, on the electric vehicle front in general. Switching gears, we had a lot of the hoteliers reporting their earnings this week. And of course, they talked a lot about the effect of the Omicron variant. And for most of them, the fact that that is now waning. I guess the question is, what happens next? Michael Belisario is Baird equity research analyst. He covers these companies. So, Michael, I just wanted to start sort of generally, right, with these hotel companies and where they stand in terms of the COVID cycle. It does seem like that they are coming out of it to some extent, but they still have a long way to go.
Yeah, great. Thanks for having me today. I think the short story is everything is getting better. The U.S. has recovered the quickest, and every time we've seen a step back with Delta and now Omicron, the impact has been a little bit less, and the recovery thereafter in terms of the pent-up demand coming back, rates coming back, has been quicker. So they're on a pretty good trajectory. RevPAR, which is revenue per available room, the industry kind of top-line metric that everyone looks at, continues to improve. It's still negative versus 2019 levels, but the trend is your friend here, and things are getting better.
Michael, are you surprised, just given where occupancy levels are? And for a lot of the major hotels, there's under 60%, depending on the chain. Are you surprised that a lot of these big players continue to move aggressively to open up new rooms around the world?
No, not surprised. Developers that are putting shovels in the ground, they're looking out 5 years, 10 years. These are real estate investors that are making long-term bets. And actually, some people are trying to lean in today. It's difficult. Costs are going up, interest rates are going up, projects are taking longer to get done. But a lot of people want to put a shovel in the ground today because they want to open the hotel in 3 years or 4 years when no one else is opening a hotel. So not surprised on that end. And I think the brands are going to continue to grow. And as they look around the world, the white space is internationally. They're growing in the US, but it's really ex-US.
I want to ask about the competitive landscape between the hotels as a class and things like Airbnb, because we have seen this shift in stays at the likes of an Airbnb where people are staying longer. What does that sort of do to the hotel room share dynamic, if you will? If people are staying longer in Airbnbs, does that actually give hotels an opportunity to grab back some of the short-term stays?
Yeah, I think right now the leisure demand pie is big enough for everyone to play in the same sandbox. Airbnb, that was probably the number one risk that investors asked us about 2014, 2015, 2016. That doesn't really come up that much anymore. I think what you're seeing is the weekend is probably now Thursday, Friday, Saturday, Sunday into Monday, and the business travel week is shorter today versus what it was 2+ years ago. But I think the answer is people are staying in different markets on different days of the week for different reasons. and both Airbnb, VRBO, and the hotel brands are getting their fair share of a much bigger leisure demand pie today.
If we're having this conversation, let's say in August, Michael, how do you think the hotel chains will have done during that peak travel season?
Wow. I mean, I think that's the simple answer. Everyone continues to be surprised at how quickly demand continues to bounce back every time we have one of these short-term pullbacks here because of a different variant. And then the other thing that has surprised everyone in the industry is the rates, the high level of rates that people are willing to pay. And that has also helped bottom line profitability for the brands and also owners. So I think the short answer is the next 3 to 6 months, the outlook and the trajectory of the recovery, it looks pretty strong.
I mean, people are paying rates because they can't wait to get the hell out of the house, I guess, is part of the situation. I wanted to ask about your ratings amongst the different ones. It looks like, judging from where you have outperforms, that Hilton and Windham are your preferences. What is it that makes them in a stronger competitive position?
Yes, Wyndham's our top pick. It's been our top pick for a while. It's a relatively new name. It became a standalone public company in 2018, and there's been a lot of noise since then. They did a huge acquisition of La Quinta around the time of the spinoff, and then the pandemic happened. So it's a little bit of a self-help story. We don't think there's enough eyeballs on it in terms of people looking at it, understanding how good of a business it is. And there's still a bit of a re-rating story there. And then also the lower end chain scales, their US focus, those segments, those markets have been performing and recovering the best. And then Hilton, it's sort of a same story. It's an easy to sleep at night business. They're growing net units, or at least they think they're going to grow this year, 5%. RevPAR is recovering, and they're in the chain scales and in the markets that are performing better.
Well, happy traveling to you, Michael, and thanks for your perspective on all of this. Michael Belisario is an equity research analyst at Baird. Thanks. All right, we're going to take a break. When we come back, another check on the markets here. We were up, and now we are lower. We're going to give you the details on what is moving. When doves cry, it looks like that's what's hitting the markets at this point. We are seeing stocks turn lower here. Charles Evans, Federal Reserve Bank of Chicago president, speaking today at a conference in New York. And he says the current stance of monetary policy is wrong-footed. He says it needs substantial adjustment, but he's also calling inflation expectations inflation as well anchored, So it's a little bit confusing here. He believes that underlying long-term inflation will remain low, held down by structural factors. So he would hold off on moving policy and being more aggressive. It feels to me, Brian Sozzi, like the market wants the Fed to move by those 50 basis points, or at least, we've heard a number of people come on and say the Fed is behind the ball. So if, I don't know that the doves are going to win out on the FOMC, but maybe just reminding the market that there are doves on the FOMC.
Yeah. Hey, it's a great time to be Yahoo Finance's senior Fed correspondent, Brian Chung, because this is just a fascinating time in Fed policy ahead of really a massive unwind in the Fed's balance sheet, raising interest rates. You had Jim Bullard, again, I believe it was yesterday, Julie, out in an interview saying that inflation, and this was his words, could get out of control. Who would have thought we'd be hearing this type of commentary from Fed members a year ago, 2 years ago, or a couple of years ago? It's new territory, and it's new territory for the markets.
Yeah, speaking of new territory for the markets, I wanted to look at our trending tickers today because the carnage is pretty dramatic when you look at some of the stocks being sold off in today's session. We've been talking all about them, but I wanted to highlight them once again because the drops are so severe. We've got Roku shares that are falling by 27%. Draftkings is down after earnings. The Archiverse continues to be in focus, that ARK ETF that holds so many of these names, including Roku and Draftkings. We talked earlier about Deere. That company, even though it looked like it beat estimates, is trading lower. And Redfin as well, absolutely plummeting today after the company forecast a loss that maybe is worse than estimated. That one's a little bit confusing there as well.
Julie, any big weekend plans?
I am going to upstate New York this weekend, and hopefully we'll be able to relax a little bit. Do you have any plans, Brian Sozzi?
No, I was just trying to map them out in my head. Well, I'm going to get an egg roll tonight. I'm very excited about that. Maybe shop for some ties this weekend. I love me a good tie, and then I need more cover up. I ran out of cover up, so that's my weekend in a nutshell.
Big weekend for you, Brian Sozzi. Get some rest.
On the sales.
Step away from your phone and your email and your Slack for a little bit would be my counsel to you and everyone out there. Sure. Counsel that I'm sure you will not take.
That I don't listen to.
I got her offered anyway. That's just how we work. I say, please relax a little bit. You don't do it, but we still play our roles to a T.
Have a lovely
weekend. All right,
weekend.
that does it for us ahead of this relaxing 3-day weekend that I hope everyone out there will have. Akiko Fujita going to take you through the next 2 hours of trading. We'll be back here on Tuesday.
Welcome to Yahoo Finance Live, and happy Friday to all of you. I'm Akiko Fuchida. Let's take a look at all three major indices, how the markets are trading right now. The Dow continuing its declines after its worst day of the year. We're now seeing that down about 109 points. Tensions between Russia and Ukraine continuing to weigh on investors, with all three major indices now set for their 7th weekly loss this year. Oil markets also seeing a big pullback, with WTI crude now set for its worst or first weekly loss of this year. Crypto also sliding in this session. We're seeing Bitcoin now off of that $40,000 level, off more than 40% from those highs we saw back in November. FTX US President Brett Harrison is going to be joining us to walk us through the latest price moves. He'll also discuss the cryptocurrency exchange's ambitious plans for expansion. And retail comeback. We are looking at the return of outlet centers as Tanger Factory Outlet sees sales surpass pre-pandemic levels. CEO and President Stephen Yalof will be joining us later on this show. We are beginning this morning, though, with that market action. We're seeing all three majors in the red right now. The Dow continuing those declines after seeing the biggest drop so far this year. Let's bring in Yahoo Finance's Jared Blickery, who's tracking the market action for us this morning. Jared.
That's right. Unfortunately, all the major indices and the Russell 2000 set for losses on the week. Let's just take a look at the worst off today. That's the Nasdaq Composite. You can see was green ever so briefly on the open and subsequently, but not now. And here is a 5-day look. You can see it's down 1.5%. S&P 500 really not that much better. You can see it's off 1.33%. And the Dow finally off 1/3% today. That is down 1.5% over the last 5 days. And it looks like we're set for the 7 out of 9 of the weekly periods this year have been seeing losses in the major indices. Only 2 weeks were positive so far. So it just kind of gives you an idea of what we've been facing this year. Here's the Nasdaq 100 heat map, and mixed board, but you can see the mega caps not mixed at all of them in the red. Tesla down 3.33%, Nvidia off almost 5%, Facebook off 0.5%. And as we've been talking about today, Facebook not even in the top 10 largest market cap companies in the world. So kind of a milestone, passing to the wrong way there. Also tracking Chinese stocks, we're seeing a lot of weakness here. This after the government of China is going after ride sharing and food delivery services, saying that they have to make their pricing more competitive. And you can see, let's do a 5-day view of what's been going on this week. You can see Meituan down 16%, Didi also effective down 6%, although still maintaining some gains over the last 5 days, but really not looking any better in ARK land. And we can see 2 stocks in particular, Roku down 28%, a huge earnings story. That company is going to be investing in their capital in their future, but that's going to cost a lot of money. Look at this 2-year chart. This is just incredible to see the volatility here. Now underwater, over 18% going back over that time frame. And then Draftkings, that is another one. Let's see if we can find that. There we go. Draftkings down 20%, holding on to gains of a whopping 1.5% over the last 2 years. So really just seeing more carnage in these expensive growth names becoming less expensive.
It has been pretty brutal for ARK, to say the least. Jared, thanks so much for walking us through those moves. Well, the White House is now engaged in around-the-clock diplomacy with the president, or to prevent an invasion, a Russian invasion of Ukraine. The president this morning holding a call with leaders of Germany, France, as well as the UK, while Vice President Kamala Harris traveled to the Munich Security Conference to meet with the UN Secretary General. Let's bring in Charles Kupchan. He's Council on Foreign Relations Senior Fellow. He's also former Special Assistant to the President and Senior Director for European Affairs on the staff of the National Security Council under President Obama. Charles, it's good to talk to you today. Just give me a sense of the state of play. I think for our viewers who have been following this story, it's sort of been a will they or won't they invade. Where do things stand right now?
The good news is that the channels of communication are open. The U.S. is talking to its allies. The U.S. is talking to Russia. Ukrainians are in the mix. So the diplomacy continues. The bad news is that we see upwards of maybe 130 up to 150,000 Russian troops on the border with Ukraine. We don't know whether this is coercive diplomacy or preparation for a Russian invasion. But right now, we're in a very dangerous moment. Putin can't keep those forces on the border at high states of readiness forever. If he's going to move, it's probably in the next few weeks. So stay tuned.
Charles, let's talk about the best case scenario here, which would be, in fact, for diplomacy to take its course. Short of the U.S. and NATO allies essentially guaranteeing that Ukraine will not be a part of NATO, what can be, what kind of promises is Russia looking for right now in order to pull back on the military side?
Well, Putin has asked for a legal guarantee that Ukraine will never join NATO. That's not going to happen. The alliance stands by its principled commitment to the open door policy, basically saying that, listen, nobody should be able to bully and coerce their neighbors, including Russia. That having been said, I think we all know that Ukraine is not now under consideration for membership and is unlikely to be on the path to membership anytime soon. The Ukrainian president just a few days ago said, hey, maybe membership in NATO is a dream. And so there's wiggle room here. And one would hope that the diplomats could finesse this issue, allow NATO to stand by the open door policy, but everyone recognizes that it's not going to be implemented for Ukraine today, tomorrow, or any time in the foreseeable future. Couple other moving pieces. One is what's called the Minsk agreements, and that is a framework for granting a certain measure of autonomy to the separatist-controlled regions in eastern Ukraine in return for Russia getting out. And then there's also a broader discussion that's taking place about the European security architecture, and that encompasses nuclear arms control, conventional arms control, greater transparency. We'll have to see where these conversations go.
Charles, if we look at this from the market perspective, it does feel like there's growing fears that this could drag on for a bit longer than anticipated. You were in the Obama administration during the annexation of Crimea, and I wonder if there are lessons that can be learned from that to see how this could potentially play out and how Russia plans to play this.
Well, the stakes for the market are much bigger than they were in 2014. Because if Russia does go in a significant way, we're going to see very far-reaching sanctions against Russia. That will have the biggest impact upon Europe because of economic interdependence, because of Europe's reliance on Russian oil and gas. But there's no question that it will rattle the market globally, that it could lead to a spike in oil prices, that Europe could face not just high prices, but shortages. China is going to have to consider whether it might want to breach secondary sanctions when it comes to trade with Russia. So the economic stakes here could be very significant. That's why we need to watch so carefully Russia's next moves.
Charles, you highlighted some of the economic stakes there. What are the stakes for the U.S.? Natural gas, of course, a big issue for Europe with that direct pipeline. That's not necessarily the case in the U.S. So what are the implications for the U.S.?
Well, they're not as immediate and as grave as the implications for Europe. And the Biden administration, in my mind, correctly, has been working behind the scenes to backfill Europe's energy need. We're seeing more liquid natural gas get directed to the Europeans, just in case there is a reduce in the flow from Russia or even a cutoff. And we heard today, for the first time explicitly at the Munich Security Conference, Germany's foreign minister say, hey, you move, it's goodbye Nord Stream 2. But I do think that the biggest issue here is the geopolitical impact of a major war. And this could be the largest war in Europe since World War II, the impact of that on global equity markets. And so for me, that is the biggest risk of that faces the investors today.
Well, Charles, we appreciate your insights this morning. Charles Kupchan, Council on Foreign Relations Senior Fellow. Appreciate you joining us today. Well, as we said at the top of the show, certainly a lot of implications for the markets as we've seen a lot of choppiness this week trading along with those headlines out of Russia and Ukraine. All three major indices now headed for their 7th weekly loss this year so far. Let's bring in Michael Aroni, U.S. Spider Business at State Street Global Advisors Chief Investment Strategist. Michael, you've been listening to Charles there about the geopolitical implications as we see the markets get weighed down by what's happening in Eastern Europe. How are you playing your portfolio right now? Is this just kind of noise when the focus is still on the Fed and policy, or are there increasing concerns that this could continue to be an overhang?
Well, I think investors are desperately seeking clarity on two things. One, the situation in the Ukraine and the tensions between the US and Russia. And secondarily, what is the path to monetary policy tightening by the Federal Reserve? In terms of how we're positioning or playing the current tension, certainly volatility across stocks, bonds, and currencies has climbed this year. So we've gotten a little bit more conservative in terms of our asset allocation, reducing some of our equity exposure and getting a bit more defensive in terms of raising some cash and even investing in some gold. But I think it's a bit short-sighted to change too much in terms of your asset allocation in regard to the current situation in the Ukraine. Clarity is needed, but I think it'd be a mistake to make too many moves in terms of investments at this point.
Yeah, on the issue of clarity, it feels increasingly like investors kind of just want to get that first rate hike out of the way come March from the Fed, whether it is 25 basis points or 50 basis points. Essentially, to your point, they just want to know. I mean, is the expectation here that maybe some of that choppiness could potentially subside once we get through March?
I think it could. And in fact, I think post the first quarter, I do think that the economy will kind of resume expanding. It continues to. But I think that on the other side of the Omicron variant and some of the volatility that we're seeing, the economy, both businesses and in consumers, are in good financial shape. Earnings still are very strong. So we're just concluding the earnings period. We know that more than 70% of the companies beat those earnings. Earnings per share growth for S&P 500 companies is going to be about 27%, on revenue growth of close to 16%. Those are very solid numbers. And so I do think that on the other side of some of this uncertainty is at least a solid foundation for the bull market to continue. But I would suggest investors continue to allocate towards higher quality companies, healthy balance sheets, stable earnings, some dividends, and also value parts of the market, your energy, your financials, kind of your cyclical values. I think those are the greatest opportunities for investors through this period.
You mentioned setting aside some cash. When you look at your overall allocation, are you still overweight equities, or is there a sense that the traditional safe haven plays like a gold, it's kind of a good place to hide out right now, to ride out the volatility?
So I think there's the whole TINA acronym about there is no alternative, and that environment still exists. And Akiko, what I mean by that is the dynamics on the fixed income part of a portfolio remain skewed to the downside. So even though yields have drifted higher this year, they're still low relative to history. So getting income from fixed income is challenging. Now you have the threat of higher rates and inflation, and we know that puts downward pressure on those bond allocations. So a lot of the risks in traditional fixed income safe havens are skewed to the downside. So that does lead us to other ways in which to protect the portfolio, gold being one of them, which should benefit from heightened volatility and this greater uncertainty that we're chatting about, that sometimes benefits from an inflationary hedge. So it's a store of value while inflation remains elevated. And so I do think that those properties make gold kind of an interesting opportunity here. And of many of the investments that have performed reasonably well through this volatile period, gold is actually responding as we would expect as a result of higher inflation and greater uncertainty.
Michael, what about exposure outside of the U.S.? On the one hand, we've heard from guests that Europe is a good play given the cheaper valuations there. But of course, European companies and the economy as a whole much more impacted or much more exposed to what's playing out in Russia and Ukraine. Does that put you towards emerging markets instead?
Actually, it's interesting. In tactical portfolio where we have discretion on behalf of our clients, we've actually started to increase our weights to international developed, think your ETH allocations, and even emerging markets. So we know for a while now, those investment opportunities have been cheaper on a relative basis to the US. But what is shifting is the macro picture, some of the sentiment, and some of the price momentum. That's become more attractive. So what's interesting is I mentioned that S&P 500 companies are likely to grow their earnings year over year through this most recent period by about 27%. Well, companies in the international developed in Europe and in Japan primarily have grown them by 30%, so higher. Yet they trade at significant discounts relative to US stocks. So we think that dynamic is attractive. Similarly, what's interesting is the contrast in terms of investors are now concerned about a mid-cycle slowdown in the US as the Federal Reserve tightens monetary policy. Well, in many emerging markets, they already tightened policy and now they're moving through the other side. And so we think that there you could see a bit more of an economic expansion at a better, further pace because they've already experienced their mid-cycle slowdown. And so emerging markets are becoming a bit more interesting as well.
Michael Roney, U.S. Spider Business at State Street Global Advisors, Chief Investment Strategist there. Have a good weekend. Appreciate the time today. And we do want to note some news out of Washington. President Biden is expected to address the Russia-Ukraine tensions, what's playing out there at 4 p.m. Eastern today from the White House. This coming on the back of the very latest news that Russia is, in fact, planning to conduct additional military drills starting on Saturday. Also, a lot of people watching that timeline with the Olympics over in Beijing wrapping up, potentially giving Russia the green light to move forward. Of course, the president still engaged in diplomatic fronts on a number of fronts, but the president, again, expected to address the nation at 4 p.m. Eastern today. And we will have that live for you right here on Yahoo Finance. Well, coming up, it's not exactly a field day for Draftkings. We're going to explain why the stock is tumbling despite a narrower than expected quarterly loss in revenue beat. More trending tickers are coming your way after the break. Welcome back to Yahoo Finance Live. We are watching two trending tickers moving to the downside this morning. Inez, it is a brutal one for Draftkings as well as Roku in the session. Let's start with Draftkings, though, because we're seeing that stock move to the downside even after an earnings beat. What's playing out there?
Yeah, that's right. With the company beating on revenue, but its monthly players missing expectations, and also its 2022 adjusted Ebitda forecast disappointing the street with a wider loss than expected. And that is what is really putting a lot of pressure on this stock, because the company is spending more on marketing, it's spending more on launching in new markets. And the pressure is coming in this environment where investors really have very little tolerance for large losses. So you're watching Draftkings down about 19% right now. Another stock that is just tanking today is Roku. Its biggest decline on record, down 27% right now. Its outlook is putting pressure on the stock. There's numerous analysts that have done some price target slashing. Now, Roku is a platform and hardware company. They noted that supply pressures are impacting the electronic landscape and the TV industry in particular. Taking a look year to date, the stock is down 53%, trading at around $105 a share right now. Akiko?
And there's another one we're watching today, Virgin Galactic. This coming on the back of news that Chamath Palihapitiya is stepping down as chairman. What's the story there?
Yeah, that's right. He's stepping down as chairman with him and the company saying that he will be focusing on different corporate commitments that he has. Now, keep in mind that he was the first chairman of the board when the company went public via his SPAC back in 2019. And he sold his personal stake in Virgin Galactic in early 2021, but he still indirectly owns more than 15 million shares of the company through his venture capital firm. Now, this is a stock, Virgin Galactic, that was really a high flyer last year, reaching highs of $60 a share. And you saw the price movement with this stock. I'm pulling it up right now. It's down about 5% right now, but you saw the price movement that earlier this week, the company opening up reservations for 1,000 tickets to go to the edge of space at $450,000 a share. $450,000 per ticket. But nevertheless, quite a lot of air has been taken out of this stock. Right now, it's trading down 5% at around $8.50 per share. Year to date, down 36%. Akiko?
Yeah, and off about 5% in the session today. Yahoo Finance's Inez Ferre, thanks so much for bringing us those moves. Coming up, a pandemic record. The CEO of Tanger Factory Outlet Centers joins us next to discuss how foot traffic and occupancy is making a comeback. That's next. Well, luxury outlet retailer Tanger Outlets reporting a solid fourth quarter earnings. The company seeing traffic at their locations exceed 2019 levels, with the occupancy across the outlets of over 95%. Tanger Outlets operates 36 outlet centers across 20 U.S. states. Let's bring in Stephen Yalof. He's Tanger Factory Outlet Center CEO and president. We've also got our very own Brooke DePalma joining in on the conversation. Stephen, it's great to talk to you today. We saw the stock down today, although we're seeing a broader pullback in the session, and yet we're looking at the numbers in the quarter. It certainly feels like retail, at least across all your stores, are back in a big way, not just a rebound from the pandemic, but exceeding pre-pandemic levels.
Yeah, I think that's the exciting part of the story. I think being value every day, that's what the outlet format is. We've got a solid customer base. We're introducing our type of retail shopping to new shoppers every day, and our traffic numbers continue to build. But I think where it's evidenced most strongly is on the sales line. And we were thrilled to report this morning on our earnings call that our sales of $468 a square foot is the highest of all time across the Tanger Outlet portfolio.
And Stephen, on that note, speaking of being a value-oriented operation, you said that in the call that inflation actually values your channel and a discount channel overall. So can you break down to us what sort of impact inflation has had on both your tenants and on the foot traffic you're seeing at the outlets?
Well, first of all, I think the price points across all retail channels are very high right now. And I think retailers are experiencing great margins because they just don't need to discount at the rates that they've been discounting in holiday seasons past. And that's no different in the outlet channel. You know, in our channel, although we're on sale every day, those extra take 60 off, take 50 off on certain items didn't exist in the early selling season. Towards the end of the selling season, based on an inventory that was in the stores, retailers had a tendency to become more promotional. But we found that the discounts weren't as deep, yet the value is still there every day.
You know, no question, more and more consumers are seeking out deals, especially as they feel the pinch from higher prices overall. And yet we've seen a lot of that traffic move towards online shopping as well. And I wonder how you see that breaking down. Obviously, you're seeing a bounce back in foot traffic, but more and more people are opting to shop from home.
Well, I think the best way for us to work with online shopping is to participate in it. We're a fully omni-channel retailer. We have a very active membership base, both in our Tanger Club and our Tanger Insiders, that interact with our web and our Tanger app very regularly. It's a great opportunity for our retailers to get their product in front of our customers and essentially give them that chance to window shop. You know, through our virtual shopper program that we announced about a year ago, we also gave the customer an opportunity to shop exactly where they are. So if they wanted to shop from home, we facilitated those transactions. But I think the dynamic right now is that our web, our app, our communication, the story that we're telling the customer, getting to know them a lot better, and meeting them where they are is actually pushing our customers into our retail stores.
And Stephen, on that note, I want to talk a little bit about non-store revenue and the opportunities there. You know, in my local outlet, I saw Heineken giving out their new Heineken, then new Heineken Zero. I was shocked to see it, but it's actually part of a larger strategy at Heineken. You hosted activations from Tesla, Heineken, Unilever over 2021. So what exactly is the opportunity that you see there for non-store revenue?
Well, that's a brand new business for us. So that's something that we just stood up about a year and a half ago, and we continue to build on it every day. And in fact, we're investing in that business now. We're building systems to make sure that our inventory is more readily available. We're building better communication so we can get deeper and richer with regard to our offering. And those activations with national retailers, you know, they just don't do the one shopping center that's closest to you, multiply that by 36 centers in our portfolio. And that's a real opportunity for them to get into or get in front of the 150 million customers that visit our shopping centers on an annual basis.
Stephen Yellow, Tanger Factory Outlet Center CEO and President. Good to have you on the show today. And our thanks to Brooke De Palma as well for joining in on the conversation. Coming up after the break, concerns linger as Russian troops reportedly continue to build up their presence at Ukraine's border. Those developments as Vice President Kamala Harris embarks on a whirlwind series of talks over in Germany. That's coming up in our Worldview on the other side. We'll be right back. In our Worldview today, Russia is preparing for another round of military drills this weekend, with President Vladimir Putin personally overseeing the exercises. The Defense Ministry says the latest drills will include multiple launches of intercontinental ballistic missiles and cruise missiles. Naval exercises will also be conducted in the Northern and Black Sea, with Belarusian leader Alexander Lukashenko also overseeing those war games. The show of force comes even as the White House holds talks with Western leaders in a last-ditch effort to avoid a conflict between Russia and Ukraine. President Biden expected to hold a call with the leaders of France, Germany, and the UK this afternoon, while Vice President Kamala Harris traveled to the Munich Security Conference to meet with NATO Secretary General Jens Stoltenberg. Secretary of State Antony Blinken is set to meet with Russia's foreign minister next week under the condition that Russia not engage in military attacks against Ukraine. Over in Canada, Ottawa police have begun arresting protesters from the so-called Freedom Convoy in an attempt to end a 3-week blockade. Officers moved in on protest organizers late Thursday, arresting Tamara Lick and Chris Barber on charges of aiding and abetting mischief. At least 7 others have been arrested without force this morning, according to police. Demonstrators have brought much of downtown Ottawa to a standstill since they began protesting COVID-19 vaccine mandates last month, leading to a tense standoff with police. Ottawa's police chief resigned earlier this week over his department's handling of the incidents. And over in Greece, at least 11 passengers are missing after a fire broke out on board a ferry to Italy overnight near the island of Corfu. Video captured here by eyewitnesses shows smoke engulfing the Euro ferry Olympia as crews scrambled to rescue survivors. Roughly 240 passengers were on board with 51 crew members. At least 2 are waiting to be airlifted after being trapped inside the ship's garage, according to the Greek Coast Guard. The ferry was headed to the Italian port of Brindisi, about 9 hours away, when the flames broke out, and passengers have been evacuated to Corfu, where they are being treated for any injuries. Well, there is yet another twist in an ongoing saga involving Russian Olympic figure skater Kamila Valieva, who tested positive for a banned substance. Now, Valieva failed to medal in the women's event Thursday after slipping multiple times in the long program, leading to an emotional outburst after she finished. Now, the head of the International Olympic Committee is now speaking out, criticizing her coaches for publicly chiding her.
When I afterwards saw how she was received by her closest entourage with such a, what appeared to be a tremendous coldness, it was chilling to see this, rather than giving her comfort. Rather than to try to help her.
The IOC's Thomas Bach there speaking to reporters over in Beijing. Want to bring in Yahoo Finance's Dave Briggs for more on this story. And Dave, for those who didn't watch this last night, essentially Valieva came off the ice rink after she had completed what was really a disastrous performance for her. And her coaches could be heard saying, "Why did you let it go? Why did you stop fighting?" I mean, it was uncomfortable to watch.
It was an agonizing routine first, Akiko, to watch the best figure skater on the planet, and that she is. And that's why she was the gold medal favorite, fall multiple times. It felt like about a 30-minute performance, like she might just skate off the ice. You got to give her credit just for finishing that routine. But yeah, those words from her coach, "Why did you stop fighting?" are the words that you could see and that really do ring disturbing, like Thomas Bach said. But ultimately, it's hard to really understand Thomas Bach. This is the system on which he's built the Olympics. Should they even be in China, a human rights abuser? Should they even allow Russia to compete after a massive doping scandal in 2014 under the Russian Olympic Committee banner? And then to have a system that the rule makes sense. If you're under 16, you should be treated as a minor, and it's not necessarily your responsibility what goes into your body. Well, then someone needs to be held accountable. Most notably, that coach who did not comfort her athlete and the team doctor should have been suspended from the Olympics and from this next Olympics. And until Thomas Bach changes that system, it's hard to really care what he's saying there or to really buy how sympathetic he is for that young athlete who was just torn apart in tears in front of the entire planet on the biggest stage of her career.
Well, and also those other skaters who actually medaled, I mean, they didn't look so happy either, just given how emotional everything was. I mean, how far do you think this particular incident goes in tarnishing what is one of the signature events for the Winter Olympic Games?
Unfortunately, I think unless something bigger happens in these next 48 hours, this is going to be what we're stuck with, because there wasn't really an iconic performance in these Winter Games that we can all be inspired by. Someone that's going to come home and be an Olympic hero because Michaela Schifrin struggled and Shaun White, the GOAT in snowboarding, retired. None of the huge household name stars really had a gold medal winning, inspiring performance. So I think this is what we're going to be stuck with. And this is the IOC. One other story that fell way under the radar, a good friend of mine is a snowboarder who won a silver medal earlier in these games. They decided that in her second competition, suddenly her snowboard sponsor, Prada, wasn't actually an official Olympic sponsor and said she needs to cross out the sponsorship on the bottom of her snowboard. She had no choice but to cross it out with a Sharpie. She then got hurt because any friction you add to a board impacts the way a snowboarder lands. The IOC needs to stop pretending this is about the athletes or make some major structural changes to these games. Otherwise, those words from Thomas Bach just kind of ring hollow. Dan Wetzel, who writes for Yahoo Sports, called this, frankly, child abuse, what happened to Valieva, and it's hard to argue with what he said there, given the treatment from her coach and sponsor. That rule needs to be changed. If you're not going to be held accountable what goes into your body, someone has to be, and therefore someone has to be suspended from these Olympics and another Olympics. This is what Russia does. This is their playbook. We've seen it for decades now.
Yeah, and Dave, it was interesting to see how NBC treated this too. I mean, Tara Lipinski, who of course was calling this, she won the gold medal, saying, look, it's the adults who didn't protect her. She's just 15 years old, and she is the one that is now having to take on that emotional toll, but just really kind of a painful performance all around, and something that I think the IOC will continue to be asked about. Dave Briggs, thanks so much for bringing us that story. Coming up on the other side, we've got the president of crypto exchange FTX US joining us to discuss that Larry David Super Bowl ad that went viral. Also, Bitcoin sliding today. That's coming up on the other side. Welcome back to Yahoo Finance Live. Let's now turn to our crypto corner presented by Intuit TurboTax Live. We are seeing Bitcoin slumping today in the session, now below that $41,000 level. This comes as crypto exchanges like FTX dominated the Super Bowl ad space this year.
Edison, can I be honest with you? It stinks.
Nobody's gone to the moon, ever! Why not? It's far! It's too far! It's far!
の未来はポータブルミュージックです。
バカか！出て行け！バタリがいてもやるぞ！バタリ!
Like I was saying, it's FTX. It's a safe and easy way to get into crypto.
I don't think so. And I'm never wrong about this stuff. Never.
Let's bring in our guest, FTX US President Brett Harrison. Brett, I can't say I would have cast Larry David as the guy in a crypto ad. We'll get to that in just a bit, but let me just get your thoughts on the price moves right now. Obviously, we have seen it kind of move in tandem with the sell-off in the equity space too. You're coming off of a year where you saw huge volume growth in the space. How much of that momentum has kept up along with the choppiness we've seen on the equity side?
On the volume side, we've seen generally a slowdown, as you said, in tandem with the equity markets as a whole. A lot of tension right now with Russia and Ukraine, just general slowdowns in futures and equities across the board. And so we're seeing that in crypto as well. But as an exchange, we still see volumes relatively high, for example, compared to some earlier slowdowns after some of the big March increases last year, where we saw just general chilling of crypto markets. We're not seeing anything like that. So there's still retail interest in trading crypto right now.
There's been so much debate about what exactly or how exactly crypto is valued. And there was a period where we said it was, sort of tandem to gold. Now it feels like increasingly it's being traded like other risk assets, like these high growth tech names. I wonder how you view the recent moves and what that tells you about how Bitcoin specifically is being valued in the market.
During situations where there's general risk off across the board, now that assets like Bitcoin and Ether are such larger percentages of portfolios of large institutions, big portfolio managers, if people are selling, crypto is going to be affected by that too, no question. As for how you value something like Bitcoin, it's tricky. There's a lot of different ways to think about it. Is it the future value of all of the rewards given to validators? Is it some sort of store of value? Is it in its ability to be a low-cost payment transaction method? Do people think it has viability of a currency? There's a little bit of everything when people think about the value of Bitcoin. But yeah, during a situation like what we're seeing now in the markets, general sell-offs are going to affect Bitcoin pretty similarly to other assets.
Let's talk about that Super Bowl ad. You got a lot of buzz off of that on Sunday. Very cleverly scripted, I should say, with Larry David cast there. What was the thinking within the company in terms of placing that ad? Obviously, you shelled out millions of dollars, as did other companies, for a 30-second spot or however long that was. Not necessarily the impact, but what was the thinking in trying to get that prime spot during the Super Bowl and the audience you were trying to capture?
There are very few events for the United States where everyone's attention is on this singular moment, which is the advertising slots in the game of the Super Bowl. And for companies that want to emerge as known players in a relatively new industry where there is an enormous amount of skepticism and lack of clarity in a lot of sense as well, there's very few things that could be as beneficial as immediately get your name out there with an advertisement in the Super Bowl. And of course, that comes with its risks too. There are people who are generally expressing skepticism about crypto advertising and other kinds of advertising like mortgage advertising, et cetera, for the Super Bowl. But this is what we thought, that if we want to establish our brand dominance in the US, this is an important aspect of that plan.
And Brett, obviously, FTX not the only company we're showing this ad from Coinbase, which I found to be very effective, very simple, just had a QR code bouncing through. And we actually put the question to our viewers, because there were so many crypto ads during the Super Bowl. We asked the question, look, how many of you actually went out and bought crypto as a result of seeing those ads? And here's how the poll broke down. 87% said no, 12% said yes. What did you see? What kind of traction did you see on the back of your ad?
So naturally, we saw increased site traffic, huge increases in our social media following, and just general attraction to our social media channels, more downloads, more people using the app. But that poll is not surprising to me. The goal of an ad for something like cryptocurrency is not to make the world impulse buy, Dogecoin off the back of seeing Larry David to have a great funny script. The goal is to start to address the general skepticism in the market around crypto, but also to showcase our personality as a company, that we're people who get that this is something that's going to take a while for people to understand, for the technology to really infiltrate different areas of the financial sector and other areas like art, music, real estate, law, that we expect blockchain technology to have a role in. And this is just the beginning of that. This is not something where we want to encourage people to buy now and not learn for themselves. We want people to learn and be educated, understand the risks, and be a long-term believer in the technology if they come to understand it. And if they want to come to understand it, FTX and FTX US are great places to do it.
Yeah, I mean, I'd imagine a lot of people who are watching the Super Bowl heard about FTX for the first time, who weren't necessarily interested in crypto initially. I want to ask you about what's playing on the regulatory front. Your competitor, Binance, now under investigation from the SEC, specifically about the ties of its founder to trading firms that work with Binance. That's raised questions about FTX as well, and the fact that you've got a market maker who's also owned by founded by Sam Bankman-Fried. How do you think this space should be regulated? I mean, should there be regulation that cracks down on this? We had a guest earlier this week who said, if you go into any one of these exchanges, it's kind of like those old driver ed ads or videos that you saw where there are violations everywhere.
So let's say a couple of different things. So the first is on the regulatory front, crypto exchanges need to be regulated in similar ways to derivatives exchanges like the CME, stock exchanges like Nasdaq. There has to be proper federal market oversight for cryptocurrency exchanges. As some people may know, right now exchanges are regulated as if they are MoneyGram, like money transmitters. But that's not the appropriate place to ensure, for example, anti-market manipulation, anti-spoofing, making sure that everyone has fair access and no one has unfair, extra information about customers on the exchange, which is probably one of the main things that the SEC is looking for when thinking about trading firms in connection to finance. So that's what we are pushing heavily for, is for either the SEC, the CFTC, some combination of the two, to be able to work together to create comprehensive federal market oversight for cryptocurrency exchanges. On the trading side, one thing that FTX is very, very serious about is fair access for all participants. If you think about an exchange like Nasdaq, there are certain players that have preferential treatment because they shill out millions of dollars every year for servers in the data centers closest to the exchange, in these co-location facilities where it costs an enormous amount for the server real estate. For FTX, no one has special access, whether you are a person in your garage, writing a Python program for the first time, or you're a giant HFT connecting to the exchange. It's all in the cloud. Everyone has the same access and fair access, and no one market maker firm has extra information that an ordinary trader or consumer, doesn't have. And that's something that we take extremely seriously, but it's up to us to regulate ourselves in that front. We really would like to see comprehensive rules across the board for all exchanges to make sure everyone's playing by the same rules.
Yeah, and it does feel like we might get a little more clarity from the White House next week as well in relations to the President Biden's executive order on crypto. Brett, it's always good to have you on the show. Brett Harrison, FTX US president, joining us today. Coming up on the other side, Samsung reveals its latest trio of smartphones, but is it worth the hype? Tech editor Dan Halley is going to be joining us next to explain. Samsung is rolling out its latest trio of smartphones and their most recent push to compete against Apple's iPhone. Let's bring in Yahoo Finance's Dan Halley, who's taking a look at that. And we're talking about the Galaxy S22 line. How does it stack up?
That's right, Akiko. We're looking at the S22 line, as you said. These are Samsung's latest flagship devices. Now, like Apple, Samsung has gone ahead and released a number of phones at once. This is the S22 Plus. That's right, we all get exciting new names for phones every year as well. So let's go over some of the stats of these phones. There's the S22 and the S22 Plus. Those are the basic ones. They start at $799, $999, and then $1,200. And what you're going to look at with the S22 is a 6.1-inch screen. S22 Plus, which is the one that I have, is a 6.6-inch screen. Neither of them have a stylus built in. That's important. I'll get to that in a second, though. They both have 3 cameras, a wide-angle, ultra-wide, and telephoto. You can get 256 gigabytes of storage. And the big deal with these cameras is that they offer better low-light capabilities. Now, like the iPhone Pro, they have a 3x optical zoom. Now, that's important if you want to zoom in on things. You're looking at taking photos of friends, but don't want to get super creepy up close with them. They're a great pair of phones. I've been using the S22 Plus for the past several days as my, just daily driver. I love it. The battery life is fantastic. The interface is nice and smooth, a lot easier than prior Samsung interfaces since they've upgraded that last year. So it's definitely a great device if you're not an Apple fan. Now, let's move on to the S22 Ultra, though, and that's this big boy. This one has a 6.8-inch display. That's absolutely massive. You can see it's got these hardened edges up top, squared off. And then if I go here, this is where the stylus conversation comes from before. It has a built-in stylus. Now, Samsung used to have a phone called the Galaxy Note. This is essentially the Galaxy Note now, but they're just going to call it the Galaxy S22 Ultra. Like the other S22s, great low-light camera performance, long-lasting battery, but unlike the others, the S22 and S22 Plus, this has a 4-camera setup, and it has ultra-wide, wide-angle, that 3 times optical telephoto, and then a 10 times optical telephoto, which is just incredible. I mean, if you want to take really sharp photos of things that are at a distance, this phone is wonderful at it. The iPhone Pro only goes up to 3 times optical zoom, so this blows that out of the water. And then it does have those low light capabilities as well. I think for me, I do love that 10 times zoom, but this bad boy is just too beefy for my hands. It's just too large. Getting it in and out of my pocket is an issue. I just don't feel like this is the phone for me. Now, if you love giant phones, you want a stylus, and you want to be able to zoom and look at the moon, I guess, you can do that with this. As I said, $1,200. For me, though, it really is the Galaxy S22 Plus. I think this phone is fantastic. If you're not an iPhone user, then I suggest checking this out. If you don't love Samsung, though, there's still the Google Pixel 6 Pro.
Yeah, Dan, I'm with you. I think I have reached my max on the iPhone size, right? You got to be able to put it in your pocket, and just it has to be a little compact.
Too big. I think that's why I think the S22 Plus is really where to go. It fits very nicely in your hand.
Okay, and Dan's got the full review on our website at yahoofinance.com. Dan Halley, thanks so much for that. Coming up, WTI crude now set for its first weekly loss of 2022. An analyst is going to be joining us on the other side to explain why she thinks oil markets will remain vulnerable for now. We'll be right back. Welcome back to Yahoo Finance Live. We are continuing to see the Dow slide in the session on this Friday after suffering its worst day of the year. The Dow now off about 260 points. Tensions between Russia and Ukraine continuing to weigh on investors, with all three major indices set for their 7th weekly loss this year. Now, all this comes as oil markets are seeing a big pullback, with WTI crude now set for its first weekly loss of this year. Joining us to discuss is S&P Global Platts head of supply and production analytics. We've got Shin Kim joining us today. And Shin, it feels like we're following two narratives here in the oil market. On the one hand, it is about the disruption that could come from a Russian invasion of Ukraine. And then you've got a potential, and I stress the word potential, deal in reviving that Iran nuclear deal, which could bring additional supply online. Do they kind of offset each other?
They do. You know, if you think about the state of oil markets today, we're in a very vulnerable spot, right? Demand is growing very strong. We're still in recovery post-COVID, and we're growing very strong rates. Supply is being maxed out from Russia, from Saudi, on the non-OPEC side. Inventories are at the lowest level we've seen since prices were, comfortably well above the $100 level. Spare capacity in the world is uncomfortably low, and we have a lot of risks to supply, not just Russia and Iran, we'll get to that, but we also have a lot of risk from Libya. We have a risk in the UAE. We have ongoing disappointing performance out of places like Nigeria. So the world is in this, oil markets are in this very vulnerable place right now. And then on top of that, we have a potential, as you highlight, for tensions to accelerate further in Russia, Ukraine. And then on top of that, in the opposite direction, we have the potential for an Iran deal, which has not looked very good over the last several months, especially as we were looking into about midway through last year. But the positive news coming out more recently is suggesting that we are getting closer to a potential deal, and that really is taking markets. You know, we were on 96. Dated Brent was up at $100 earlier this week, and now we've ratcheted down quite significantly, given the potential for an Iran deal, and it's really causing prices to seesaw. And we probably will continue to see a lot of seesawing as long as these headline risks are hitting right at the vulnerabilities of oil markets at the minute.
And Shin, I'm looking through your notes here. You're estimating oil was pricing in roughly $20 a barrel, risk premium at their highs. You say that's too high. Where do you think it should be?
High. I mentioned the vulnerability of the oil market. We have strong demands, supply being maxed out, very thin spare capacity. The potential to lose one of the world's largest oil and gas suppliers is major, and it should not be overlooked. And the potential for a loss of 4+ million barrels a day of European oil, 40% of European gas comes from Russia, 500,000 goes of Russian oil hits the US. The potential loss of that is risky, and it has people needing to pay more to feel that they have to secure supplies in the future. A $20 premium, however, is a lot. Given our base case assumptions, we find it more likely. We believe S&P Global Platts Analytics, we believe that there will not be a significant disruption to Russian oil. Nord Stream 2 gas pipeline, that will probably be delayed further, but we don't expect a major disruption of oil exports. We don't think Western sanctions will specifically target Russian oil, and we don't think Russia will voluntarily curtail their exports simply because it's not in their long-term interests. They want to be seen as a secure supplier through the longer term. So given that a less than likely chance of any major disruption to oil exports and to oil supplies, a $20 premium that oil prices were pricing in seemed lofty. But it's not completely unjustifiable, given that there is that risk that we could lose a significant amount of barrels. Or for us, the largest risk is financial sanctions that could potentially make buyers of Russian oil hesitate to buy that oil. So that is a risk. But $20 seemed to be a lot. And then we saw prices pull back shortly after reaching their highs.
So with that said, I'm looking at where it's trading right now. WTI crude is at $90 a barrel. We've heard those calls for $100 a barrel as we continue to see the pressure build. Do you see it climbing to that level?
I think if we have to watch carefully how the tensions build and how the situation progresses in Russia, Ukraine build as we go forward. It's going to have major implications for oil markets, for gas markets, and for global everything markets if something does happen. The question is, what's the risk that something will happen, and how much could the disruption be if there is a disruption? So that is watching the headlines and how the situation unfolds will be critical. But also we caution that you have to think about the other side as well. We mentioned Iran. Any kind of deal out of Iran, which is looking, as I say, more likely as we speak, will lessen that vulnerability, will lessen that tension and that feeling to secure more supplies if we get some kind of a deal with Iran. Remember, it's something like 1.5 million barrels a day of oil that's been off the market because of these sanctions, and that coming back, whether it's an interim deal, a full deal, after considering whatever the specifics of that deal and how sanctions waivers could be lifted over time, that will have a key bearish risk that could sort of take off that sense of insecurity of supply for oil markets.
Well, Shin Kim, S&P Global Platts Head of Supply and Production Analytics. It is good to get your insight on this Friday. I really appreciate you stopping by. Well, we have continued to see the price of fruits and vegetables push higher, with overall food prices increasing 7% year on year in January. Our very own Inez Ferre has been looking at what's behind some of those price spikes. Inez, I was just at the grocery store yesterday. I was thinking about this, looking at those prices, saying, well, is it really worth buying this now that it's $1.50 more, $2 more? What did you find in speaking to some farmers?
Well, I spoke to one food importer who told me the main reason why you're seeing inflation in the fresh produce section of the grocery store is because of transportation costs, specifically the cost of diesel and also the driver shortage in the U.S., that truck driver shortage. He said that this is what's driving up prices. And he gave me the example. He said, look, I usually at this time of year will pay about $6,200 for an entire truckload of food to be transported from the southern Texas border, from McAllen, Texas, all the way to the Northeast. Right now, he's paying anywhere between $9,100 and $9,300 for that same freight cost. And what he's saying is that his customers, who are retailers, who are wholesalers, they are buying just enough because they don't want to get stuck with the losses. Remember that these are perishable goods. They only last for a finite amount of time on the shelves. So anything that they don't sell goes into the dumpster. So they're only buying enough that they know that they will be able to sell. Otherwise, they're stuck with a loss.
And Inez, we've heard from a lot of restaurants as well as food companies who've talked about their ability to raise prices. Chipotle, one example, they reported last week saying essentially they didn't see necessarily customers back off. They still came to buy the burritos even with that price spike. What did you hear from that importer specifically about consumers' ability to pay higher prices?
Yeah, look, he's a veteran of this industry. He's been in it for more than 30 years. And he says that him and other veterans feel this way. Yes, the consumer will eventually pay those higher prices. But he says that what this does overall in the industry, sustained higher prices, is that it slows movement and it slows volumes. So eventually, if the price gets to be too high, less of it is bought, or they trade down. And in the case of restaurants, they may take the higher prices off the menu. They may shrink the portions. And he gave this example. For example, if tomato prices become too high, then that salad will come with no tomatoes.
Yeah, a lot of adjustments, a lot of discussions that are happening behind the scenes on that front. And Inez Ferre, thanks so much for bringing us that story. Let's take a look at Facebook. Parent company Meta now seeing its worst monthly stock decline ever. Hitting a new low today in the session, by the way, at $207 a share. This comes as a social media giant is facing new scrutiny from whistleblower Frances Haugen. The Washington Post reports lawyers for Haugen have filed a complaint with the SEC alleging Facebook knowingly misrepresented plans to investors about how it would combat disinformation regarding COVID as well as climate change. Yahoo Finance has reached out to Meta for comments. We have not heard back just yet. Well, coming up, a conversation with Maryland Senator Ben Cardin. He's going to be joining us on the other side to discuss the latest on the Russia-Ukraine border crisis and why he says it matters for Americans. That's on the other side. Well, we are continuing to follow the latest developments from the Russia-Ukraine border. Several reports of increased shelling there, with pro-Russian rebels ordering the evacuation of civilians. Amid those heightened tensions, President Biden is expected to speak this afternoon at 4 p.m. Eastern after he holds a call with NATO allies. And of course, we're going to bring that to you live right here on Yahoo Finance. Let's bring in Senator Ben Cardin of Maryland, who's also on the Senate Foreign Relations Committee. Senator, it's good to talk to you today. I think a lot of people trying to make sense of the headlines that we've gotten this week. You know, is diplomacy going to take its course? Is a Russian invasion of Ukraine inevitable? Talk to me about what you're hearing and what your biggest concerns are.
Well, first, it's good to be with you. Look, the circumstances are extremely dangerous right now. When you take a look at what Mr. Putin has done, the provocative actions he just recently took in eastern Ukraine, the number of troops that he has on the border fully prepared to do a full incursion into Ukraine, and his past history, what he did in Georgia, what he's done, this is part of his playbook, to use misinformation and to use everything he possibly can to bring down a country, and he wants to bring down an independent Ukraine. So it's a very, very dangerous situation. What will come next? Only Mr. Putin knows. We certainly will not give up on diplomacy if Mr. Putin wants a diplomatic answer. But to now, every indication is that he is determined to use force to bring down the Ukrainian government.
You and your colleagues in the Senate have called for sanctions or increased sanctions against Russia. And I realize Republican senators have put forward their own sanctions as well. To what extent can these sanctions really have teeth in curtailing Vladimir Putin from scaling back some of those ambitions you just highlighted?
Well, to be clear, Democrats, Republicans, House, Senate are fully behind President Biden and our European allies to make it clear that Mr. Putin will pay a very, very, very heavy price if he does further incursions into Ukraine. There's no dispute about that. We are fully behind the president in that regard. There's many of us who think that Mr. Putin already deserves to have additional sanctions imposed, but that would also, we think, give the president some additional leverage in his conversations with Mr. Putin. But that's more of a strategy issue rather than our resolve that do everything we can to prevent the incursion. If it happens, the president will have our full support to impose the most serious sanctions, both on sectorial economy as well as individuals.
We had your colleague, Senator Jon Tester, on earlier this week who said, look, I'm all for sanctions, but we also need to be mindful of the economic impact this could have on our allies over in Europe, specifically on energy. How do you view that, especially if we're talking about something like Nord Stream 2? I mean, number one, what power does the U.S. have in halting that? And how do you think about the consequences for a country like Germany if that is halted, especially given their reliance on natural gas coming in from Russia?
Well, Senator Tester is mentioning some important points, but our number one priority is the security of Europe. And if Mr. Putin can overtake a sovereign country by the use of force without consequences, that does not bode well for the future security of Europe or other parts of the world by the use of force to try to change borders. That will have a much more devastating impact on future economies as well as the safety of Europe. So that has to be our primary concern. These sanctions on the energy sector particularly, we need to long-term have a more secure Europe on energy sources. We know that. But in the short term, we have to make sure that energy is not used as a weapon, as Mr. Putin is trying to do. That only will lead to bad results. So for all these reasons, we have to stay resolved and resolute in our force to say that we will impose the heaviest possible sanctions if there are further incursions into Russia.
Let's talk about more domestic issues. You have been for some time here calling for additional funds here to combat COVID-19. I know there was a request in from the Health and Human Services Department that called for $30 billion in additional funds, given how much was spent on this most recent wave for Omicron. Where do those discussions stand right now, and how are you thinking about that? Number one, in terms of additional budgets that are needed on the healthcare side to fight the virus, and then the amount of money that could potentially go to small businesses that are still hurting in a big way?
Well, we have some unfunded programs now that need to be completely funded, and that is the Restaurant Revitalization Fund. We made certain commitments. The money, it was not adequate. We need to replenish those funds. That should be done as soon as possible. I hope we can get it done in early March. In regards to additional COVID needs, there's clearly a need in our health resources to make sure that we can stay ahead of the next variant, and there's likely to be another variant. So we have to have the funds necessary to do all of the preparation, including vaccination preparations, the therapeutic drugs, protective equipment, testing. All that will require additional resources, and as they're needed, we have to make those resources available. And then we hope we're at near the end of the tunnel in regards to this COVID, on the impact it has on our economy. But if it continues, then we have to be prepared again to step forward as we did in the past to make sure that our economy can continue even during a pandemic.
You talk about the challenges in the economy. Certainly a lot of Americans feeling the pinch from price pressures and inflation now hitting a 40-year high. That has certainly hurt this administration, at least in the eye of the public. And I wonder where you stand, especially on a potential holiday on the federal gas tax. That's something that has been raised by other Democratic lawmakers. The cynical take would be, to what extent that can really bring down prices and how much of this is motivated politically. Where do you stand on that? And should there be a bit of a reprieve given how far up gas taxes have run?
Well, I understand that we have to deal with the short-term pressures that American families are sustaining. So I recognize that. But to deal with the causes for inflation, We really do need to deal with the labor force to have more people able to work. And that means in the Build Back Better agenda, affordable childcare is critically important. We got to protect our supply chains as one of the principal reasons why we're seeing a shortage of goods and therefore an increase in price. And that means pass the legislation that is passed by both the House and Senate that needs to be reconciled that would make America more products produced here in our own country. They're the two things I think we can do the most to protect against the impact of higher costs. But we recognize that American families are hurting. That's why we want to deal with more affordable housing, more affordable educational costs. We want to deal with the cost centers that are affecting American families.
Specifically on the federal gas tax, though, would you support a suspension?
Well, it depends. We have to make sure that there's adequate resources to carry out our infrastructure and our transportation programs. It's not just as simple as a holiday. It's a question of how we're going to adequately fund the needs that are critically important. You know, the transit needs, the road needs, the broadband, all these are important services that the American people need, and we have to make sure we can continue to carry out those programs.
Well, Senator Ben Cardin, we always enjoy having you on the show. Hope to have you back on again soon. Maryland Senator Ben Cardin there joining us today from Baltimore. Coming up, existing home sales unexpectedly jump in January as inventory hits a record low. Our next guest explains where buyers are headed next. That's on the other side of the break. We'll be right back. Well, existing home sales in the U.S. saw an unexpected jump in January. That number climbed 6.7% last month, despite record low supply. The strong demand coupled with limited supply pushed the median price of a home to $350,000. Let's bring in Indranil Karlekar, Principal Real Estate Global Head of Research and Strategy. You know, Indranil, it feels like every time we think there's some kind of reprieve, those prices keep pushing higher because of the record low inventory that's there. What are you seeing in the data right now?
Yes, good morning. It's really a combination of a couple of things. Clearly, inventory shortage is driving some of the demand for home prices, home value increases. But also, I think you got to factor in the fact that a lot of buyers are looking at the interest rate outlet, looking at what the Fed's articulating and saying, look, I better get into the home market now before rates move significantly higher. So I think you're seeing the intersection of a shortage of homes across the United States, and combine that with the potential for high interest rates that's really driving these strong volumes. So I think you got to look at both together to look into a little bit what's into the explanation for why we saw this jump up in the last month.
Yeah, to what extent do you think that the fear of those rising rates are pushing homeowners to buy? And if you look several months down the line, are we going to start to see some of that supply issue improve, even if those rates are higher?
Yeah, I think it's almost like, nobody wants to miss the dance, right? Everybody wants to make sure they get in the last tango before the housing market starts, before rates go up. At least it feels that way, certainly at the retail level. And if you look at if you're a home buyer looking to, especially a first-time home buyer who already are probably priced out of many of the gateway markets in the U.S., but are looking to get their foot in the door in some other markets, they're looking at what the Fed's signaling and saying, look, rates are not going to be where they've been historically. We've also been super spoiled by where rates have been over the last decade. Let's face it, right? I mean, 2 or 3% interest rates for mortgages is pretty unheard of. And so they're trying to get in before the Fed really starts to crank the handle. And so I think a lot of folks are being driven by that desperation almost to get their foot in the door. To your point, yes, I think if the mortgage rates do start climbing pretty significantly, I think you're going to find a little bit of a cooling occurring over the next year or so, particularly in some of these very hot gateway markets. And supply hopefully will start to pick up a little bit. But honestly, I don't think it's going to be a sudden. I don't think it's like a balloon collapsing. It's going to be a slow exhale, if you want to call it that.
Yeah, let's talk a bit more about those gateway markets. I mean, you've pointed out the fact that they are among the most prominent losers. And we're talking about the cities that have historically been much higher, places like New York, LA, San Francisco. What are you seeing in those markets? And on the other side, what do you see in some of these medium-sized cities where we've heard more and more people are moving to because they've essentially been priced out of the bigger markets?
Yeah, it's interesting. You certainly see a huge movement away from the traditional gateway markets, as you said. If you look at just the last decade in the U.S., the migration out of some of these coastal markets into some of these median markets, as you mentioned, has been quite breathtaking. Just to give you some interesting stats, just over the last decade, Florida has grown by about 15%. This is migration population. Georgia by 11%, the Carolinas by 10%, Texas by 15%. On the flip side, you've seen net migration out of some of the some Midwestern markets. Illinois has been hit pretty badly. California, New York hasn't seen the same kind of exodus, but they haven't seen the same kind of growth that some of these Sunbelt markets have seen. What we've seen, interestingly, is the coastal markets get progressively more expensive, making home ownership increasingly more affordable. What we're seeing are a couple of things. People are leaving, voting with their feet. They're saying it's become too unaffordable. We got to find markets where we can live with a better quality of living. So they're moving out of some of these gateway markets. But increasingly, what's also happening is that we're finding folks are looking who want to stay in some of these markets but are getting priced out, are looking at other alternatives. So they're looking at single-family rentals, for example, instead of home ownership. They're looking at manufactured homes as a way to stay in these markets without giving up the home ownership dream. So we're seeing some creative things that are occurring at the margins. But to your point, the biggest transformation in terms of population growth is clearly occurring in these median markets, these Sunbelt markets, not in the gateway markets. But at the same time, we continue to see pretty robust home price values even in the gateway markets. If you look at the Case-Shiller Index, yes, absolutely, the Sunbelt markets have demonstrated huge year-over-year growth. I mean, for example, Tampa was up 30% year-over-year. Miami was up 25% year-over-year in growth in sales price. But even in some of the highly priced gateway markets, California, LA was up 19%, San Francisco was up about 18%. So there's still that strength in these markets, which is just being, again, driven by the huge shortage of inventory.
How much of the price increases we've seen you think have been driven by developers increasingly getting in? You know, we're talking about just how choppy things are on the equity side. Maybe the hope is here that you get a bigger return if you get into property. We've heard some big deals from places, you know, companies like Blackstone. How much of that do you think is contributing to the price increase that we're seeing, especially in those markets that you just mentioned?
Interesting. We've seen, obviously, you know, the single family rental market, which I think what you're referring to, a lot of institutional capital has poured into this over the last 2 or 3 years. It's become a very, very attractive place for institutional capital. Interestingly enough, we are seeing not a massive shift in prices in these markets where the institutional capital is at play. If you look at the overall deal volume for single family rentals, for example, or single family homes, more appropriately in the US, institutional capital is still only 1 to 2% of the overall market. So in terms of being a meaningful driver of value, we haven't yet seen that. So you obviously we see a lot of headlines where, you know, you see first-time home buyers being priced out because of a lot of institutional capital coming. That is happening, but it's very rare and usually happens in a few isolated segments. What we are still seeing is institutional capital is certainly coming to the sector in a big way, but it hasn't yet meaningfully shifted the price relationship yet.
Indranil Karlekar, Principal Real Estate Global Head of Research and Strategy. Good to have you on today. Appreciate the time. Well, coming up, restaurant owners calling on Congress for more aid during the Omicron wave. Our next guest explains why many businesses are close to financial ruin. That's straight ahead.
You can feel the spirit of Isla in every bar and restaurant near you, in every owner or bartender striving to keep the lights on and the regulars happy. Today, the businesses you love still need your help. Please join The Botanist and the Independent Restaurant Coalition and share in the spirit of community.
That commercial you just saw there, just the second year in a row that the Independent Restaurant Coalition revealed an ad during the Super Bowl urging continued support for small businesses. This comes as restaurant owners are calling on Congress for more aid amid the Omicron wave. Let's bring in David Nafeld. He's a Chafico Group co-owner of an Independent Restaurant Coalition board member. David, just talk to me about what you're seeing right now in the industry. I know you're based in San Francisco. It's one of those markets that have really been slower to recover, largely because so many people haven't returned now that they were working remotely as well. But where are restaurant owners in the recovery process where you are?
Well, first of all, thank you so much for having me. I mean, to put it, shortly, we are in a really bad way right now. We're, as a industry, especially independent restaurant owners, we are at a place right now where a lot of us are finally getting our numbers from the first period of this fiscal year, which included New Year's Eve from 2021, and showing that many of us had to cancel all of our reservations for New Year's, which is supposed to be the highest grossing night of the year. Showing that a lot of us had to shut our restaurants down during the Omicron surge, had to let go of people. A lot of us had to carry staff and pay out sick pay for an entire staff during closures, lose inventory, all sorts of stuff. So now that we're getting our P&Ls and our financials for last period, at least personally, we're seeing that we had hundreds of thousands of dollars in losses. And that's even, we're not even halfway through Q1 yet, right? And so when we look at where, the restaurant industry is, especially with independent restaurants who tend to focus more on indoor dining and things like that, we're very challenged right now. And the only thing that's really going to help subside some of this pressure is if Congress and the administration does right on their promise to refill the Restaurant Revitalization Fund.
How many restaurants do you think are at risk of permanent closure if that fund is not renewed?
Well, so we did a survey at the Independent Restaurant Coalition of folks that did not get the initial Restaurant Revitalization Fund, and we showed over 42% of them are saying that they are on the verge of bankruptcy if they don't get it within the next month to 2 months, right? So that's a stark number. When you look at the people that got it, that got the Restaurant Revitalization Fund, those folks are completely able to weather the storm in a completely different way. And some of those ways are, they're not going to close, obviously. They're able to stay up to date on the rent. When they are closing, they're able to keep people aboard so they don't have to let people go and then try and rehire, which anyone who runs a business knows that kind of start-stop energy is just a killer to momentum. And it really, really challenges a business, both from cash flow perspective, but also from being able to bring in revenue.
And I'd imagine this most recent Omicron wave certainly didn't help with restaurants who are just starting to get back on their feet. I am curious why you chose to put out an ad during the Super Bowl. Obviously, you've got a huge audience there, millions of people watching the game. How much of that was directed at diners and consumers saying, hey, we're still not okay, you need to support your small restaurants? How much of it was sort of, flagging the fact that you haven't seen a lot of movement, at least in Congress, in getting that additional aid?
Well, so one feeds into the other, right? At the Independent Restaurant Coalition, we are a grassroots effort, right? Every neighborhood in the entire country, regardless of political standing, regardless of what you believe, every city, every town has restaurants that they love, and they see their restaurants struggling, and they see their restaurants having a hard time hiring, having a hard time purchasing, raising prices, doing all of these things. And the fact of the matter is, we as a society are kind of prone to think that restaurants are doing okay the second that we see people walk inside. And the fact of the matter is, restaurants have been weathering the storm for the past just under 2 years. And that is mounting debt. That is, a significant amount of losses that we've struggled with. So just when you see, people coming into a restaurant, like we are unable, first of all, to capture all of the revenue that we need to capture because we're understaffed. A lot of us are making hard choices as to what to cut from menus because we can't afford, or we feel like the price elasticity has priced us out of certain things. One of my favorite bar and grills right here, in town, basically made the choice to stop serving chicken wings because they would have had to double the price on them because of how much they've gone up in the past 18 months. So these are the types of choices people are making. Eventually, what ends up happening is you end up looking at your balance sheet and saying, there's no point for me to continue this fight. I don't want to become bankrupt. And I also want to let people go in some fashion that is resembling, humane, right? Like offering some sort of severance. And the majority of small businesses aren't even able to do that when they close. So what we really need right now is we need folks to understand that we're in a bad way. Number one, start picking up your phone and calling Congress and letting them know that they need to keep up with their promise to refill the Restaurant Revitalization Fund, because Senator Schumer made it very clear that he knew that the initial amount was just a down payment.
It's a good reminder for all of us, David, to continue supporting restaurants and really to show that a lot of these restaurants are still not out of the woods yet. David Nafeld, Chafico Group co-owner and Independent Restaurant Coalition board member. Appreciate the time today. We want to get to some breaking news from the Federal Reserve, the central bank approving rules to ban officials from trading stocks, bonds, and cryptocurrencies. These regulations were first announced back in October after several officials, including now former Dallas Fed President Robert Kaplan and former Boston Fed President Eric Rosengren, traded individual stocks and funds as the central bank was taking action to address the COVID crisis. So the Fed now approving those rules to ban officials from trading stocks, bonds, and cryptocurrencies. We'll be right back. Welcome back to Yahoo Finance Live. We are continuing to see all three major indices firmly in the red on this Friday session, with the Nasdaq leading the losses here, down about 212 points. Let's bring in Yahoo Finance's Jared Blickery, who is here with a special guest. Jared.
That's right. We got Stephen Guilfoyle in the house, a.k.a. Sarge of Sarge 986 LLC. And let's get straight to the charts here. I'm going to put up a chart. Let's go back about 6 months in the SPY. We got some candlesticks here. I can put on some moving averages, but the trend has been down this year so far. I'm just wondering what you see in the market action.
All right. A lot of folks are seeing a head and shoulders here, a large 4-month head and shoulders with a peak at 480, and one shoulder peaking at 473 and the other shoulder peaking at 458. If that's the case, now some smarter people than me are seeing this. I don't really see it. That would mean that we have some serious downside to our front. What I'm seeing here is we're losing the 200-day simple moving average of 444, and we're coming dangerously close to a type of a swing trader's death cross, not a true death cross, when the 21-day EMA, exponential moving average, moves below the 200-day SMA, simple moving average. That's generally a short to medium term negative. So we're in a very negative spot here, which if somebody shoots somebody in Eastern Europe, that's what we're in store for. Conversely, we'll all be wrong about this negativity if things turn out well.
Yeah, and we can't ignore the Fed, of course. Markets have been pricing in ever more rate hikes this year, also have to deal with the prospect of quantitative tightening. We've been seeing a lot of those headlines, and I'm just wondering what you're seeing reflected in the Q, because this is a little bit more bearish to me than even the SPY chart that we were just looking at.
Yeah, the triple Qs are actually, they've lost contact with their 21-day EMA. Not the triple Qs, but the Nasdaq Composite Index actually is suffering a death cross as we speak. And the scary thing is nothing's technically oversold yet. So there is considerable negativity to the downside.
All right, and let's move on to a ticker that's moving big today on earnings, down 18%. That is Draftkings. I'm going to put a max chart on here since it's, well, I guess we call it its SPAC IPO here, but this has come full circle. You can see since the beginning, really not holding on to much of its early gains here, Sarge.
Yeah, I wrote an article on this piece today, and it really ticked me off because I couldn't find the balance sheet anywhere. I also do fundamental analysis, and when you make it hard for me to find the balance sheet, I'm not going to cut you a break. All right. And there's a downward sloping trend here, which you can fit into an Andrews pitchfork, if technical analyst knows what that is. It starts in September, runs through the present, and we're still stuck in the middle of it. So there's absolutely not much to get excited about here. A 38.2% Fibonacci retracement would take you all the way to 35.43. And so that's so far away, it's hard to even imagine. I could see this stock trading in the single digits. I would not buy it with my money. I would not buy it with your money. I would not buy it with your money if I hated your guts.
Not in a not in a house with a mouse. Something. I mean, Dr. Seuss would be proud of this moment here. We got a minute left. I want to hit Northrop Grumman and also Lockheed Martin because these defensive stocks are actually looking pretty strong and bucking the trend that we've seen this year with most issues. All right.
We'll start with Northrop Grumman. Is that what you have first?
You got it.
Okay. Northrop here, we're looking at a cup with handle pattern, all right, with a 409 pivot. If we get the pivot, we can spring load a 490 target price. I am long the stock. I'm adding it down to the 50-day SMA, which is 386, and I will decide I'm wrong and panic when it hits 368, which is below the 200-day SMA.
All right. And Lockheed Martin, we got less than a minute here.
Lockheed Martin is coming off a double bottom reversal. Our pivot has been sprung at 378. We have a 454 pivot on this one. I'm also long this one. I will add it down to 368, which is the 50-day SMA. And I will admit I'm wrong at 359, which is also a break of the 200-day SMA.
Perfect. Sarge, always great to have you here with us. Stephen Guilfoyle of Sarge 986 LLC. Back to you, Akiko.
All right. Thanks so much for that, Jared and Sarge. We'll be right back. Miami is getting a big lift in its ambitions to become the crypto capital of the U.S. Venture capital investments soared more than 2,000% last year, at least according to new analysis. Let's bring in Alexandra Semenova, who's been following this story for us. And Alexandra, it's important to note Miami did get a big lift, but it still lags behind major hubs like San Francisco and New York.
Yeah, that's right, Akiko. VCs focused on blockchain and crypto are flocking to Miami. The city has long tried to position itself as the crypto epicenter of the country. The mayor, Francis Suarez, is a big proponent of digital assets. He collects his own salary in Bitcoin. He has said before that he wants all Miami residents to have a digital wallet, and the city even has its own Miami coin. Now Miami can add to its list that it's the fastest growing region for blockchain-focused startups. According to a study by the firm Telstra Ventures, blockchain-focused venture capital deals based in Miami grew more than 2,000% in 2021 from the previous year. Now, to be clear, as you said, the major tech hubs like the San Francisco Bay Area, New York City, and even LA are still leading the way in blockchain investment. But Miami last year emerged out of nowhere to take fourth place, which is really quite telling of how quickly the city is building its reputation as the U.S. crypto capital. So as we've got many people wondering whether Miami can become the next Silicon Valley, for crypto fans, the idea may not seem too far-fetched. Akiko?
Yeah, and we've had Mayor Francis Suarez on many times on our show, really pushing that crypto angle. What is the incentive for these companies to invest in Miami versus some of these other traditional hubs? What did you find?
Well, there have been a number of factors that have paved the way for this to happen. First of all, the cost of living in Miami is much cheaper than some of the other tech hubs like San Francisco and New York. Miami benefits from Florida's lower income taxes and also generally has cheaper real estate. And another is the massive push from local leadership to encourage financial innovation. Mayor Suarez, being an outspoken proponent of crypto, has really opened the door for VCs who are interested in the sector. He has been working on partnering with Silicon Valley VCs to promote Miami as a destination to get crypto talent and also to get VCs to actually support the local scene in Miami. Akiko?
Yeah, Mayor Suarez, the biggest ambassador for his own city. Yahoo Finance's Alexandra Semenova, good to have you on. Appreciate you bringing us this story. That does it for me in these 2 hours here on Friday, Flying Solo. But let's take a look at the markets right before we let you go, because we have seen stocks now hit session lows. The Dow down about over 260 points. The Nasdaq, the biggest laggard on the day, down nearly 1.5%, and the S&P 500 down about 40. Geopolitical tensions continuing to weigh on investors' minds, and of course, we're going to hear from President Biden later this afternoon. Keep it right here on Yahoo Finance Live.
High alert. U.S. officials warn that a Russian attack on Ukraine is expected in the matter of days. It could involve tanks, fighter jets, missiles, and a cyber strike. We examine the implications for the global economy and your portfolio. First, it was Amazon, then Starbucks. Now, Apple employees are looking to unionize. What's behind the growing worker backlash, and what does it mean for the $3 trillion tech giant? And with the Super Bowl of football behind us, we look forward to the Super Bowl of NASCAR. NFL legend Emmitt Smith is here to talk about his efforts to increase diversity on the track. Hello, everyone, and welcome to Yahoo Finance Live. I'm Alexis Christoforous here with Karina Mitchell, and stocks are sharply lower, just adding to yesterday's steep losses as tensions between Russia and Ukraine ramp up. And we also have the VIX index, Karina, that so-called fear gauge spiking and closing in on 30 today amid all this uncertainty.
Yeah, absolutely. No surprise there. Tensions, as you say, between Ukraine and Russia rattling markets, despite news that Secretary of State Antony Blinken will meet with his Russian counterpart, Sergei Lavrov, next week in Europe. As you say, President Biden set to make remarks as the markets close for the long holiday weekend. That's about in 3 hours from now. And U.S. officials saying an attack could come in the next few days involving air, ground, and cyber attacks. Taking a look at the benchmarks, you see them there. They are at session lows right now, where a day after a steep sell-off where the Dow saw its worst day so far this year and the Nasdaq in correction territory. So taking a look now, the Dow is down by 308 points, the S&P lower by 47, the Nasdaq, the big loser there, down 1.6%. Sector-wise, there are no winners. Everything is in the red, but some of the biggest losers include consumer discretionary, tech, industrials, health, and communication services. Meanwhile, over to the housing market, where sales of previously owned homes saw a surge of 6.7% in January, month over month, as supply remains tight. Meanwhile, the supply of homes for sale fell to a record low, down 16.5% from a year ago. The median price of a home now, a whopping $350,000. That's up 15.4% year over year. Want to get you over to the bond market. Take a quick check there. Treasury yields dip, of course, as the focus remains on geopolitical tensions. The 10-year now at 1.93, the 30-year at 2.25. And just to give you an idea, the 2s and 10 spread now just about 50 basis points. To put that in context, a year ago, the spread was 1.6. So the curve is flattening. With more on what's moving markets, let's bring in our Yahoo Finance's Jared Blickery. Jared.
Yeah, not the way you want to end the week here. Let's just take a look at what the Dow is doing, because we've seen the markets just bleed lower all day. Not really spiking too much, but certainly losing some steam here. Let me put a 2-month chart. Actually, let's do a year-to-date chart as well. It was only yesterday that the Dow had its worst day of the year, and now it is set for the lowest close of the year. These wicks here, as they're called, are just intraday spikes, so not representing the settlement. And then you take a look at the Nasdaq. That's the worst fare today, off of more than 1.5%. A little bit farther down in, it could have its lowest settlement of the year as well. And these are just the indexes that we're tracking here. We'll go inside the market in just a minute, but we want to check out what's happening with the 5-year T-note yield. And let's make this a candlestick chart. We can see that it has the lowest level in about 2 weeks here. It's down to 1.8%. And we can also take a look at the 10-year T-note yield. That's down 5 basis points. So taking some pressure off of the yields here, but not really translating to anything positive for the markets. Also, you mentioned the VIX, Karina. Got to take a look at volatility. We can see that just trying to inch higher here. Not anything like we saw during that initial spike down in January, but still, we have a lot more to go here into the close. So we'll have to see how that evolves. Now, looking at the sector action, everything in the red right now. Outperformers, we have staples, financials, materials, and utilities. But as you can see in the red there, tech is the biggest loser. That's down 1.5%. Consumer discretionary follows. Those are the two big underperformers. Those represent the mega caps. And so it's been not the greatest week for them. Tesla down almost 4%, Nvidia down 5%. And it was a big earnings week for a lot of these companies, and earnings in general. You know, you add fuel to the fire. Those haven't been great for a lot of companies. You got the Federal Reserve calculation and now geopolitical tension. So put it all together, it's been rough going.
That it has, and plenty of red there on your chart. Jared Blickery, thanks so much. I want to stay with this market sell-off and bring in David Lefkowitz, Head of Equities Americas at UBS Global Wealth Management. David, welcome to the show. And just want to start with, this fluid situation between Russia and Ukraine. How is that guiding your decisions there with your clients when you take a look at their portfolios right now?
Yeah, thanks, Alexis. Look, it is a fluid situation as you've described. We still think though it's not likely we're going to see outright military conflict between the parties. So in our view, this is more of a tail risk. And obviously, there are things to do to protect in terms of the tail risk or a tail event that might lead to a more pronounced sell-off in markets. But in our base case, we think that there will be some non-military solution. There would be a lot to lose from a lot of parties if Russia does move down the path of military conflict. The sanctions that we've put in place, Europe potentially has a lot to lose also in terms of energy flows into its economy, into those countries. So the stakes are pretty high, and we think there's definitely scope for the parties to find some common ground outside of a military option.
Well, we certainly do hope so and don't want to think of worst case scenario. But if there is going to be military action here, how does that sort of change your outlook over the next weeks, months, and perhaps even the rest of the year when it comes to exposure to the U.S. equity market?
Yeah, it's a tricky question because it really depends on how much of an escalation we're talking about. Worst case scenario, if we're talking about a prolonged disruption of energy flows into Europe, that would obviously be very, very disruptive. If we're talking about a quick action, and usually these types of events tend to be fairly quick in terms of military action, you could see a sell-off, but then you could see a quick rebound right after that. So it's hard to know precisely how this will play out, obviously, but we still think that the most likely scenario is that we'll avoid that outright military confrontation.
When you look at how investors are sort of positioning themselves right now, I know that gold is pulling back today, but it's still on track for its best week in about 9 months. You also have an interesting reaction here in the oil markets. I'm looking at WTI crude. It's hanging at around $91 a barrel right now. Remember, just a few days ago, it was marching pretty steadily toward that $100 a barrel mark. What do you make of the commodities trade right now? And are you doing anything differently in that space?
Yeah, no, we haven't really made any changes. I think there's a couple of things going on with oil. Right? There's also some thoughts coming into the market that there could be an agreement between the U.S. and Iran. So that would lead to some additional barrels coming onto the market. That would be, it's going to take some time for those parties to reach an agreement, but that could be what's causing oil to come down a little bit. But we still don't think it really changes the longer term outlook for supply and demand. And we still are in an environment where demand has recovered pretty nicely. It's probably going to continue to recover as people get back on airplanes and things like that. And companies have really not been investing very much in terms of new supply. So we think it's still going to be a pretty tight oil market that should be supportive for oil prices. Now on gold, we think interest rates do rise further. Obviously, when there's uncertainty like we're seeing in the markets, it can be a safe haven. But again, in our base case, interest rates rising a bit more, real interest rates also rising, that tends to depress gold prices. So I think you need to make a distinction between different parts of the commodity complex when you're talking about whether it be energy or precious metals.
And I just want to bring your attention to the housing market for a minute and stocks that are related to housing. We see lumber prices certainly going through the roof right now, and that's part of that is because of supply chain issues. But the housing market's still very strong. We had home sales jumping 6.7% in January. Looks like buyers might want to get ahead of those higher mortgage rates that could be coming down the pike. Do you see strength and opportunity in those housing-related stocks further into the year as, the purchase of a home gets further out of reach for so many people?
Yeah, Alexis, I think we're expecting that the housing market will still remain fairly robust. And that's really, yes, mortgage rates are moving higher, but when you do the math, a percentage point increase in the mortgage rate doesn't materially change the calculus when it comes to buying a home. Obviously, it has some impact, but it's not dramatic. And I think it's also important to bear in mind that consumers are in really good shape from a balance sheet perspective. Debt levels are quite low relative to incomes, and certainly the cost of servicing that debt is quite low. Wages are rising, the job market is very strong. So we think there's still a lot of support for consumer spending broadly. And we know that people are still kind of adjusting to the pandemic in terms of the type of housing they want, not necessarily in cities, looking for bigger homes. Millennials are also starting to buy homes. So there's a lot of support for additional demand in housing. But mortgage rates will have a little bit of a cooling off effect, but we think it's manageable.
And finally, we're heading into a long holiday weekend here in the U.S. with all of this uncertainty, this geopolitical uncertainty. What would you tell average investors right now watching this, thinking, maybe I should hold on to cash, maybe I should be getting out of some positions? What are some costly errors or mistakes they should be avoiding on a day like today?
Yeah, it's a great point, Alexis. I mean, so one of the things that we're picking up is that extremely depressed investor sentiment. When we look at the surveys, you can see this. You can look at what's happening in the options market, put-call ratios, things like that. Investor sentiment is very cautious. When that has happened in the past, and we still see very good business activity, and we still are seeing that. Corporate profits for the S&P were up nearly 30% in the fourth quarter. We think we're still on track for double-digit gains in corporate profits this year. I mean, all the commentary we're seeing from companies is talking about very strong demand. So whenever there's a disconnect between investor sentiment, which is quite low right now, and business activity, those actually tend to be very good buying opportunities. So I would not overreact to the headlines. In fact, I would be thinking about using this opportunity as a way to start deploying some cash into the market.
All right, David Lefkowitz, head of Equities Americas, UBS Global Wealth Management. Enjoy your long holiday weekend. Thanks so much. And we want to help you step up your investment strategy starting today with a free 14-day trial of Yahoo Finance Plus. You'll get expert research reports, actionable investment ideas, advanced portfolio tools, and more in a sleek ad-light experience. It's all there for you at yahoofinance.com/plus. Karina, back over to you.
Okay, great discussion there. All right, coming up, we'll tell you about a big partnership in the world of NASCAR as the season looks to get into the gear. Hint, it involves some big names you'll recognize. Stick around. Welcome back. Well, NASCAR phenom Jesse Iwuji and Emmitt Smith, NFL Hall of Famer from NASCAR's team, are teaming up with Chevrolet for the NASCAR Xfinity Series starting in June of 2022. Starting in 2022, rather, Emmitt and Jesse join us now from Daytona along with Yahoo Finance's David Briggs. David.
Thanks so much. Appreciate that. Emmitt Smith and Jesse Iwuji, good to see you both joining us from Daytona. The Super Bowl of NASCAR is on Sunday, the Daytona 500. Very cool to see this partnership tackling diversity in the sport. Emmitt, let's start with you. What drove you to pick Jesse as your driver, your business partner, and why does this work so well?
First and foremost, let's get this corrected. I didn't pick him. He actually chose me. He actually invited me into his world. And so I'm honored that I got a chance to meet Jesse about 1.5 years ago at Texas Motor Speedway. One of the companies that I've worked with actually sponsored a car for him to ride in that particular race. And we just started a relationship that way. And then finally, we got to the point, he got to the point until Wuji Racing, and asked me to be a part of it. Here I am.
And Jesse, you grew up a Cowboys fan, wearing number 22, playing football, so it goes without saying what drove you to Emmitt. But what does this partnership mean to you, and how do you tackle diversity in your sport?
It definitely means a lot to me to, have the opportunity to partner with Emmitt, with everything he's been able to do, in the National Football League, being a Hall of Famer, one of the best running backs ever of all time to play, still right now leading in all-time rushing yards, and be able to partner with him with all his wisdom he has from the business world, everything he's done in the sports world, and really with his vision of wanting to really create that lasting legacy and an opportunity generating system. The only way we can do that is in a team in NASCAR. So we came together to make that happen. It's been absolutely incredible over the last, now, I don't know, a little less than 12 months really since the thought really came up. And putting this whole thing together has been definitely a task for sure. Just about a month and a half ago, we didn't even have a car yet. And now we have a full-on team. We have multiple race cars. We're here at Daytona International Speedway. We're getting ready to race in our number 34 Equity Prime Mortgage Chevrolet Camaro. It's just a lot of great things coming together, and this is just an absolute dream come true to make this happen. So we're looking to continue to use this team to motivate, inspire those out there who never thought they had an opportunity to achieve their goals and dreams. By them seeing this platform, being able to go through the programs we're going to create, it's going to give a lot of people opportunities. So I'm looking forward to diversifying NASCAR and continuing to, just create positivity in the sport.
And Emmitt, you join Michael Jordan as a team owner in NASCAR. What's the biggest obstacle to improving diversity in NASCAR? It's a sport that not long ago had Confederate flags waving just outside NASCAR tracks across the country.
Well, you still have some of those Confederate flags waving here. And so for me, I think the biggest challenge is getting owners or creating the opportunity for ownership so you can affect change that way and bring different coaches to a sport that generally did not have much diversity at all. And so now that you have an ownership team, you have a driver like Jesse doing what he's doing, you have Jordan, you have Pitbull coming into it, along with Floyd Mayweather and some of the other guys. So diversity is starting to happen because NASCAR created an opportunity for guys like myself and Jesse and others to own our own team and to come in and compete at this level. Now, it's not going to be easy, but we're up for the challenge, and Jesse's up for the challenge, and we're going to go out and put our best foot forward and go around the track and try to win that checkered flag.
Should be fun. And Emmitt, you were just at the Super Bowl, and now you go to the Super Bowl of NASCAR. And of course, the two sports both have enormous issues tackling the diversity issue, in particular, given the Brian Flores lawsuit, accusing the NFL of discriminatory hiring practices at the coaching level. Do you see discrimination, racism in the hiring process? And is it on the commissioner? We understand there's reports that he is working on a long-term extension to remain the commissioner. How big a problem is it? How do they solve it?
I think it's a huge problem, to be honest with you. That's one reason why you only see so many African-American head coaches. A lot of them have not had the success of some of the coaches like Tony Dungy and Mike Tomlin, are the two that I can think of off the top of my head that has had tremendous success at winning the Super Bowl. But when it comes down to other practices and so forth, You see a lot of African-American coaches on staff doing quality work as a defensive coordinator or linebacker coach or something of that nature, or running back coach. But when it comes down to them becoming head coaches, well, that's where the crickets come out. But not only that, but look at the ownership structure itself. You don't have many African-Americans owning teams. And so now you're starting to have a number of guys that have tremendous capital, like Robert Smith coming into the business trying to own, whether it's the Denver Broncos or some other team that comes available. I think at that level, you will start to see some diversity happen throughout the staff, throughout the organization. And that's why ownership is such an important thing. And so does the NFL have tremendous room for improvement? Yes, they do. How they get it done? I actually say start at the top because I've never seen someone that did not have money try to tell somebody who has money what to do with their money. So you have to actually start from the top. And so that's the way I look at it. And if you want to truly, truly affect change.
Both sports a very similar problem. One of your other business endeavors also followed Michael Jordan into the tequila business. I know you have a number 22 Herradura brand. We have Dale Jr. coming up in just a bit, who's also down at Daytona. Do you have any advice for him? He has his new vodka coming out. And how's the tequila going?
Tequila's going well. Herradura and I have been in partnership for 12 years now. And that relationship is still going strong. Looking to expand the brand and stuff and grow the brand and take more shelf space from others because of the quality of the tequila that we are producing. And I'm excited for the opportunity to continue the working relationship and also to get MS22 out there in the marketplace as well.
I'm a tequila man. Look forward to trying it. Look forward to watching Jesse on Saturday and throughout this NASCAR Xfinity season. Congratulations to both of you and best of luck improving diversity in that sport. Really appreciate you guys joining us.
While he's driving, I'm going to be sipping on some tequila. Thank you so much.
Cheers, guys. Good luck. Karina?
All right, cheers to you all. That was Emmitt Smith, NFL Hall of Famer, along with Jesse Iwuji, NASCAR driver, both in fine form there. And of course, NASCAR Infinity Series events kicking off this weekend. Okay, Alexis, over to you.
That was a lot of fun. What a treat. All right, coming up next, another treat, a conversation with Barrick Gold's CEO, Mark Bristow. Welcome back to Yahoo Finance Live. It appears the luster is back for the gold sector. Gold prices, while lower today, over the past month or so, have been breaking out as investors fret about the outlook for inflation. And that's sending shares of gold producers in particular higher. Yahoo Finance caught up with Barrick Gold's CEO Mark Bristow earlier today. Let's see what he had to say.
You know, one of the things about these big corrections in the markets, and that's where gold does really well, is you only see them when they're upon you. And we're certainly, if you go back to the end of last year, everyone was really bullish and it was always all going to be fine, and things were transitory, and suddenly things are a reality. And you know, we've got hot markets, inflation, a lot of conflict around the world, and a global economy that's not in sync. So that's always good for gold.
And so one of the other things that has been affecting you guys, just like it's been affecting anyone, is not only do you have to get your product out of the ground, you have to get it to where it needs to be. And I know that you all have been very focused on supply chains. So talk to us about the latest and sort of give us a status report on that front.
So Julie, that's true. I think, you know, I grew up in northern Africa, and I understand supply chains. And so, you know, the sort of sophisticated developed world has been caught flat-footed on supply chains, has been caught flat-footed on many things related to COVID. And so, you know, the importance of being agile and being able to manage supply chains is absolutely critical, particularly in the mining industry, because we rely on it. You know, we move a lot of stuff to the mines to mine the ore and then move it all back out again. So it is a challenge, but it's absolutely manageable. And, you know, that's going to be the separator. And I think it's going to be the separator in many industries, those who can manage the supply chain and those who can't.
Mark, I don't tell you this, but these are tough jobs working out in gold mines. It's not like putting on makeup and going on TV here. I mean, no offense to what me and Julie do, but mining for gold, it is a tough gig. Are you having trouble finding the next generation of workers in this tight market to get in those mines and work them?
You know, Sozi, the important thing is we pay well, and the big challenge, and when we did the merger with Randgold, the big focus there was, let's focus on the best assets and, more importantly, the best people, because mining has always sort of been in the back of the queue when it comes to, quality people, and we can offer fantastic careers, and that's what we've done, and we feel that there's a huge opportunity to access young people and give them a real career in mining.
And the opportunity that you guys are seeing, not just that you're offering to people, but that you're seeing for the company, prompted you guys to announce a share buyback program as well. Do you think that as we start to see gold prices recover, that Barrick is going to be rewarded as well? I mean, how do you think you convince investors to see the value like you see the value in the company?
Julie, we come we did a big merger in 2019. A couple of deals in Nevada. We consolidated Newmont and Barrick's assets. We took out a problem child company in Africa called Acacia. We merged with Randgold, and my ambition is to build a modern mining company acceptable to future generations. And we've been underperforming the market, particularly recently. It couldn't have been a better time. We've focused on delivering high quality assets with the best people, delivering quality and financial results. And we were lagging in the market. And so we came out with a revised dividend policy. We indicated that we got approval to do a big $1 billion share buyback, because we felt that our share price was undervalued, and it couldn't have come at a better time. Get everyone focused on the stock, and now everyone is focused on gold because of the situation globally.
I like what you said on the earnings call the other day, Mark. You said, quote, competition for M&A at the moment is competition to survive. Now, this industry has a long history of boom and bust cycles as it pertains to M&A. Do you feel heat to make a big deal here?
we looked at all those, and one thing that's sort of kept me in this industry is the things that I didn't do rather than the things that I did. And it's so easy to do big deals at Premier at the top of the market. It's much more difficult to exercise that discipline. And you're right, Sozi, we have a great history or tradition of buying in the top and going bust in the troughs. And we have that discipline. And also mining is a consumptive industry. So it's very important that you invest in your future all the time, not only when the going's good. And that's what we in Barrick have done. And we were one of the few companies this year in our results to point out that we've replaced all the gold that we mined last year. That's a significant step forward, and it's a standout performance in an industry that's always battling to keep its asset base intact as it mines it away.
Well, ask you real quick, Mark, somebody who wants to get into the gold market, just given if they have concerns about inflation, how do you recommend they do it other than buying shares of Barrick Gold? How should they go about it?
So the ETFs are probably the easiest way to get in, and you can buy equity ETFs, and you can also buy the physical gold. And the physical gold is a very safe bet, but you don't get the premium that you get in a good equity. At the same time, in a bad equity, you're exposed to the risks, operational risks, and you don't sometimes get the full benefit of what gold brings to a portfolio. And over time, and I'm talking the last 50, 60 years, gold has always been a stabilizer in a portfolio. And you should have around 5% of your portfolio in some sort of gold package. And that really helps you through difficult times.
And those gold ETFs have certainly proven to be popular with investors today. That was Barrick Gold CEO Mark Bristow. Karina, back over to you.
Okay, and coming up, why regulators have been holding off on approving a COVID shot for kids under 5. Plus, the Biden administration says it's running short of cash to deal with future variants. We'll ask a medical expert to weigh in. Welcome back. Well, the Wall Street Journal report reveals regulators decided to delay the review of Pfizer's COVID vaccine for children under 5 because the initial 2-dose regimen was not working well against Omicron in testing. Here to help us discuss, let's bring in Dr. Tyson Bell, Assistant Professor of Medicine in the Divisions of Infectious Disease and Pulmonary Critical Care Medicine at the University of Virginia. Doctor, thank you so much for being here today. Just your reaction to that news, because there will be a lot of parents with young kids that will be very disappointed about this.
Well, thanks for having me on, Karina. And I'm one of those parents. I have a 3-year-old, and I'm looking at all this news with really two brains. The medical side really understands that we really want to have the data, your ducks in a row when it comes to coming forward to FDA and the CDC. And it looks like the efficacy for the vaccine trials was looking good in the Delta wave. But as we know, Omicron presented a higher challenge for vaccines. And so it looks like that efficacy was a little bit lower. Now, Pfizer has not released the data. I have not seen it. But I agree that you want to make sure that the data is solid before you approach the FDA. Now, the parent side of me with my 3-year-old who I wanted to get vaccinated now, is very frustrated because it feels like parents are being jerked around with this, press release and reversals. And so, at the end of the day, we will have a vaccine that's effective for young children. I wish it were now, but that day is going to come.
Okay, and Doctor, California is now one of the first states to say that they are going to start looking at this disease as endemic instead of a pandemic. Hawaii is one of the last states to sort of ease mask mandates. Are we turning a corner here? Is it time to start thinking about this virus differently?
Well, we see that we have over 2,000 deaths per day and close to 80,000 in the hospital. So I would not say that we're endemic yet, but it does look like we're getting towards that point. Endemic basically means that the virus is here with us, but it's manageable. And so if you have hospitals that are overwhelmed, that's not the spot that you're in. Now, I think regardless of what point we are in a pandemic, I think what California is doing is laying the groundwork for what they're going to do to manage the pandemic and be prepared for the next wave. And what that basically means is expanding vaccination, making sure that you have a good testing infrastructure, making sure that even if you're not requiring masks for indoor settings, that you have a good stockpile that are ready to go in case you need them. And that you're doing all that you can to lay the groundwork for when that next wave comes. The nature of this is to come in waves. And we've been here before last summer before Delta took hold. We just have to be prepared for that next wave to come.
And perhaps there will be a next wave coming because while people are becoming complacent, there is a new subvariant, BA2, that's now causing concern. It's said to be 30 to 50% more contagious than Omicron, more severe in symptoms than Delta. It's now present in 74 countries and 47 states. How concerned do you think we need to be about it?
Well, whenever a variant comes, it's kind of like playing a new team that you haven't played before. So you need the scouting report. But at the end of the day, it depends on what's happening on the field. And so there's always 3 questions you want to ask yourself with a variant. So the first is it more transmissible or easily spread? So it looks like it might be a little bit more than BA1 or the original Omicron. The second question is are vaccines and therapeutics, are they going to be effective? And it looks like that immune evasion is still around the same level that we saw with the original Omicron, and that there's one monoclonal antibody that may not work as well for this strain as compared to the previous Omicron. And then the last question really is it more severe? Now, there's a lab report that suggests that it could be more severe, but that's way too early. What's important and what gives me, some encouragement is that on the field, in places where you're seeing BA2 cases rise, you're still seeing hospitalizations go down. And that's probably a combination of protection from the vaccine. So vaccination and boosting still provides a good level of protection from severe disease, but also being effective with Omicron does seem to provide some protection against this strain. And so I fully expect that if you're vaccinated and boosted, that we won't have as much problems with BA2.
And Doctor, I want to ask you really quickly, Health and Human Services says it is running short of money to deal with future variants and the technology to keep ahead of this virus. They're asking for $30 billion more to help take care of all of the issues they're looking into. How vital are those funds in your estimation?
Well, prevention is key. And when you're dealing with the pandemic, if you are playing the catch-up game, you're already far behind. And that's how hospitals get overwhelmed. That's how staff attrition happens. And that would leave you scarred for handling the next wave. And so, if the resources are needed. Remember, public health was already severely underfunded before we even went into this pandemic. And so we have to catch up to the level just to do core basic functions to deal with everything else that's going on. But we also have to make sure that we have a good workforce that's in place, ready to respond when we have another wave. And so, we have to have masks, we have to have testing, tracing, isolation. And that means that on the ground, public health, local public health agencies and state agencies need to have the staffing and the funding that are able to do this.
All right, we will leave it there. Thank you for all you are doing along with your team. Dr. Tyson Bell, Assistant Professor of Medicine in the Divisions of Infectious Disease and Pulmonary Critical Care Medicine at the University of Virginia. Thank you so much. Alexis, over to you.
Thanks a lot, and thanks to Dr. Bell for his candid comments. It is tax season, everybody, in case you didn't know. Up next, we're going to speak with a tax expert on how to navigate through all the chaos. This tax season could be one for the record books, and not in a good way. The IRS has been crippled by staffing shortages, and taxpayers now face unique challenges preparing their returns. Here to help us through it all is Richard Levina, CEO and founder of the on-demand tax filing app, TaxFile. Richard, good to have you here on the show. We'll talk about TaxFile and what you do there in a little bit, but first I want to get to some of these challenges that we as taxpayers have this time around, namely how to report pandemic-related stimulus payments and those child tax credits when it comes to our tax returns. What should we know, and how might they affect our returns?
Yeah, thanks for having me. So the one that's affecting most individuals here in the United States would be definitely the child tax credit. So in 2021, that credit was increased from $2,000 to $3,600, right? And a lot of us, myself being a parent, opted in to get some payments advanced in 2021, right? So when it comes time for you to file your taxes this season, and you have until April 15th to do so, you just want to make sure that either if you're doing your taxes or your CPA or assistant is doing your taxes for you, your pro, to make sure that you track all the payments that you received in 2021 if you had some of that that credit advanced to you. If not, that's okay. You could claim the full $3,600 amount on your return. And as it relates to small businesses, you mentioned stimulus payments and things like that. The biggest one would be PPP. So the latest update in terms of PPP is that If you got PPP funding because you incurred some hardship during the pandemic, that seems like for most cases it's fully forgivable, meaning that you don't have to pay it back.
And of course, tax filing day 2 months away now, April 18th. Crypto is one of the big conundrums that a lot of people are dealing with this year because they are supposed to disclose any sort of gains. And I'm wondering, how do people deal with that?
Crypto is tough because unlike other stock, a lot of people that trade crypto go from one coin to another without necessarily exchanging it to cash first, right? So unlike the stock market, if you use an app like Robinhood or something like that, it's usually you're converting dollars into the equity of the company that you're trying to buy stock in, right? But with crypto, however, whether you use Coinbase or some other exchange, you're exchanging from one coin to another. And the disconnect between how the IRS treats that and regular trading is that they calculate, or they want you to calculate, your gains and losses as you trade from one position to the other, right? So it seems to me that, as we work with a lot of people that do crypto, they think that it's only when you change back into fiat, whether that's the euro or the USD, right, or something like that. That's when you have to record it on your Schedule D on your tax return. However, it's not. It's a little bit more complicated than that. There's a lot of softwares that are out there that could help you keep track of all those positions changes, and we highly recommend that.
A lot of taxpayers are also sort of trying to deal with how to submit their 2021 returns when their 2020 returns, or perhaps even earlier ones, haven't even been processed yet because there's such a backlog at the IRS. What should they do?
Be patient. You could definitely call and get an update. That helps for sure. But it's not like there's a secret to getting an update. They are currently have, I think, like 6 million returns that are still backlogged. Many of them are paper filings, right? So as you know, you can either file electronically or with a paper file. Sometimes they require you to file with a paper document as opposed to electronically if you're doing some work that you had to revise or something like that. And if that was the case in 2021 and you still haven't received, let's say, a refund or the settlement of your position with the IRS, those are probably going to be farther back in the queue than if it was done electronically.
Now, Richard, I want to ask you about your own company, TaxFile. It's been deemed the Uber of taxes because you can file your taxes from your couch or your home. Tell me what makes you unique from different companies.
Yeah, so I think TaxFile, unlike, there's a lot of great do-it-yourself apps out there, and if you need assistance, like TurboTax Live, that's nice. If that's kind of like your thing. If you have a slightly more, I would say, complex position, let's say you're a small business operator, you did trade crypto. We have a network of 4,500 on-demand CPAs and IRS enrolled agents that specialize in slightly more complex situations, right? So the niche that we kind of go for would be those that mainly are spending 10 plus hours on TurboTax and maybe are getting frustrated with it and want to bend it. So about 6 years ago, we started this company to help solve that problem.
All right, we're going to leave it there. Richard Levine is CEO and founder of TaxFile. And we know with so many people not wanting to go in to actually see their accountant to file because of COVID, this is definitely a great option. Thanks so much for being here. Karina?
All right, and I'm sending my own taxes in today. Thank you so much. We are going to switch gears after a quick break. Apple workers are looking for a change in their working conditions. We'll get into that next. Welcome back. Well, despite the market turn down, Apple is still the most valuable company on the planet, and it seems like employees want a bigger piece of the pie, with some workers seeking to unionize. Here with more, let's bring in Yahoo Finance's Dan Howley. And Dan, to be clear, we're talking about some employees here in the U.S. What are they looking for?
That's right, Karina. Basically, what's going on here is, according to reporting from the Washington Post, a number of stores, Apple stores, employees are looking to unionize. Now, there's 2 so far that have seemingly reached out to major union organizations. And so what this means is that the workers want, as you said, to get a bigger slice of that huge amount of money that Apple has. At this point, it's worth, its market cap is still north of $2.7 trillion, despite falling back from $3 trillion. Again, a wild number, but still a drop. And if you look at Apple's earnings in Q1, they still set records. They had $71.6 billion in revenue from the iPhone alone. And so workers seem to want to get more of that as inflation causes them to essentially earn less money than they previously would. They also want more benefits. Apple offers a number of different opportunities to advance, but workers want more. And some of the experts I spoke to said that this really comes down to the fact that they were on the front lines during the pandemic. They're front-facing workers. They deal with the public. They're the people that have to give kind of tutorials on the products that are being purchased. And so because they have to do that, and because they're the ones that help drive Apple's sales, they feel like they're entitled to more than some of the executives otherwise believe.
Dan, of course, the natural comparisons here are looking at Amazon and Starbucks, where we've seen workers at both those companies pushed to unionize. Is that a fair comparison to make?
I think it's more apt to compare it to Starbucks than something like an Amazon. And, that's because of the type of people that are working at the 2 organizations. It's, usually folks that are somewhere along the lines of college educated. They're really young in most cases. And so there's a lot of overlap. And so some of the people that I've spoken to, some of the labor experts, have basically said that these 2 really line up well with each other, and that Apple could end up hurting itself like Starbucks did if it pushes union busting activities, which apparently it's trying to do by getting managers to tell some of the employees that joining a union will depress wages, will take away some of the benefits that they have, like special options to work at Apple's headquarters. So really, it comes down to this being perhaps Starbucks being a lesson for Apple, and then it could work with the employees if it chose to, and that in the long run would have them be happier and want to work with Apple over the long term.
Okay, Dan Howley, thank you so much for that report. Alexis, over to you.
All right, we're going to be keeping an eye on it. We are keeping an eye, of course, on the markets. That's what we do here at Yahoo Finance. And I can tell you that all 3 major indexes well off their lows of the session, continuing to hang over this market. Concerns about the Russia-Ukraine situation. U.S. officials today warning that a Russian attack on Ukraine is expected in the matter of days. And President Biden is going to be making comments about that situation from the White House at 4 p.m. Eastern today. And we'll bring those comments to you as they happen. The Dow is off 182 points right now. The S&P down 30 and the Nasdaq off 167. I want to take a deeper dive into the Dow for a moment and take a look at some of the winners there, actually, because there are some winners, which is why the Dow is able to bounce off its lows of the day. Cisco Systems, Coca-Cola, and JP Morgan Chase among the stocks leading the advancers there, but putting pressure on the 30 Dow. The same stocks that have been all day long. We've got big losses for Intel, Boeing, Salesforce having a rough week overall, also lower right now. And let's get a quick check of the bond market, which of course we know is very sensitive to all of these geopolitical tensions as well. We're seeing yields pull back a little bit there, but the yield curve continuing to flatten. We've got the 10-year at 1.92, the 30-year at 2.24. Much more on the markets, the situation between Russia and Ukraine, when Yahoo Finance Live continues right after this short break.
Markets trying to keep a lid on what's been a brutal week for equities, constantly changing geopolitical headlines, whipsawing investors, not as Fed speak continues all ahead of the long weekend and comments from President Biden just a short time from now. What appetite is there for risk? We'll ask an analyst. Twists and turns, the rhetoric keeps changing on Ukraine and Russia tension. Joe Biden set to deliver remarks at 4 p.m. That is, Vladimir Putin says he didn't pay attention to reports of an invasion. Meanwhile, dialogue continues as Russian personnel amass on a tense border and Ukrainian separatists evacuate to Russia. And in our Black History series, we speak to an entrepreneur whose spicy spin on her business is getting attention and lifting the community. Good afternoon, everyone. I'm Karina Mitchell, along with my co-anchor, Alexis Christophers, coming up to 2 p.m. on this Friday, ahead of a long weekend, and investors squarely focused on Ukraine-Russia tensions. Here with more on that and what else is moving markets, let's bring in our Yahoo Finance's Jared Blickery. And Jared, markets really trying to digest the latest Russia-Ukraine headlines.
Yes, it looks like the worst for the day is over so far. Of course, we have a couple more hours into the close, but let's just take a look at the Nasdaq, which is off of its lows a little bit, but you can still see mired in the red, down about 1.2%. And the Dow also off about 0.5%, only 170 points there. The Nasdaq taking the biggest losses today. Let's check out the VIX. We want to take a look at volatility, which we've been seeing spiking higher. So the VIX a little bit lower than its high, its daily high that we saw a little bit earlier. And we'll also get a quick check of the bond market. The 10-year T-note yield now solidly in territory we haven't seen in a couple weeks, down to 1.92%. So looks like a little bit of respite from these highs that we saw here. And bond volatility, I got to say, has been an issue lately. If you take a look at the equivalent of the VIX in the bond market, that's called the MOVE Index, definitely moving higher here, not shown. This is a sector action for today. You can see Staples trying to crawl into the green, but still a little bit down. That's followed by, well, actually now it's materials, then Staples, then financials. All of this circling around the unchanged line. To the downside, we see tech, consumer discretionary. Those are the two hardest hit sectors. And we can see that reflected in the mega caps here, where we're still seeing Tesla and Ebitda under pressure. Each of those stocks down over 3%, guys.
Oh, we've also got the chip stocks on the downside today. I know, Jared, led by Intel. I think that stock is slumping to its lowest level in about a year. I know they had their turnaround pitch yesterday. Seems like it didn't impress investors much.
Yeah, a little bit too ebullient, and we're going to get to some Wall Street commentary on that. And yes, it is the worst day that they've had since November of 2020. So, and you can also see touching those lows that we've seen in this chart here over the last 2 years. Now, let's put a candlestick chart on here before we get to the analyst commentary. I just want to point out an interesting technical formation. You can see a lot of sideways action here, but you could see this as a double top. And if we're right at the neckline right now, a measured move, which is the $45 price level here up to 70. That's a $25 move. You subtract that from $45, the target is $20. And you can see that on a max chart here going back to the 1980s. This is where that price target is. Doesn't mean that the market has to go there, but we break below these levels, could be some downside action there. Now, Bernstein, which rates the stock and underperform with a price target of $40 underneath the current price of about $45. They're saying the company's tone at the event was almost absurdly bullish as to the growth that they think they can achieve. The strategy will be expensive, and the next few years look dour with muted gross margins and spending. Baird, which holds the stock with an outperform rating, price target of 60, says Intel remains a show-me story near term, but is also a long-term, high-stake turnaround story in which we believe in and which should ultimately be rewarding. So some differing opinions there, but the technicals showing that we're right at a crucial level for sure here, guys.
Okay, and then finally, Jared, stocks feeling pain after reporting earnings. Draftkings and Roku not feeling any love at all. Roku still delivering earnings that were better than expected.
Yeah, some quick commentary there. Roku is planning for its future. I mean, we were just talking about Intel planning for its future. A lot of these growth companies which are getting hit on their earnings announcements simply because they're going to have to outlay a lot of funds for capital expenditures. Roku is in that group, and we'll take a look at some of these charts in a second, but I'm writing about this over the weekend. A lot of stocks are feeling the pain after the after they have reported earnings this season. Top of the list here, and I use the S&P 500 along with some of the top Yahoo Finance trending tickers. Lending Club down almost 30% after its earning, followed by 1-800-Flowers. Both of those, by the way, also meme stocks, but then also the mega caps, Roku, Roblox, Facebook, PayPal, Teradyne, Netflix, all down more than, let's say, 24% after their earnings. And the list goes all the way down here. Spotify, Shopify, Palantir, Under Armour is the least worst off here. It was down about 14 or 12% after its earnings. But then you take a look at what's happened year to date in a lot of these issues. And let's go up to our heat map here. A lot of these are down 40 to 50%. So you can see Facebook down almost 40%, Netflix 35%, PayPal 45%. Those even are not the worst. The worst performance here, Roku down 52.5%, what we were just talking about. Shopify and Roblox also down more than 50%. So a lot of these growth names getting in the re-rating cycle, and that's really hurting their performance this year. But if you're looking for the upside, probably going to be a couple of quarters in the not so near future, maybe the distant future, where they can kind of catch up here. But it's going to take a lot of investment and a lot of time for a lot of these stocks to heal.
Okay, Jared Blickery, thank you so much. And we'll see you here back in a bit for the oil close. We're going to keep it on markets right now and bring in our next guest. Mark Newton is Fundstrat Managing Director and Global Head of Technical Strategy. Mark, thanks so much for your time. So markets are really getting whipsawed at the moment because of these geopolitical tensions. And I'm wondering, in your opinion, what conviction is there in the market right now, particularly ahead of a 3-day holiday? And then short term, what does market sentiment look like to you?
Thank you. Well, there certainly is a lot of uncertainty right now. You have the 1-2 punch of not only investors not really being in sync with what the Federal Reserve has in store, and there's a lot of uncertainty there with really how many rate hikes we're going to get this year. And so ordinarily the markets work very fine when they know exactly what the Federal Reserve has in store. And in this case, I think it's really all over the map, and it's anybody's guess. People know that rates have to come up and the balance sheet is going to be pared down. The question is, how quickly does that happen? So there is a little bit of concern there. And also, of course, the geopolitical tension. I would just argue that oftentimes that does tend to prove to be very short-lived, and that, many times during geopolitical conflicts, it's really more of a case of sell the rumor, buy the news. And so my thinking is that, within the next couple of weeks, we'll see some stability on that front, and markets likely can start to push higher into the month of March. But we have had a ton of damage that's been done. As we were just talking about, all the stocks that are down 40 to 50% off the highs. If anything, the effect of some of these FANG type companies within the broader indices, you look at the weighting of Apple and Microsoft, and those have really held the broader indices up at a time when the actual markets have suffered a far greater damage. To your second point, sentiment is a little subdued. It obviously is gotten a little bit more bearish, but it's not to the extent that it was actually in early December or even in January, when we saw the pace of the decline much faster to the downside. If anything, this recent choppiness has provided a little bit more of uncertainty, and it's not truly that fearful yet. When you look at things like the equity put to call or fear and greed index, those haven't reached levels of true capitulation. So yes, we have seen selling in technology, of course, and that's what many investors are concentrating on. But look at stocks like Altria or Philip Morris or Hershey or many of the stocks that are breaking out to new all-time highs, or Coca-Cola, for example. That's where all the strength is right now. It's all in the safety stocks. Meanwhile, everybody is wondering if Roku, now that it's gone from 500 to 105, is a buy at these levels. And so oftentimes it pays for these for these technology stocks that are plummeting to really wait for some signs of stabilization before thinking we can have a huge bounce.
I want to ask you a question, because how much of these tensions that are happening currently are exacerbating the risk of inflation? And then perhaps on the flip side, there was talk of a 50 basis point hike come March. Do you think that's off the table with everything that's going on now?
In terms of exacerbating the tension, inflation is something that many people agree parts of it are here to stay and parts of it can be transitory. Our own Tom Lee at Fundstrat would argue that it is going to be transitory and that it's going to come down towards the latter part of the year. So hiking rates aggressively into that to try to curb inflation likely is not going to be beneficial. And if anything, they really have to be careful. The Fed oftentimes never truly gets it right. They're always behind the curve. They're always hiking and looking at past events. And we to try to think that we're going to hike 7 times and we can see a smooth landing on that at the same time as we engineer the soft landing of, taking down the balance sheet, that can be very, very tricky. And if anything, that could start to affect growth. So, in terms of 50 versus 25 basis points, it's really anybody's guess. But I think that we learned this past week that Bullard came out, way too hawkish, and actually look at, recent comments that have come in a little bit not as hawkish as what he initially said. And so that caused a little bit of a steepening in the yield curve for the first time in a while. So, I think we've got our answer that it likely is going to be 25. We all expect that it's going to be anywhere between 5 and maybe 7 hikes, but there's a lot that can happen between now and then, and it's really anybody's guess. If the market were to truly start to turn lower with a lot more velocity, it would be difficult, in my opinion, to see the Fed really aggressively hike into that at a time when the stock market is showing downward volatility into maybe the end of the second quarter.
And then I know you did talk about growth stocks. There's something else that you like, which is interesting. You say tobacco stocks are worth looking at. How come?
Well, that's one of the best acting groups of the entire week. So, as the saying goes, smoke them if you got them. I mean, look, this group, when you look at Altria, when you look at Philip Morris, these are simply stocks that are acting, very, very well. And maybe not necessarily today on a day of extreme market weakness, but over the course of the week, when you look at the weekly performance and some of the breakouts that are happening in Altria, Philip Morris, and it's just really an area that investors can hide during times of extreme volatility. And it's often, beneficial not only to diversify during times of market weakness, but to look at these safe themes and look at the Walmarts of the world, look at Coca-Cola, look at McDonald's, look at some of the tobacco names. They tend to provide a lot of stability and safety, and oftentimes act a lot better and don't get caught up in the type of downdraft that we see during times of real carnage to technology stocks.
All right, we will leave it there. Smoke them if you got him. My colleagues join me in saying that is the quote of the day. Thank you so much, Mark Newton, Fundstrat Managing Director and Global Head of Technical Strategy. Thanks for your time. Have a great weekend. Alexis, back to you.
Yeah. I like that. It's brought a smile to my face on this Friday. We can all use that right about now. Coming up next, a conversation with the executive chairman of Immunity Bio on that company's efforts to tackle cancer. We're back right after this. Welcome back to Yahoo Finance Live. President Joe Biden announced a renewed effort to tackle cancer in the U.S. but the so-called moonshot program has plenty of critics. The executive chairman of Immunity Bio has faced some similar criticisms for his own efforts, which began back in 2016. Anjali Khemlani joining us now with more. Anjali, I know you had a chance to catch up with the executive chairman of that company. What did he have to say?
That's right, Alexis. We know that Dr. Patrick Soon-Shiong has been pretty well storied and has faced pretty heavy criticisms for missing a 2020 deadline for his own cancer moonshot program. A lot has happened since then. We've seen some incremental updates, but this kind of is a flashback, really, as we see how the president's own program is rolling out and what the possible hiccups he could be facing there, too. So listen to what he had to say about all of this and more.
You know, when we launched our cancer moonshot in 4 or 5 years ago, that was exactly the goal, not only to cut it by half, but actually to convert cancer into a chronic disease. And what I'm excited to say is our announcement a couple of weeks ago on pancreatic cancer, an announcement today on bladder cancer. It looks like we are close to that goal.
I definitely want to touch on that because there have been differences in coverage. Some of your critics saying that you didn't quite meet that 2020 goal from the initial program, and yet we have seen those incremental updates as well. What do you think this says really about the goal itself and just about how hard cancer is for to eradicate?
You know, I think people misunderstood not misunderstood. It's a real paradigm change. So there's no misunderstanding because it's never been done before. And that's why, what was the goal of our cancer moonshot? At the end of the day, the goal of the cancer moonshot was a complete paradigm change that said you, in your body, have immune cells called the natural killer cells and T cells that can kill the cancer. So it's like going to the moon. The first established program is to say, in fact, is that true? Are the immune cells, natural killer cells and T cells in your body that can kill cancer? And if so, does that actually change the outcome of patients who are put into hospice? I mean, going to the real end stage that have failed everything, like pancreatic cancer, triple-negative breast cancer, glioblastoma, Merkel cell cancer, lung cancer, and bladder cancer. And that was the goal of the cancer moonshot from our perspective. Stage 1. And I've just tweeted, we've reached stage 1. We've reached stage 1. And we've doubled the survival rate in metastatic pancreatic cancer. And we've taken patients with bladder cancer who have no other treatment left other than to have the entire bladder removed, a 70%, over 70% complete remission lasting for over 2 years. So I'm pretty pleased that we've actually proved the hypothesis. Now we launched phase 1. And now we need to go to earlier stage disease all the way to preventing cancer in patients like Lynch syndrome. So the answer is we're well on our way with Cancer Moonshot.
Absolutely. Let's talk about what has changed since that time. You launched this in 2016 with several big pharma partners, and then the outfit that you had sort of done this through, NantQuest, you reverse merged into Immunity Bio recently. So all that put together with all these moves, what else has changed, would you say, whether in technology and biotech or in diagnostic testing and sort of the investor market and the interest there? What pieces of the puzzle have changed for you, would you say, in that time?
Well, when I first started this, when we had this meeting at the Vice President and Vice President Biden at his residence, I brought every pharma into the room with the FDA, with the National Cancer Institute. And maybe naively, the goal was that we'd all work together. There'd be no, there'll be competition for sure, but at the end of the day, we are actually for the common good. That quite didn't work out, which then needed me to pivot to bring small companies together, which we did under the umbrella now of Immunity Bio. So that's happened where we brought multiple platforms, a natural killer cell platform, an adenovirus platform, a yeast platform, a self-amplifying RNA platform, all under one roof, which has never been done. The next thing that changed was for me to understand how I need to build biological manufacturing capacity. And because of my experience with American pharmaceutical partners, in which we made 1 million vials a day for 10 years, and we're responsible for the safe supply of heparin in this country during the heparin crisis, I had not only the background, but also the people who would actually follow that vision. And we now have close to 1 million square feet of manufacturing capacity for upstream and downstream of biologics, which will create what I think a national preparedness organization, not only for the United States, but for the world.
Yeah, I definitely want to talk about emergency preparedness shortly, but looking back on the testing part of it as well, I know that was a key piece to how you were looking to progress all the cancer breakthroughs. The GPS test, I know, sort of petered out a little bit, but it seems like we saw a little bit of that happen in the industry with not necessarily a strong uptake of testing. Now, post-COVID, has that helped at all? Do you see maybe a new market or new opportunities?
Well, the GPS test did not peter out, actually, and that was one of the disappointments. In fact, we were the first, when we launched Cancer Moonshot, to do a whole genome sequencing and mutation analysis, which is exactly what's happening with COVID. So not only were we correct, we got FDA approval. The problem is there was no reimbursement. So it's very hard to induce an oncologist or patient to do this very difficult test without any reimbursement. And that was the biggest disappointment. And we fought for 4 years. Having said that, we didn't give up. We have the only ClearCap certified whole genome sequencing mutational analysis lab. In fact, on that basis, we've done the mutational analysis of every mutant of COVID and look at its binding affinity to T cells. That's what's driven our T cell vaccine. So all these things that we have put in place, it's difficult for the consumer to understand that these things didn't exist. A whole genome sequencing, tumor normal didn't exist. We built that. And that was the GPS test. It's necessary, completely necessary, and still is necessary. And then we sent these 2 machines to South Africa, to University of Stellenbosch. And as you could see, Omicron and everything else was discovered as a consequence of that. So sequencing is important. However, what is more important is what to do with the results. So awareness is important, but response is more important. And so it's no point in crying wolf if you didn't have a preparedness or response, and that's what we are building now. Now that we've finished the first 2 elements of the testing awareness, the next thing is the response and the platform and the therapeutics.
So as you can hear, a lot going on there, still pushing forward with his efforts, even though that 2020 deadline was missed. And it must be pointed out that President Joe Biden, then Vice President, also had some similar goals which were missed. So it seems like it is still just a longer road ahead, and we'll see how this new initiative rolls out. Back to you.
All right, definitely an important issue there. Anjali Khemlani, thank you so much. We're going to take a quick break, but on the other side of it, we delve further into the Ukraine-Russia crisis, speaking to the Brookings Institute. Stay with us.
Welcome back. Renewed fears of a Russian invasion of Ukraine. The U.S. and NATO officials say there is evidence on the ground that shows Russia has increased troop levels near Ukraine's border, despite Moscow announcing earlier in the week that some units were pulling back. Meantime, President Biden said the probability of an attack in the coming days remains high, and he's expected to make some comments from the White House about 90 minutes from now. Joining me to discuss is Douglas Redeker, Brookings non-resident senior fellow. Douglas, thanks so much for being with us. I want to talk for a moment about the global economic implications of a possible invasion by Russia, because we know the U.S. is talking about Russian sanctions, but in many ways, Putin has found an economic lifeline in China. So I guess my question is, would Western sanctions really be a deterrent for Putin at this point?
Well, I like to take a step back and say there are sort of three different buckets of economic impact of what's ongoing right now between Russia and Ukraine. The first is the direct impact of a potential Russian invasion and the disruptions of commerce and economic activity on the back of that invasion. The second alludes to the question that you asked about sanctions. And then the third is, if we do put on sanctions, whatever they may be, what the retaliatory measures might be that Russia might impose on the US and Europe. And each of those three has different economic consequences. So the first one, the direct action of Russia, we don't know, obviously. We don't know what a Russian invasion might look like. But let's assume that that is going to be the one that has the most direct impact on Russia and Ukraine and its trading partners, and particularly in the energy sector, if those energy pipelines are somehow disrupted. But then the second one, the sanctions, that's what we're talking about, proportionality. Proportionality means whatever it is the Russians do, we're expecting a US-EU sanctions package to be somehow proportional to whatever that invasion looks like. These days, it's looking as if there is an invasion, it's going to be a real invasion, not what President Biden referred to as a minor incursion. So if there is a real invasion that warrants real transatlantic imposed sanctions, I would suspect that those are going to primarily focus on high-tech imports into Russia, the banking sector, and individuals and entities that are on a sanctions list. So whether that includes Putin or not, we don't know. Mm-hmm. But I think those are the three buckets. I don't think it's going to include direct sanctions on energy, simply because energy is a double-edged sword. It hurts those that are receiving the energy as much as, or at least to some degree, as much as those exporting it. So I think that's going to be less likely to be part of that initial package.
Okay, so what about the possible impact on the food sector? And I ask that because you've got these massive Russian naval exercises right now already threatening to choke off agricultural exports from Ukraine, which I believe is one of the top suppliers in the world of corn and wheat. So if that is cut off and only gets worse in the coming days and weeks, what does that mean for the global supply of corn and wheat and to prices there?
Yeah, that's a great question. You know, Ukraine used to be known as the breadbasket of the former Soviet Union, and it still is a major agricultural exporter, primarily but not exclusively to North Africa and countries in the emerging markets. So you have to sort of look at it as a first, second, and third order consequence of Ukraine being cut off from its exports. Those countries that normally rely on those imports, what are they going to do? There's probably going to have to be a need to fill those countries' needs for imports, and then where do those imports come from as a substitute for where they would normally go? So I think, yeah, you could certainly look at a second-order consequence of a hike in some food prices, primarily to those countries that are really dependent on Ukraine. But you're right, it's a global marketplace for a lot of these foodstuffs, so it would have an impact. The other thing I would say is potash and other fertilizers. Ukraine is a major supplier of those raw materials. So I think that you would see an impact, not in the immediate term, because of course fertilizer has to actually trickle into the agricultural chain. But if you do cut off potash and other fertilizer exports from Ukraine, that's going to have a broader impact on the food supply going forward as well.
I want to get back to energy for a minute, because a lot of folks are very concerned that we could see gas prices, move even close to $5 a gallon on average in the U.S. if there was a heightened activity between Russia and Ukraine. And we also saw crude oil marching towards $100 a barrel. Do you believe that is not going to happen?
Well, so there are two ways to look at, well, there are multiple ways to look at it. Let's take gas, meaning natural gas, and separate it out from oil, which we in the US define as gas, meaning gasoline. Gas, meaning natural gas, is much more of a point-to-point distribution network, meaning you have pipelines that go from Russia through a country to its ultimate destination. There are, however, ramped up supplies of liquid natural gas, which can be transported by ship and by other means. But really, the primary distribution networks of natural gas are point to point. So the US consumer of gas, natural gas, would be less likely to feel a price shock on the back of Russia-Ukraine tensions, other than the fact that we may be diverting some of our excess supply to make up for the shortfalls or potential shortfalls in Europe. But on oil, which again hits the pump here, look, oil is a global commodity. I don't actually believe that the molecules, the energy molecules of oil, are going to be directly impacted by either the action in Ukraine or by the sanctions package that we and the Europeans might seek to impose on Russia. That doesn't mean that supplies are not going to be somehow disrupted by the action itself. But I do think that we are overreacting and thinking that it is going to be a direct sanctions consequence to the price of oil. However, markets don't always focus on those molecules. They focus on the forward-looking fear factor of supply disruptions, and that's where you're going to see the price spike. So my sense is the market is really starting to understand, oh my goodness, a land war in Europe is something we really haven't factored into our thinking for decades. This is going to be disruptive. One of the means by which you're going to see that disruption is going to be energy supplies. But no, I actually don't think you're going to see a direct impact on oil exports from Russia on the back of sanctions.
All right, Douglas Redeker, Brookings non-resident senior fellow. Thanks for your insights today. We appreciate it. And I know, Karina, we're going to talk more about oil on the other side of the break.
Yeah, exactly. We'll check the energy sector where there's an unusual twist in oil prices. So more on that ahead. Welcome back. Well, it's a bit puzzling to many, but oil saw a weekly decline despite geopolitical tensions, which Vice President Kamala Harris calls, quote, a dynamic moment in time. Perhaps some of those tensions offset by advances in Iran nuclear talks. Here with more on the energy sector and how oil settled, let's bring in our Yahoo Finance's Jared Blickery. It is quite a surprise that oil took a dip.
Yes, we were seeing oil shoot higher only last week on some of these Ukraine headlines, but really not that much this week. So WTI crude oil for March futures just settled at $91.07 per barrel. Today's price action pretty much in the red the entire day. And here's what happened this week, down 4.5%. In fact, I believe this is the first week that we've had a negative print, a negative return in crude oil futures this year. I mean, you take a look at the year-to-date picture here, and it's from the lower left to the upper right, although we are definitely stalling out here, having hit about $95 per barrel. A lot of analysts calling for as much as $100 per barrel, but a lot of the people we've been speaking to think that we've hit a temporary ceiling. So I would say anything between $95 and $100 probably going to stall out in there if we do get some big geopolitical spike. And in fact, if we happen to find ourselves in a land war in Europe next week, we could very well hit there. In the meantime, any resolution to this process probably going to see the price of oil retreat a little bit. And there's also that Iranian situation that you were talking about just now that factors in as well.
Okay, Jared Blickreed, thank you so much for that report. We are going to pivot now. It's no secret the pandemic has been a catalyst for a plethora of changes across various industries, including the world of fashion. And here to share insights on some of those changes, including the latest consumer styles and shopping trends, let's bring in Stitch Fix chief merchant Loretta Choi, along with Yahoo Finance's Danny Romero. Danny.
Thanks, Karina. And thank you so much, Loretta, for joining us.
Thanks, Danny. I'm really happy to be here.
So let's dive into the latest report of consumer styles and shopping trends. What were the biggest takeaways?
Yeah, I wanted to share with Stitch Fix, we're an online personalized shopping and styling service. And what we believe is that there's a better way for our customers to shop. And through that, we are helping clients today with our styling, our stylists and our data to help clients make client right decisions. And with that, we have been able to take the data and really put together a great style forecast that is just presenting really incredible themes. One of the biggest themes that we're seeing is this shift away from business casual into business comfort. What does that mean? Over the last couple of years, we've been in this great shift where, everyone's been wearing leggings, everyone's been wearing sweatpants in this global pandemic, and has been really thinking about how do we swap out our clothes now that we are returning to normal life. And with that, this major swap out, about 2/3 of our consumers are really eager to think about style again in a different way. How do you wear great style? How do you think about being comfortable? No one is willing to forget about the comforts that they've experienced over the last 2 years.
Yeah, Loretta, you bring up a really good point, because after nearly 2 years of working from home, the business casual dress code has become somewhat hazy, right? And so how is Stitch Fix helping those customers find clarity in their wardrobe now?
Yeah, with everything that we're hearing with our customers, comfort is one of those key words that keeps coming up over and over again. And what we're finding is that clients want softer hand feel in fabrics, they want relaxed fits, they want comfortable details. And women today in our client mix they're telling us that they're wanting to say goodbye to buttons and zippers, hello to elastic waist pants. They're asking for knit blazers that actually feel like sweatshirts, so comfy every single day, but has a really great polished look. On our men's side of the business, what we're hearing is that polo shirts have really replaced button-down woven shirts. And athletic pants, what you see in hike wear and golf pants, that is much more versatile for our customers, and they're wearing that every single day, taking it from the golf course all the way back into work and then bringing it back to home.
Yeah, and I wanted to talk about, with the inflationary pressures being very prominent among consumers and supply chain disruptions continue to be headaches for businesses, how is the company navigating those challenges on what's ahead?
Yeah, it is. It is really inflation is hitting every industry, and it's hitting every single consumer, and so that is something that we are very aware of. I think the difference here at Stitch Fix is that we are all about personalization, and when we think about leveraging our data and leveraging the insights that we get from our styling teams, we are able to really think about, your style preferences, your fit preferences, but also your budget preferences. So we are adapting. We are using our data to really help inform how we think about product that we bring in and what types of product that we are presenting to our clients.
And Loretta, really quick to wrap this all up because we're going to head to break. Earnings is coming up in the next 2 weeks, and there's some cautiousness around analysts around the company's fixed model about it being a niche concept with limited growth potential. How is the company planning to grow that customer base?
Yeah, we are really focused on the long term. We are a relationship company, and what we are doing is adding great value to all of our clients, both in the fix and in our new freestyle model. And what that means is that we are building personalized experiences to our customers, whether they want to engage with a stylist and receive items, 5 items in a box, or have this on-demand option in freestyle, which means that a client can come in and experience a personalized shop at their fingertips at any time. So we are really focused on this evolution and really continuing to add value to every one of our clients.
Well, thank you again for all of that. And I'm going to pass it back to Karina.
Okay, guys, that was a great conversation. Loretta Choi, Stitch Fix Chief Merchant, along with Yahoo Finance's Danny Romero. Thank you both so much. We're going to take a quick break, but on the other side of it, if a menu item named Ménage à Trois doesn't grab your attention, our next guest, who owns a restaurant where you can get it, certainly will. Stick around. Welcome back. Well, with menu items like Fussy Hussy and One Night Stand, our next guest is a fast casual restaurateur who knows how to get your attention before the food ever hits the table. Joining us as part of Black History Month series is our next guest, Pinky Cole, vegan restaurateur, along with Yahoo Finance's Brooke DePalma. Thank you both for being here. Pinky, so you've got a few locations in the Atlanta area serving vegan food. First of all, tell everyone the name of your restaurant, because I think it's amazing. It's something that when you hear, you definitely won't forget. And then why vegan and why Atlanta? Because the two things don't necessarily conjure up something that would come together, but you made it work and community came behind you.
Well, first of all, hopefully I can say this on TV, but it's called Slutty Vegan. And unless you've been living under a rock, Slutty Vegan is a 100% plant-based burger joint that started in 2018 and became a worldwide phenomenon. We have locations in Atlanta, but we literally help people to reimagine food. You know, when you think about starting a vegan concept in the heart of the South in Atlanta, it's typically unheard of in this capacity. But what I was able to do was craft an experience around community and people and food that made me have lines down the block for the last 4 years. And it's been an amazing roller coaster ride. We create ecosystems around people and provide opportunity for people, and they get to have a good time while eating good food at the same time.
Pinky, now historically, it's quite hard for women of color to get funding to start, their endeavors like you did. Now, you did self-fund the first location of Slutty Vegan, but for many Black women, the average seed round for Black female entrepreneurs in 2020 was $125,000. Now, that's far less from the national average of $2.5 million. There's a huge gap there. What do you think needs to be done in order to close that gap?
I think that I myself, I am being a change that I wish to see. Once upon a time, Black women especially weren't even considered for opportunities to get an injection of capital. But now with everything that's happening in the world, we are finally getting our due and our recognition. And I'm showing people that as long as you continue to rise up and you have a valuable business that's sustainable and you have a really good model that people want to be a part of, you will get the money. And that does not have anything to do with color. Because at the end of the day, if you have something that's viable, that's successful, people are going to want to attach themselves to you. So here I am as a successful Black woman, a recipient of an injection of capital that's coming up. And I can honestly guarantee you that I'm not getting the money just because I'm a Black woman that needed an opportunity. I'm getting the money because I created a damn good business that people know, love, and respect, and they want to see it win in a major way.
More power to you there. I want to talk to you about your Pinky Cole Foundation. Why did you decide to come up with it? And then what are some of the obstacles that you faced?
So I started the foundation in 2019, and it was really a way to formalize me giving up my money because I love to help people, and I get that from my mom. But I help to bridge the generational wealth gap. And it's not just about food, it's about mind, body, and spirit. So we've done so much through the foundation. I've partnered with the Department of Juvenile Justice to provide jobs for second chance juveniles. Partnered with Impossible Foods and Jermaine Dupri to get people excited about the last voting election that just happened. And I think that we played a really big part in turning Georgia blue. I've also contributed in donating, paying the rents for 30 college students in Atlanta so that they can walk across the stage. I've paid the rents for local businesses in Atlanta. I've given out thousands of pounds of fruits and vegetables. And most recently, my partner and I, Derek Hayes, we are now providing 25,000 Black men in Atlanta with life insurance that they do not have to pay for. We're footing the bill. We partner with Prudential Life Insurance to make sure that men in Atlanta have life insurance so that they can learn about financial literacy, mental health, and all the good stuff that we really don't talk about in our community. So I'm putting my money where my mouth is and really doing the work. And it's at the core of who we are as an organization. And that's a part of the reason why Slutty Vegan is still successful.
And Pinky, what you're doing is absolutely incredible, but you started with a mission just to get plant-based protein more notice, more mainstream. And so when we spoke to you back in May, you said it may take 10 years for the majority of America to try plant-based options. Do you think it'll still take 10 years?
No, I take that back. I think with the trajectory that we're moving in right now, we have a really good opportunity to get more people excited. And what does that take to happen? It takes us infusing the business into the culture and entertainment. It makes sense to make sure that people are aware and helping to open up their consciousness with opening up more Slutty Vegans. I believe that we are in a progressive space in America now where people want to live better, mind, body, and spirit. And if we could start with the food element to help people to reimagine food, I honestly believe that it can take 5 years or less.
All right. Thank you so much for that. I've got to tell you, I was researching this story last night and I was telling Brooke, I need one of those locations in my neighborhood because I wanted one so bad. Pinky Cole. In Manhattan on the Upper East Side. So plan on one there, please. Can't wait to try it. We will leave it there. We will leave it there for right now. Pinky Cole, vegan restaurateur. I'm not going to say the name of the restaurant, but everyone knows it now. We all know what it is. Thank you so much for your time, along with Brooke De Palma. We've got much more coming up ahead. Over to you, Alexis.
All right, thanks a lot. That was a fun one, guys. Coming up next, Draftkings earnings beat the street. So why is the stock getting beaten up today? We take a look next. Welcome back. Looks like investors are dumping shares of Draftkings today. The stock is one of our top trending tickers on the Yahoo Finance site. It is down now more than 19%, and that is despite the online betting giant posting strong earnings. Yahoo Finance's Josh Schaefer joining us now with what's got investors running for the exits. I have a feeling it has something to do with their outlook, Josh.
It definitely does, Alexis. So as you mentioned, Draftkings actually beat revenue estimates for the fourth quarter. Revenue came in at $473 million versus the $444 million expected. And the company's full year 2022 revenue guidance also beat estimates. And considering the increased legalization and growing betting handles we've been tracking over the past couple of weeks amid the Super Bowl, this isn't exactly shocking. But with these sports gambling companies, it's always about the profit, and DraftKings' profit is worrying investors. So DraftKings reported a wider than expected adjusted EBITDA loss for the full year of 2022. The company projects an adjusted EBITDA loss of $825 million to $925 million, and that's about $250 million more in losses than the street had been expecting. So with the recent sell-off in unprofitable tech, it seems investors just don't want to be along for this ride with DraftKings anymore, and the stock dropped about 20% today. So interesting to note, with the positive trends we've been talking about in the industry, as I just mentioned, the handles are growing. It seems like more people are interested, more states are opening up. DraftKings is opening up all over the place, but it's the customer acquisition that we're seeing being the problem for DraftKings. The gambling market has proven to be very expensive. It's competitive. There's a lot of other companies in this space, and these sportsbooks are spending so much money, and it's not going to be profitable in the short term, and investors are starting to wonder if it's going to be profitable in the long term. An example of some of these promos we've seen from the company, I mean, right now you can go on the app, you can bet $1 on an NHL or NBA game and win $150. Last week, you could bet on the Super Bowl, you could bet $5 just to pick the winner straight up and win $280. These are not normal sports lines. These are promoted. DraftKings CEO Jason Robbins was on with us last week and told us the goal is to move over these illegal gamblers to the legal market. And in order to do that, you kind of do need to provide these promotions. But the question is, how many promotions are too many promotions? And right now it seems like DraftKings might be doing maybe too many promotions. They're getting the users. They've reported about 2 million monthly users in the fourth quarter, which was right in line with estimates. But the question is, can those users stay on? Are those users going to be there in a year? Because if they're there in a year, then the house might turn positive on them, and then DraftKings might be in the position that they hope to be in come 2023, 2024.
Hey, Josh. So it's Karina here. So what happens next for DraftKings, and which other states could be opening up soon that could help drive business? I know the big prize is California.
Yeah, Karina, exactly. I mean, we're looking at California, maybe Florida this year. If one of those states opens, that could definitely help DraftKings a lot. And what's going to be interesting, too, is to check the other big state that just opened. New York's been open for a little bit over a month now, and DraftKings posted a little bit under a $600 million handle there and has about $47 million in revenue in about a month there. We just went through the biggest sports betting month you can go through with NFL playoffs and the other sports going, the Olympics, and all the promotions DraftKings was running. The question is, as we move forward and we get out of those promotions, once we get past March Madness in April and May, is DraftKings still posting these big handle numbers and these big revenue numbers in the state of New York? If they are, then that means those big markets like a New York or a Florida might be able to turn positive quicker than people thought, and then DraftKings business is booming. But right now we need to just keep an eye on how those revenue numbers keep coming out and not necessarily the handle numbers. The handle numbers are going to keep being big. People love the promotions, but that doesn't necessarily help DraftKings bottom line, and investors are making the stock pay for it today.
Yeah, good point. That's when the real test in the end, right, for their business model. All right, Josh Schaefer, thanks so much for that. Well, Karina, I can't believe the 2 hours is up. We had a packed show today.
Absolutely, absolutely. I'll do it from myself and Alexis Christoforous on this Risk Off Friday as investors try to digest all of the geopolitical tensions that we are dealing with. But stay with Yahoo Finance Live because our colleagues will take you to the closing bell and to those remarks from President Biden expected at about 4 p.m. Eastern. Stay with us.
Stocks are sliding to close out a volatile week in the red, with Russia and Ukraine tensions still in focus. U.S. officials said Russia has built up some 190,000 military personnel in and near Ukraine. President Joe Biden is set to address the conflict at 4 p.m. Eastern this afternoon after speaking with NATO allies, and we'll bring you these remarks live. Plus, the housing market is heating up as buyers try to get ahead of rising rates. Existing home sales unexpectedly leaped to the highest level in a year at the start of 2022. We'll get an outlook on the residential and commercial real estate markets with the CEO of Marcus & Millichap. An NBA All-Star Weekend kicks off in Cleveland today, and the resale site StockX is gearing up for a busy weekend of hype collabs. We'll preview the event and tell you what's in demand with the Chief Marketing Officer of StockX in a bit. I'm Emily McCormick here with Brad Smith and Rochelle Akufo. You're watching Yahoo Finance Live this Friday, February 18th. And Rochelle, over to you.
All right, Emily, taking a quick look at how the markets are doing right now. The major indices all in the red, though doing better than they did yesterday. Still, we're seeing the Dow down by just over 17 points. We'll see how they fare at the close. But for more on how the markets are doing, let's turn it over to our very own Jared Blickery.
Well, thankfully, we are off the lows, and we can see the Dow and the S&P 500 down by only 3 basis points, so almost in the green yet again, but not for the week. Let's take a look at the Dow here, still underwater by over 1%. S&P 500 underwater by about 0.9%, and the Nasdaq down the most today, only 0.4% right now, almost 1%. So kind of pairing some of the losses from the week. And let's take a look at the sector action. I think it's telling that we got staples in the lead. That's kind of a defensive setup, but we also have materials, financials, real estate, and discretionary. All of those are outperforming, all of those in the green. Energy down just a bit. Crude oil, by the way, having its first negative week in performance of the year. Industrials, tech, healthcare also flagging, but really not seeing any big losers, at least at the sector or index level. But you take a look at what's happening with Chinese stocks, kind of a different story. A lot of these under pressure. The latest news is that Chinese authorities are forcing the ride-hailing companies and the delivery companies to be a little bit more price competitive. And you can see the result of that, down 15% for Meituan today. And here's what happened year to date, down 17%. Most of those losses coming from today. DD also affected. We see that stock down 4% today, 18% for the year. And let's take a look at the ARC components, because those have been getting hit lately and also today. Roku is an earnings story that we've been talking about all day. Let's take a look at the 5-day price action. Roku having to step up its capital expenses in order to be competitive, and also Draftkings, disappointing numbers on their subscribers. Announced during their earnings call, they're down 22% this week, most of it coming today. Now, we do have some other movers in the semiconductor space. We're looking at Intel, that's down 4.5% after a little bit too much excitement on Intel's performance at its investor day yesterday. Analysts a little bit skeptical, but seeing some green nonetheless. AMD up over 2.5%, Microchip up 2%. In the software sector, mainly red. We're seeing Snowflake down 2%, although Cisco, after beating on earnings with a favorable outlook, that stock is up 3%. So really the entire market is trading on what is going to happen in the Ukraine, along with some fundamentals in terms of earnings, and also the Fed. Didn't even mention the Fed just yet, but that is definitely top of mind as well, guys.
All right, Yahoo Finance's own Jared Blickery. And joining us now for more on today's market activity, we've got Paul Schatz, who's the Heritage Capital president. Paul, you heard from Jared there with regard to today's move, but broadly in context of this week as well. And particularly, you say that this bottom is hard to call. Of course, we want to be perfect and always call the perfect bottom, but this one more difficult, even if we did move off of that 34,000 level, which was kind of a key support line for the Dow Jones Industrial Average. When you think about what makes this more difficult to call, or this bottom more difficult to call, what is at play?
Sure, and thanks again for having me. Since the Christmas bottom of 2018, the various pullbacks and corrections have looked like a V. Market came down, very spiky. Market went literally right back up. There was no pause. Prior to the fourth quarter of 2018, most bottoms were more diffuse, meaning bottoms weren't points in time. Bottoms were like a mattress top where you sunk into, you came out of it, you sunk into it. Price had like water, price had to find its own level. So this market right now looks similar to other Fed-induced declines. To me, this is 90% driven by what the Fed is going to do, this decline. If you look back at the first quarter of 2018, you had a decline in January and then a more diffuse bottom over 3 months. If you look back at 2015, 16, you had really 6 months of the market trying to find its equilibrium. And all the way back in 1994, when I was in the business for 6 years already, and you guys maybe not even born, the market took an entire year after the Fed surprised the market with a rate hike and many rate hikes and before it found its footing. This is another one of those situations where people should be, my 3 key words for the year were patience. You got to be patient this year because it wasn't going to be a great year. Frustration, bulls and bears both get frustrated. I think we've seen that already. And quality, which we can get to another time.
I appreciate the extra youth. I'm not that young, though, unfortunately. However, when we think about what is at play right now, and particularly what you mentioned with the Fed, what does this kind of put them in the position of? Do you think they have to front load, or now, because of the international conflict, do they need to push out some of that tightening and perhaps put that on the back end of their strategy?
As I normally do, I have very anti-consensus contrarian opinions. First of all, the Fed is not going to backload this. The Fed is geared up, reared up. They're wrong. They should have been doing this starting in the middle of 2020. So, and I've said that for 18 months now. The Fed is going to go full steam ahead in what, 4 weeks or so. And they're going to raise rates, and they're going to raise rates again and again, at least 2 or 3 times. I do think ultimately the Fed's going to blink, and I think they're going to blink later this year, and that's going to be the impetus for the next leg higher in the market in 2023. But no, the Fed is not going to backload this. They don't have much credibility now anyway. If they did not follow through on what they've all been saying publicly with multiple rate hikes and then the balance sheet reduction, balance sheet sale, that they would have negative credibility. So they're going to go full steam ahead. And it's kind of where I see this bottom ultimately forming. Today, the action today is pretty good. If you're a short-term nimble trader, you can try to time this and play this, and you just get out if, frankly, we close below today's lows. But I really see this bottom wrapping up somewhere plus or minus a week around the Fed meeting in March.
Paul, you mentioned the Fed is really what the market is responding to right now, but there still has been volatility in response to Russia, Ukraine. Now, FactSet noted today that the combined revenue exposure of the S&P 500 to Russia and Ukraine is only about 1%. Now, given that, how much of a direct impact would U.S. companies see from a potential Russian military invasion into Ukraine?
So since this geopolitical event began, I said the decline is 90% Fed and 10% everything else. Look, this is not Iraq invading Kuwait Part 2. We don't have a national interest in Ukraine. What could happen would be a tragedy with insane loss of human life, but it's not going to impact GDP growth, which is slowing. It's not going to impact earnings growth, which is slowing. It very mildly impacts the energy markets, which probably roll over or go sideways anyway. So for me, I think investors are way too focused on Russia and Ukraine. Their eye is off the ball. The ball is the Fed. Look at what leads and lags, rallies and declines. It's not a geopolitically led market. This is all about the Fed. If people don't wake up to that, their portfolios certainly are going to take it on the chin. This market, I said this in October, November, December, January, it's a sell the rally and selectively buy the dip until we get through at least July 4th. Because I think the Fed, again, Fed's going to blink second half of this year. They're not going to do 6, 7, 8 rate hikes. They're going to blink. Markets are going to applaud. We're back on our merry way in 2023, later in 2022 for sure.
So where are those areas of the market then where you would be selectively buying the dip, like the ones that we've been seeing recently?
So I think it depends on what kind of investor you are. If you're a nimble short-term trader, frankly, you buy what's been beaten down the most and you sell the first rip. That's what a very nimble short-term person does. If you have a little more length, if you have a longer time horizon, into weakness for now, you want to buy some stuff that will do okay because GDP growth and earnings growth are slowing. I like things boring, stodgy, not sexy and exciting like staples and utilities. People will yawn and say, oh, some old guy's talking about stuff that doesn't really do anything. But this is the kind of stuff which should do well in an environment where growth slows down. And the other one is biotech, which you're going to look at me and say, it's been decimated. And you're right. Biotech is to the point where it's so bad, it's becoming good. It's the hold your nose, it's aggressive, close your eyes, let it run 6 to 12 months, and I think you'll be okay. And let me say this, Cathie Wood's been beaten mercilessly in the media. Now, maybe with good reason because of her bravado over the last couple of years, but even something like her ARC ETF, for the nimble trader or someone who puts a small amount of money into it, when it bounces, whether it's here or 10% lower, you're going to get something like a 20 to 50% bounce pretty quickly. And her companies all aren't going out of business. They're not going to, the ETF may go down further, but sentiment is so negative, it probably bounces first.
And picking up on your optimism on biotech, we did see that it did become cyclical during COVID-19, which obviously isn't usual. And with COVID-19 starting to abate, at least in the US, we do expect that to change. It's still very undervalued, but we're also seeing a lot of limited M&A activity in this space. What is the biggest appeal for biotechs for you right now? And what could potentially change that?
A lot to unpack there, but I'll try. To me, the biggest appealing factor of biotech is that it has been decimated. They threw the baby out and the bathwater out and the bathtub out. Anytime that happens in any sector, when sentiment is literally scraping the bottom, you can't find a bull. And who is left to sell? Because they've thrown out the real gems. So you get why a Moderna has been thrown out, right? The pandemic is kind of cresting and we're moving on to the next phase and so on and so forth. But you've got real companies with earnings. You've got Amgen and you've got Biogen and you've got a whole stream of biotech companies that have nothing to do with the pandemic, and they've just been thrown to the wolves. Some of these stocks are down 60, 70, 80%. So unless you believe this is a new paradigm and biotech is going to be some kind of dog for the next 3 to 5 years, again, you close your eyes, you hold your nose, because the catalyst to me is not apparent yet. Right now, the two catalysts are it's been decimated and sentiment is awful. And that's usually what turns a sector. The kind of upside catalyst where it really gets going, you find out down the road when you look back and go, wow, I didn't see that one coming.
Well, certainly great having you on. Great energy there too. Paul Schatz there, Heritage Capital's president. Thank you so much. All right, up next, a quick markets check to see how oil is faring and a deeper dive into the Ukraine-Russia standoff. That's next. Welcome back. You're watching Yahoo Finance Live. As we take a look at how the markets are doing on this down day, we're going to focus in on what's happening with oil. Now, we're seeing Brent crude is in the green today so far, up just under 50%, 0.5%, sorry. And then we're also taking a look at what's happening with crude oil. Now, that's down. So we're seeing a mixed picture there for the oil markets. Now, as we look at RBOB, see what's happening with the gasoline there, that is also up for the day at about 0.8%, just under.
Tensions between Russia and Ukraine mounted further today as U.S. officials flagged that Russia had implemented its largest military mobilization since World War II in and around Ukraine. For more on this topic, we have Elizabeth Braw, Senior Fellow at the American Enterprise Institute, joining us now. Elizabeth, thank you so much for your time this afternoon. We've been whipsawed this week by headlines on Russia and Ukraine. The latest developments suggest that Russia has built up its military personnel in the region, and yet diplomatic channels do still appear to be open. What is your read right now on the situation?
It's an extremely volatile situation, and what a difference a few days make. At the beginning of the week, we thought Russia might be pulling back some forces from the Ukrainian border. Turns out that was incorrect. The Russians said they were doing it, but Western governments then presented evidence to the contrary, and there now seems to be a much larger Russian force at the border. And on top of that, we're seeing various incidents directed against Ukraine that are difficult to establish who's behind them, but they are happening nevertheless. And we have seen also an attack on a Ukrainian preschool. So all of that is happening, and it's of course short of war. There has been no invasion yet, but it's certainly extremely concerning to Western governments, to governments around the world, and of course to the business community. And as a result of all of this, this week, the Joint War Committee and Insurance Committee declared that the Ukrainian and Russian parts of the Black Sea and the Sea of Azov as well, that they are they are extremely high risk. And so we'll see if it's even possible for shipping to continue into those waters.
And I want to pick up on that subject because, as you mentioned, the Insurance Board, the Joint War Committee, placing parts of the Black Sea as well as the Sea as Azov in its top risk category this week. How would this impact shipments into and out of Russia and Ukraine? And would this potentially have spillover into Europe and potentially other bordering areas as well?
It's a potentially extremely important step. And the Joint War Committee, it's not a government committee, it's an insurance committee. But of course, if shipping, if you want to send anything by ship or indeed any other means anywhere, you need insurance. And this insurance body, which is advised by military experts and intelligence experts, has established that it's just not safe enough for shipping to continue as usual into the Russian and Ukrainian parts of the Black Sea and the Sea of Azov. And we should remember that Russia has other ports, Ukraine has no other ports. So this could be potentially crippling for the Ukrainian economy, since it will have no other way of getting those goods other than by rail and air. And that's, of course, much smaller volumes that can be transported that way. So when the notice period ends in a few days' time for this insurance decision, we could see far fewer deliveries of crucial goods to Ukraine.
And you alluded to this in your first response regarding eastern Ukraine, but we've been hearing of increased shelling in recent days. And today, pro-Russian separatists ordered that women, children, and the elderly evacuate to Russia and alleged that Ukraine was preparing a military offensive. Now, Ukraine denied these accusations immediately, but how should we be interpreting what's happening in East Ukraine and how this might inform what happens next with these tensions?
It's an incredibly toxic mix of disinformation and very subversive attacks. And the challenging thing, the challenging aspect for those of us not in eastern Ukraine and not in the affected towns is that it's very hard to verify who's behind these attacks. And so what the Russian government is putting out regarding Ukraine may or may not be true. Most likely it's not true. But the Russian government is putting out a lot of information, and it's left to us, the recipients of that information to try to establish what's going on, and it's happening all at extreme speed. There is information, pieces of information coming out all the time, various mysterious incidents all the time, and it's all short of an invasion, but it's still extremely concerning because this being Ukraine, the Ukrainians at some point may decide that they want to respond. They can't allow such a toxic mix of various forms of bullying to continue. So it's a really tense standoff, and we're heading into the weekend, including the 20th, when the US government and others have warned that Russia may stage an invasion.
Right. And of course, as you mentioned, we are still short of an actual military attack, even though we do have those reports of military builds occurring by Russian troops in and around Ukraine. But as diplomacy continues, what could a potential deal that effectively de-escalates these tensions actually look like?
Well, in the best case scenario, Vladimir Putin would decide that he has harmed Ukraine to the extent that it wouldn't be an embarrassment for him to pull all those forces back from the border. We have to remember he's trying to weaken Ukraine. We are not sure that he actually wants a chunk of Ukraine. He wants a weak and compliant Ukraine that is not capable and eager to join the West. And considering all the damage that this standoff has caused to the Ukrainian economy already, he could make the case that mission accomplished, he'll pull back. But he could also decide that this is the best opportunity he will ever have to march in because Ukraine is still not a member of NATO. It's still not militarily as strong as Russia. It's stronger than it was in 2014, but not as strong as Russia. So he could decide that this is the moment. But I think most likely he will decide that he doesn't need a full-scale military invasion, which brings us back to what President Biden mentioned a few weeks ago in his now infamous press conference. He mentioned minor incursions. Well, that could well happen. And then how are we going to respond?
All right, we'll leave it there for now. Certainly something we are keeping a close eye on as we continue to await those remarks from President Joe Biden at 4 p.m. Eastern on these tensions. But Elizabeth Bra, Senior Fellow at the American Enterprise Institute, thank you so much.
Coming up, everyone, big pivot here. Something to look forward to this weekend. The NBA All-Star Weekend festivities kick off today in Cleveland, which means the super rare sneakers will be out to play. Our next guest joins us live from the StockX factory on the other side of the break.
Stocks are on track to post back-to-back weekly losses, and let's take a look at where the major averages are trading with about 34 minutes left of today's session. Now, the Dow Jones Industrial Average is currently down nearly 200 points, or about 0.6%. The S&P 500 down 0.6%, and the Nasdaq Composite, the laggard during today's session, down 1.1%. Now, taking a look inside the S&P 500 by sector, the information technology, energy, and industrial sectors are the laggards during this afternoon session, whereas consumer staples and materials are holding on to narrow gains. But let's also shift gears and take a look at the CBOE Volatility Index, or VIX. We are seeing this coming down from its highs of the session, now down back below 28. At session highs, it had been above 29 as we continue to monitor the latest on tensions between Russia and Ukraine.
Well, as the basketball world shifts its attention to Cleveland, Ohio for All-Star Weekend festivities, fashion and culture marketplace StockX is positioning itself in the middle of the action. And joining us live from the StockX factory in Cleveland is Dina Bari, who is the Chief Marketing Officer of global resale platform StockX. Dina, great to have you here with us today, and thanks for taking some of the time. We know it's busy out there, but talk to us about All-Star Weekend and this investment. Why did this blitz make sense to execute now for StockX?
Hi, Brad. It's great to be here, and it's such an exciting weekend in Cleveland. The All-Star Weekend is such a great celebration of basketball, but also of community and all the people who contribute to current culture. We've got fans here, we've got athletes, we've got creators and artists all coming together in our factory, which is an activation that is playing off of Cleveland's roots as an industrial city, and is also playing off the idea that we all contribute to the creation of culture. And so we're really just trying to create a moment where people can come together, interact. There's customization of product, there's product drops, there's a sneaker drop off for StockX sellers. And there are partnerships that we're bringing to life with folks like Tiffany's, the Cavs, obviously, and Daniel Arsham. So it's really about bringing the community together.
So let's talk about the community that's coming together, and StockX as one of the platforms that they continue to have that collaboration or that sense of community around as well. StockX seems to have benefited from word of mouth and the limited drops era, if you will, as well. But for the amount of traffic you do see, for the customer acquisition spend that is necessary for partnerships like this with All-Star Weekend, what type of lifetime value do you see from those newly acquired customers?
Yeah, so we think about our marketing spend in a few ways. The first is, spend that cultivates the brand awareness and that sort of beginning of the relationship for the customer with our brand. And then we think about the more ROI-driven marketing spend, like the customer acquisition spend you mentioned. And the two really play together to create that journey that begins with a great emotional brand experience, then transfers into a more transactional moment where the customer is engaging on our platform, buying things, and then that relationship endures. While we can't talk about specifics, I can say our goal as an organization is to create long-standing, profitable relationships with our customers, and also to create marketing moments that help the customer connect with us emotionally, so they want to stick around, they want to tell their friends about us, they want to help be ambassadors for our brand.
It's a very emotional purchase. I can attest to that as a customer as well. You have a very unique position. You're the first ever Chief Marketing Officer of StockX. What has the data shown you about who the recurring customer is in your resale market, and how does that influence your strategic vision for StockX?
So we have demographically many different segments, many different customer segments. And that's part of the fun of this job, is that you really have to be smart about targeting and tailoring your marketing efforts to our various customers. For example, we have casual buyers and sellers who are really in this space because the products that we sell speak to them, help them express themselves. And then we have people who are effectively running small businesses on our platform, power buyers, power sellers, who really are counting on us to sustain their livelihood. And so we have to cater to both as a marketing organization and as a brand. But if you step back from the demographics, we really believe that there's a shared psychographic curiosity and a sort of obsession around the idea of current culture and the idea of passion points, ideas, values, intersect in order to help really make a statement about what matters to you, the consumer. And nobody does a better job of teaching brands and teaching StockX about this than the next gen consumer, who's led by the Gen Z customer. This is a very passionate, opinionated, strong consumer who has very clear beliefs and who's not afraid to make them clear. And so we are really focused on serving that audience and helping them sort of bring their passion points together with our brand experience.
This is a big time for StockX, not just because it's All-Star Weekend, but also because in the first half of 2022, the anticipation is that StockX will go public, reports emerging in January that banks were selected. How has perhaps market volatility impacted the anticipated timeline? Has that kind of remained intact, at least as of right now, for a public debut in the first half of this year?
Well, we are just super focused on executing against our plan for the long term, really creating an amazing, viable business for the long term and serving and delighting our customer. And so, what's going on in the market, of course, we're watching it, but what we're most focused on and will remain most focused on is executing well and delighting our customer.
Absolutely. All right, we're going to have to check back in the future, and have a great weekend out there in Cleveland as well.
I look forward to checking in again. Thank you.
Absolutely. Would love to. That is Dina Bari, who is the Chief Marketing Officer of StockX, joining us here on Yahoo Finance.
All right, coming up, we're going to be taking a look at what we're watching on this choppy market day in our triple play. That's coming up on the other side of this break.
Time now for our triple play, when Rochelle, Brad, and I each break down one stock we're watching this afternoon. And guys, I'll start things off with Draftkings. Now, the stock is sliding today after the sports betting company reported quarterly results and guidance that pointed to a slowdown in growth. And I counted two main things that investors seem to be punishing Draftkings shares on from this earnings report. Now, first, for the fourth quarter, monthly unique paid customers came in lighter than expected at 2 million. And second, Draftkings Draftkings is forecasting a wider loss than expected this year and said that adjusted EBITDA losses would come in at as much as $925 million. Now, this is something that we've been watching for a while now in the sports betting world. The companies are prioritizing growth over profits and using promotions to try and bring on new customers, even if it impacts their bottom lines and path to profitability. But with DraftKings, it seems like they're shelling out these promotions, posting wider than expected losses, and based on their latest quarterly customer counts, still not exceeding estimates in terms of user growth. So definitely a difficult combination for investors to be digesting at this point.
Yeah,
I mean, it's interesting because usually when you think about gambling, it's supposed to be the house that always wins, but that doesn't seem to be the case with sports betting. As you mentioned, all these promotions, a lot of people betting and doing very well off of it. And even as you look at the sort of choppiness in the overall stock market, I mean, when they were looking at some of the fact that they were looking at the Ebitda guidance more overshadowing this Q4 revenue guidance, the CEO is saying, look, it's a reflection of just an unstable stock market. And he seems to have a lot of faith in the long term. But we'll have to see if, you know, coming off the heels of something like the Super Bowl, we'll see what happens with other sports betting companies as well.
Yeah, that's spot on. And when we think about how the handle doesn't necessarily equate into direct revenue, at the end of the day, it's going to come down to what the marketing spends look like. Are the investors comfortable with how much they're going to continue to spend, as you laid out a moment ago, Emily? And then additionally, with regard to the states that come online, do those states that do activate some of their mobile betting options, do they do so quickly and in such a concerted manner that now you've got a company in DraftKings and many of their competitors that now have to go full-scale blitz with the amount of spending, and that far exceeds some of the expectations from investors as well. So that's something that's perhaps a headwind risk, but it'll probably come a little bit more piecemeal, something that perhaps they can expect or at least anticipate and better forecast for as well.
Now, one of the stocks that I'm watching today is Alibaba, also known as Baba. We saw that it was one of several Chinese e-commerce platforms that was put on the U.S. Trade Representative's notorious markets list. Now, that's for companies that allegedly sell or facilitate the sale of counterfeit goods. And so we know that they also took a hit from Chinese regulators, their Meituan delivery service being asked to reduce delivery fees, along with a lot of other delivery companies there. So we've seen Baba shares down 50% over the last year. And by some analyst estimates, it still may not have hit its bottom yet.
Yeah, taking a look at Alibaba, and you looked at the past year timeline, and what's really come into play for Alibaba over that period of time is also looking at where some of the listings, both internationally and on the home front, but especially in China, where many of them had been looking at delisting some of their shares in U.S. markets and having to list primarily in China, what impact that has for the broader and more global kind of investor constituency that they were going after previously when they did go public back in 2014. And so with all of that in mind, I think for e-commerce as a whole, Alibaba, what they've continued to try and show is that they can be and continue to be widely profitable on the e-commerce while also trying to build out their Alibaba Web Services equivalent to AWS, if you will. And all of that in play still has this overhang of what the Chinese government may do and that techlash that's clearly been taking place within the region as well.
Right. And absolutely. If we think about some of the overhang that has been weighing on Alibaba shares over the past year, Rochelle, you were talking about that more than 50% decline that we've seen in the stocks. It is, to Brad's point, the Chinese regulatory overhang. It's also the zero COVID policy that we've seen in China that has really weighed on economic growth there and impacted the consumer and the consumption that we've been seeing in that region, which, of course, comprises so much of Alibaba's overall sales. And it's also, of course, the U.S. regulatory side when it comes to that potential specter of delisting here. Brad, something else that you were also talking about. So I think this has just been an incredibly difficult environment for Alibaba and many of these Chinese internet giants to be operating in. And not to mention that in terms of where growth had been for e-commerce companies from the peak during the pandemic, already seeing a slowdown on that front. So really just a multitude of headwinds here for this company and its ilk.
Absolutely. We'll take another look here at, and I wish I picked a positive stock for us today, Indo, and I did not. I'm sorry. I actually picked Roku today. It's tracking for its worst day as a publicly traded company here. And so taking a look at shares, you're seeing them down right now by about 23%. This is on the back of earnings that we broke down yesterday after the market closed. And particularly, one of the things sticking out to investors, of course, is going to be that drawdown in the growth rate. When we think about the number particularly that they're forecasting for going forward from this particular time. They're forecasting a revenue growth of 35% for 2022. Let's remember, in 2021, they saw 55% revenue growth. If anything, for Roku, what they tried to do over these past 2 years for certain was shore up the coffers of content, making the strategic acquisitions of some of those Quibi titles that were not necessarily going well for Quibi at all, to the point where they did have to offload or license out all of them. And so with all of that in mind, it comes squarely down to, for me at least, in my perspective, what Roku is going to do with its platform, continuing to have some of the manufacturing partnerships that it does, being able to be automatically on some of the devices that make their way into homes, how Roku can continue to exercise that hub and making sure that the content is prominent within there. But at the same time, I think investors really latching on to not just the earnings and the revenue itself, but also what the company is signaling going forward from here, and perhaps that deceleration of growth too.
Right, Brett. And speaking of that outlook, I think what perhaps took a lot of investors by surprise here was the extent to which Roku has been exposed to the supply chain disruptions that we've been seeing across the economy. Because we think of Roku as being the streaming player, but of course it does have hardware on the TV side. And Roku's chief financial officer, Steve Loudon, did tell Bloomberg in an interview that he sees supply chain disruptions relating to the TV market persisting into 2022. So really something that we're going to continue seeing over the course of this year. And not only on the hardware side, but we're also seeing supply chain disruptions and some of the disruptions to Roku's customers on the advertising side being impacted by this. It's impacting their ad spend that they're actually putting into Roku. So again, a number of concerns here for Roku that are really weighing on the stock post-earnings results yesterday.
And really adding to that, you have to ask yourself, I mean, is this overestimation coming home to roost? I mean, Roku is up against some of the biggest competitors. You have Amazon, Apple, Netflix, and Google, who have the added bonus also of having stronger content offerings. And of course, they offer more beyond subscriptions and software. They also have a lot more money, and they have a deeper pool of engineers. And so, as you mentioned, if you couple that with things like supply chain issues, I think Roku might be in a bit of trouble here in terms of how it's going to compete going forward. Now, it has been doing well in some of its sectors, but when you think about who it's up against and how things might perhaps change as people sort of return to work and maybe not at home as much, we'll have to see if they can keep up with the big boys.
Yeah, they tried to be a standalone solution and formulate the right partnerships along the way. But when you're going up against some of those ecosystems that you mentioned, Rochelle, certainly an uphill battle there for sure. We're going to keep a close eye on all of these companies that we brought to your attention going into the close. Switching gears, though, in a key week for economic housing data, home builder confidence, it declined while existing home sales rose. The CEO of commercial real estate company Marcus & Millichap joins us with their outlook for residential and commercial properties next.
As the broader market continues to languish in the red this afternoon, let's get a check of real estate stocks. This morning, existing home sales came in much higher than expected, in fact, reaching the highest level in a year at a seasonally adjusted annualized rate of 6.5 million. That was good for a 6.7% month-over-month increase. Now, on the heels of that, the S&P 500 real estate sector, as you can see on the screen, is still lower on the day, but also off session lows and also outperforming the broader S&P 500. Now, for the year to date, however, the sector is still the worst performer after communication services, with prospects of higher interest rates weighing on many real estate stocks. But taking a look at two home builders specifically, we are seeing shares of KB Home as well as Toll Brothers coming well off session lows. Toll Brothers shares have actually now turned positive. So one part of the market that we're continuing to watch closely is that real estate sector.
Lots of data there. We know that existing home sales jumped 6.7% in January to a seasonally adjusted annual rate of 6.5 million. Now, this also comes amid record low inventory, with homes often getting snatched up in a day or two and leaving less affluent buyers out in the cold. Well, to break down what's happening with the housing market, let's welcome Hassam Naji, Marcus & Millichap's CEO. Thank you for joining me.
Thanks for having me on the program.
So I want to first start by getting your reaction to some of this data. Obviously, looking at this 6.7% surge in existing home sales, median existing home prices up 15.4% on the year to 350,000. In this competitive market, though, what opportunities do you see?
Well, first of all, the number is not surprising given the trends that we've seen over the last year, in that the housing market has had a supply shortage. Unlike the 2008-2009 crisis, where over-speculation had actually created a vast majority of the credit problems that led to that downturn and a recession, real estate on this side of the cycle has actually been a contributor, and there's been no oversupply in housing or in commercial real estate. And of course, the effect of the pandemic has created so much demand for people to work from home, expand their living spaces, and so on. We're seeing the same phenomenon carry out in apartment rentals, which are also registering record demand and rent growth. So where does it go from here? We do have some concerns in that affordability is becoming an issue. Less and less people will be able to afford the 15.5%, 16% price increase that you just mentioned on a year-over-year basis. On top of that, as interest rates go up, of course, that affordability becomes even more acute. But the supply side of the equation is still constrained by the supply chain issues, labor costs, and so on. So again, supply demand is going to be fairly balanced. We don't expect prices to continue increasing for the for sale market at the same rate they have been. So some cooling off of prices, but nonetheless, the market is fairly stable. On the commercial real estate side of the equation, because of low interest rates and the fact that commercial real estate as an investment vehicle has always been viewed strongly as an inflation hedge, we continue to see record demand from investors wanting to invest in apartments, office buildings even, shopping centers, and in self-storage assets, every category of commercial real estate.
So then, as we talk about the Fed here, you've said that a significant rapid increase in interest rates by the Fed could weigh on commercial real estate investment. What sectors are the most exposed, and how are you advising your clients to really brace for potentially 4 to 7 rate hikes this year?
Well, first and foremost, you have to remember the 10-year Treasury yield has already ran up quite a bit this year, and the market has adjusted fairly well. Lender spreads have come in, and what's really important for commercial real estate investments and valuations is the pace by which interest rate increases are met with rent growth increases. If the income and occupancy of these assets are healthy and growing at least the same pace, if not faster, than the rate of increases in interest rates or the cost of debt, valuations are well supported. So far, that's what we're seeing. The biggest risk is if the Fed goes too far too fast or has to react even more aggressively than anticipated to basically fight inflation. And I think we need some time to see if that's going to be necessary or not. Let's not forget that we're coming off of a significant recovery in jobs last year. Now the pace of job growth is slowing. Therefore, wage growth should probably begin to crest a bit. And the supply chain at some point is going to start easing again. So it's not a foregone conclusion that the Fed will have to really overplay its hand.
Now, I want to talk more about commercial real estate and really the record-breaking amount of investment we saw last year. Investors bought more commercial real estate in 2021 than ever before, and a record $335 billion just into apartments across the United States last year. But then you also have renters who want to become first-time buyers because the rents are increasing and a lot of leases are coming to an end. So what is your outlook for the apartment market in 2022? And what are some of the headwinds that you're watching for?
The outlook for apartments is quite robust because, as I mentioned earlier, the for sale housing affordability issue is going to become more of a problem. If you look at some of the metros like Austin or Salt Lake City, Phoenix, Los Angeles, even San Jose, the Inland Empire here in Southern California, they've registered price increases of 19, 18 to 28% on a year-over-year basis. A lot of consumers are going to get priced out of the for sale housing market and will have to continue renting. And a lot of consumers we've seen over the last 5 years, pre-pandemic, really were choosing to be renters to have the flexibility in the lifestyle that they've enjoyed as renters. And the apartment development community has responded by building product that the 30-somethings, 40-somethings, couples without children, or empty nesters really want to rent. Those trends have captured more renters than ever before. And for those reasons, the outlook for apartments is quite robust for 2022 and beyond.
And speaking of trends, we're seeing obviously Omicron-related COVID rates continuing to fall in the US. We're seeing a return to either in-person work or some sort of hybrid work from home in-person model. What are you watching for in the office market? And what are you seeing with the best and worst performing markets for vacancies?
The office market still has a lot of cloud over it, especially in urban America, where the vacancy rates are still very high. And of course, the pandemic affected urban markets much more severely than suburban markets. And the outmigration that we've seen was happening even before the pandemic. The millennials that were really fueling the demand for urban housing and professional service jobs, office jobs, were beginning to enter their 30s, forming families. 60% of them are now in their 30s, and they were already moving to the suburbs before the pandemic. And the pandemic, of course, accelerated that trend. So the office outlook is somewhat mixed in that you still have leases on average in place where the tenant has to pay the rent for another 4 years. So we have plenty of time for there to be a recovery in demand. But public transportation, getting people comfortable to come back into the office is going to take some time. We believe it'll happen over time, but the hybrid solution, workplace solution, is here to stay. We're experiencing it. Every one of our clients in some way is experiencing it. So it will reduce office space demand. But let's not forget that places like New York, Los Angeles, were the leading job creators in the last 12 months. 300,000 jobs in LA, 200,000+ jobs in New York. Dallas was the third largest job creator. So the urban markets are beginning to come back. And I think business formations that we're seeing at record levels will eventually bring new demand to the office market, but it's going to be a bit of a transition time. We're seeing a lot of opportunistic investors take advantage of office right now being the diamond in the rough.
We'll certainly have to keep an eye on that. We'll have to leave it there. Thank you so much. Hassam Naji there, Marcus and Millichap's CEO. Thank you so much.
Just minutes left in today's trading activity. Some of the key levels to watch going into the closing bell coming up next.
Welcome back. Just a few minutes to go before the closing bell, so let's check in with Yahoo Finance's Jared Blickery. Okay, well, we'll take a quick look here. We're seeing that the markets, they have been down most of the day. Right now, the Dow down about 0.7%. The S&P also down about similarly about 0.78%. And the Nasdaq also in the red, losing about 177 points. We'll have to see if that continues.
Welcome back to Yahoo Finance Live, everyone. Just seconds away from today's closing bell. Brad Smith here with Rochelle Akufo and Emily McCormick, and standing by for analysis of today's session and this hypersensitive trading week that we've had. We've got Ryan Dietrich, who is the LPL Financial Chief Market Strategist, and Francis Stacey, who is the Optimal Capital Director of Strategy. Great to have you both. We're going to come back to both Ryan and Francis in just a few moments here. Take a look at the major averages here as we're going into the closing bell. You've got the Dow Jones Industrial Average right now down 0.7%, 243 points in decline on the day. The S&P 500, that's down by about 0.75%. NASDAQ 1.3%. Here's the closing bell.
And that is the closing bell. We made it, guys. It's Friday, February 18th. And taking a look at where stocks are going to settle today's session, a lot of red across the screen. The Nasdaq Composite down about 1.2% and making our way up the screen here. The S&P 500 down by 0.7%. The Dow Jones Industrial Average down by more than 200 points, or about 0.7%. Now let's head back over to our panel. Do want to let you guys know that we are awaiting remarks from President Joe Biden, slated to begin any minute now on the Russia-Ukraine tensions. But with that in mind, Francis, I'll turn this first question over to you. With the volatility that we saw over the course of this past week, how much of this do you think was in response to the uncertainty now about Russia and Ukraine? And how much do you think is still investors digesting what may be the Fed's next move?
I really think most of the Russia-Ukraine volatility occurred in the energy space, particularly with oil. I think the rest of the volatility in the broader market has to do with the Fed tightening conversation. You know, now a number of firms are coming out with a prediction that we're going to hike 7 times this year. We're now starting to put a balance sheet reduction on the table. We're now having conversations around potentially a 50 bips, hike in March, which those expectations have come a little bit off in the swap market. But we're looking at this sort of aggressive tightening against this backdrop of inflation. And I think that that's what's causing the volatility.
And Ryan, we often go to you and to LPL Financial for historical data on stock performance under certain scenarios. What does past performance suggest about how stocks may handle geopolitical tensions like what we're seeing with Russia and Ukraine?
Yeah, guys, thanks for having me. And TGIF, right? But you're right. I mean, historically, we went back and found more than 20 major geopolitical events going all the way back to World War II. And the funny thing about it, stocks pull back about 5%. After about 3 or 4 weeks, you kind of make up those losses. So we're not ignoring the major geopolitical events that are really swirling in our world right now. What we are saying is if the economy's strong, look at the housing data, look at the recent retail sales data, look at this earnings season that's been extremely strong. This volatility we are seeing, like we just kind of talked about after a huge rally, could be perfectly normal. And the geopolitical is the cherry on top to really add to it. But from an investment point of view, we would think that, a little more volatility, but any major bear market, or is this the end of the bull market? No, we don't think so. And history would kind of side with that.
And Francis, as I bring you in here, obviously, we're still seeing a lot of reaction from the markets with every change that we see in that geopolitical situation with Ukraine and Russia. Why do you think, given the limited exposure directly to the US and the US economy, that we're still seeing a lot of this volatility and it's not really priced in at this point?
Tough question to answer. I mean, I don't know what's going to occur there. If you kind of, drown out some of the noise in the news cycle, you look at the technicals, which is my favorite thing to do. The Nasdaq has been trading in a range from 13,100, to sort of, the 14.3 area for weeks now. And I think it's more around the Fed conversation than anything else. If you look at the S&P 500 and the Nasdaq, they're holding the lows for this year thus far. So if we make a higher low here, we just have to see the strength in that bounce. I do have to say that with regards to the previous comments, there are some anomalies that we should calculate in based on history. Number one, when they hiked rates starting in December 15, through the end of 18, they hiked 9 times, but they did it over that 3-year period. When you talk about hiking 7 times in 1 year, it's that rate of change aspect that starts to hit the markets. And markets will start to try and price that in the best they can. But what they can't price in right now is a lot of credit risk. And so you have the situation where you could see these credit spreads blowing out. The other thing that you have that's quite an anomaly from COVID is you have the comparisons from the second quarter. You've got GDP coming down, and then you've got a couple of percent being taken off additionally against the decelerating comparisons because of the negative 1.3 trillion in fiscal drag this year without any laws being changed. And so we are coming into an environment where you're compressing a business cycle with very large numbers into a very small tract of time, and that will exacerbate volatility. So I agree, the Russia-Ukraine situation, yes, it's a situation. Certainly if we go in there and have a lot of attacks, but this stock market over the decades has survived, as my friend on the panel has said, has survived a lot of these geopolitical tensions. What this stock market is not going to do well with is the Fed tightening into a decelerating economy, and history has also proven that.
Now, Ryan, you're saying that when you add up all these things, whether it's inflation, rate hikes, Russia, Ukraine in the news, you're saying it's important to remember that we're just simply due for more volatility in 2022. Give us your analysis on that and what might perhaps shape that.
Yeah, you're right. I mean, so this is a midterm year, right? We were talking about this a couple months ago, saying midterm years are the most volatile in a 4-year cycle. You see a 17% peak to trough correction in your average midterm year. The first 2 quarters of a midterm year out of the whole 4-year presidential cycle are like 2 of the worst quarters. So the fact that we're kind of weak here and volatile, the news is the news. We're not ignoring it, but it kind of makes sense. And you talk about the whole hiking rates thing. I mean, the Fed hiked rates 8 times in 2004. The Fed hiked rates 17 times in 2004, 5, and 6. The S&P was up all those years, not up a lot, I'll admit, but they were higher. And the idea that the economy is decelerating, we had a 5.7% GDP last year. We're probably going to have 4% this year. So no question, the economy is weaker than last year, but 4% GDP this year, we think is possible with 10% earnings growth. That's still above long-term trends. So there's all these swirling things that are out there. It's not easy. Investors need to realize after the run we've had, more volatility makes a lot of sense. But think of this. When you look at the first Fed rate hike, the last 7 times, 1 year later, the S&P 500 was higher 6 of those times, up about 10% on average. So just because they're hiking, more volatility, yes, into the bull market, we'd say probably not.
Okay, so considering that historical context, Francis, for the market to have its Gloria Gaynor, I will survive moment, when that does hit, people want to know where they should be investing into to set themselves up for when we do have that recovery.
Yeah, I'm a little bit more conservative just in the sense that we're also talking about a balance sheet reduction. The balance sheet has risen to 35% of the GDP, and they're talking about correcting the balance sheet down to 20% of GDP in a very short span of time. And I think that's actually going to have a bigger effect than hiking rates. We've never seen a $9 trillion balance sheet. And those effects from COVID. So remember, after the 9 hikes in 2018, we had a 20% correction, but we also had a liquidity crisis in September of 19 when the overnight rates in the repo market skyrocketed pretty drastically around those corporate tax payments. So that's the challenge, really, whether, in the short term here, could we see, the markets holding some higher lows here and the technical setup for a rally? Sure. I'd like to see the S&P closing again above 4772. And maybe that occurs kind of, watching the economic data come through. And while GDP is historically high, it's decelerating at the fastest rate of change ever. So then we sort of get into that debate whether, the pure level matters or the rate of change. Furthermore, I heard another analyst, no names, talking about rates in the 80s and the Volcker days. Well, if you look at the amount of debt in the system in the Volcker days, yes, interest rates were immensely higher, but they weren't the huge trillions of dollars that we're dealing with in debt markets. And so these little percentages actually move a lot more money around the system. You also have commercial and industrial loans, which have kind of fallen off of a cliff. They've had a recent uptick, but there are several liquidity drains happening in the market right now. You've got the fiscal drain, you've got the monetary policy aggressively tightening, you've got lending that's going down. And so you're just talking about removing a lot of liquidity from the system. I think in the shorter term, we could have a technical setup to go up. We could go up and make a lower high and fail. We could go up and have a double top to all-time highs and fail. I don't see a catalyst for taking out the all-time high yet in the system with all of this liquidity coming out. We have to see what that does to credit markets first.
Ryan, on the other side of that, do you see us taking out the lows of 2022 that we've already seen thus far, and particularly at a time where we still have a few more earnings to get through, especially in the broader retail space where we're waiting for some of those brick and mortar companies?
Yeah, when you look at the S&P 500, we'd say probably not. That was that January 24th flush low. It is concerning, though. We're seeing a lot of the Nasdaq stocks starting to break down, and a lot of small cap stocks have already kind of started to break down. So there are clear concerns like we're talking about. And that's a great point about the credit markets and spreads. I mean, we are starting to see some high yield spreads breaking out to the highest levels we've seen in a while. The smartest guys in the room, I think, are the credit markets. It's not blowing out high, but again, there is some stress in the system. So let's not ignore that. But again, overall market sentiment is pretty dour, rightfully so. There's not been a lot of great news. The headlines are scary. Remember, when the expectations are lower, get any good news. What could catapult us to new all-time highs? I think it's stronger than expected earnings, but also maybe the Fed isn't quite as hawkish as they're making it sound. Instead of 7 or 8, maybe you get 4 or 5 rate hikes. That's kind of the base case we have here. Again, it's going to be rocky and volatile, but we still are optimistic we can get to about 5,000 on the S&P 500 when this year is all said and done.
All right, we shall see if we break to that level. Ryan Dietrich is LPL Financial Chief Market Strategist, and Francis Stacy is Optimal Capital Director of Strategy. We thank you both so much for your time. As we continue to await remarks from President Biden on Russia and Ukraine, let's head over to Yahoo Finance's Jared Blickery, who has some thoughts on this week's volatility. Jared?
That's right. And just to add to that great conversation we were just having about the potential trajectory of the S&P 500 in response to various events, here is a 2-month chart of the S&P 500. And you can see here are those spike lows that we had at the end of January. We came up, not able to reach 4,600. We came down lower low, higher high, or excuse me, lower high, and now we have a lower low as well. So that is the definition of a short-term downtrend. You take a look at a 2-year chart, we can see even a greater. Let's dial this down to a 1-year. You can see on the intermediate time frame, we hit that high or that lower low and a lower high, have yet to see that lower low, but that could come in at about the 40,000 level or the 4,000 level, excuse me. If that happens, you'd want to see a quick plunge and a reaction off of that to see if investors can gain some confidence in the market. Of course, it's going to depend on the headlines. If there's a land war in Europe emerging, probably going to sink down. As Ryan was saying, those tend to be short-term events in the market, 5% down, maybe 7, maybe 10%, but usually not a disaster on those geopolitical events. With respect to the Fed, that's the bigger part of the equation here. I think we're going to get some more clarity around the Fed announcement in March, but we could see a lot of dicey price action until then. So in the meantime, we got to buckle up our seatbelts and white knuckle it with Bitcoin over the weekend. Forgot about Bitcoin, but you got to watch something, guys.
It's true. It's true. Thank you so much, Jared Blickery there. All right, as we await President Biden speaking on the Ukraine-Russia standoff, do stay with us. We'll take a quick break. Stay with us. Welcome back to Yahoo Finance. Any minute now, we're expecting President Biden to give a speech updating us on the latest with Russia-Ukraine tensions. For a preview of what we might expect, let's bring in our very own Jennifer Schonberger. Jennifer, what are you hearing so far?
Hey there, good afternoon. That's right. We are awaiting President Biden, who is set to offer an update on the Russia-Ukraine situation after the president spoke with Western leaders just about 45 minutes ago on the troop buildup along Ukraine's border. U.S. officials saying that troops could now number as high as 190,000. That's up from 150,000. Secretary of State Anthony Blinken has accepted an invitation to speak with his Russian counterpart Sergei Lavrov next Wednesday on the condition that Russia does not invade Ukraine. However, Blinken, speaking in Munich at a security conference earlier today, said he's, quote, deeply concerned that Putin has turned away from a diplomatic solution. President Biden, of course, warned yesterday that the chances are very high that Russia could invade, and they could invade within the next several days. The U.S. believes Russia is responsible for wide-scale cyber attacks on Ukrainian banks this week, and that lays the groundwork for an invasion of sovereign territory. They expect that if Russia decides to move forward with a sovereign attack, that will be preceded by more intense cyber attacks. Now, today, Vice President Kamala Harris is in Munich for a major security conference. She met with NATO Secretary General Jens Stoltenberg and representatives of NATO's 3 Baltic states. She's expected to confer with Ukraine's President Zelensky on the sidelines of that conference this weekend. As for the president, he is expected to remain in Washington through the holiday weekend, keeping a pulse on the situation, and is expected to again talk with Western leaders at the beginning of next week. Back to you.
Yahoo Finance's own Jen Schonberger, thank you so much. For more on the situation with Russia and Ukraine, as we await remarks from President Joe Biden, we have our own Yahoo Finance's Rick Newman here with more. Rick, you heard the update from Jen. What's your read on where things stand now and how likely we are to see a best or worst case scenario as these talks continue?
I have no more of an educated guess on what Russia is going to do than anybody else does. People should keep in mind that it would make sense for Russia to apply maximum military pressure and make it look like they're really about to invade with a massive force in order to get the diplomatic outcome that they want and some of the concessions they're looking for. So I think an invasion is not a done deal until it actually happens. But I think one of the things that President Biden has to do is start explaining what's going on to ordinary Americans. Politicians have been paying close attention to this. Diplomats have, journalists have, but ordinary Americans have not been paying close attention to this. And this is going to affect Americans at least through the economy. We're probably going to see price spikes in energy. If something bad happens here, we're probably going to see more of a sell-off in the stock market and more inflation. So, and that's at a minimum. People are also going to be worried what is going on with Russia, a huge military and nuclear power, now starting a ground war in Eastern Europe, if that's what happens. So Biden is going to have to start explaining to the American people in ordinary terms, using the bully pulpit and all the things that presidents have at their disposal, a primetime address or other things like that, to start explaining and reassuring to what Americans about what's going on here. So that may be part of what we hear coming up in the next few minutes from the White House.
Rick, there was a point in this broader conflict when China was even brought into the discussion and the conversation as well. What, if any, significance does that still have to this broader conflict? And is the focus now strictly on what Russia will do in terms of the invasion that is anticipated coming from U.S. officials and the White House?
Oh, I mean, it's a global chess game without a doubt. So China does seem to be tacitly or quietly supporting Russia in terms of whatever they do, because Russia and China operate in similar ways in terms of their territorial interests and in what they would consider to be breakaway parts of their country. For China, that's obviously Taiwan, which declared independence in 1949, but China says Taiwan is part of China. So China obviously watching very closely to see what happens in Ukraine because of the implications and consequences that might have for Taiwan. That doesn't necessarily mean China is going to make a military move to re-annex Taiwan, but it's something that Xi Jinping has talked about. He's more of a hardliner than any of the last several leaders in China. And this, of course, affects the U.S. economic relationship with China, which is much more important than the U.S. economic relationship with Russia. So there are many factors here and second and third order consequences. And if Russia does attempt some type of move, there are going to be many consequences. They're going to play out for months. This is not likely to end in a sort of clean black or white way anytime soon if Russia does cross the border.
And Rick, obviously this is happening during a midterm election year for President Biden. People already sort of pandemic wary. Is this something that the American people, is this something that they are supporting? Do we get a sense of how American people feel about the US getting involved in this and the possible sanctions that might impact the economy?
Again, I think this is something Americans just are not paying attention to this. And one reason they're not paying attention, I mean, look, people are, I don't fault people for not paying attention. People are busy living their lives and getting through challenges. And we know, we talk about this all the time. Inflation is now the top concern for many people who find gas more expensive, food more expensive, rent more expensive. Also, Biden has been pretty clear all along that he doesn't intend to send US troops into any kind of combat mission involving Russia. So I guess people might hear that with one ear and say, well, it's not, at least I don't have to worry about America getting in another shooting war as we were in Afghanistan. But that doesn't necessarily mean this is all going to go Biden's way. I think, one of the things we're not noticing so much right now is that Biden's domestic agenda is crumbling. Democrats in the Senate seem like they've just given up on the Build Back Better legislation. They are now trying to cobble together a few different measures that might make it look like they're doing something to address inflation. No one's really noticing that because Ukraine is now the big story. So if Biden shows what people consider to be strong leadership on this foreign policy issue, it might help his approval rating a little, and it might also distract people from his domestic agenda, which is kind of falling apart. But there's so many ways this could go that I don't think we can predict how this is going to play for President Biden over the next several weeks and months.
Well, and Rick, to that point, is this foreign policy issue now impacting the ability of the Biden administration and lawmakers to make any progress on legislation? Or is this still happening in the background and right now headlines are just being dominated by this geopolitical concern?
No, I don't think foreign policy is getting in the way of domestic issues, but I think inflation is. I think that is really that has just become the top domestic issue for the Biden administration. And if you go back to his plans, the Build Back Better legislation, which included social welfare programs, extending the child tax credit, more help for working parents, green energy transformation, nowhere in that economic agenda going back more than 4 months was there any mention of having to deal with inflation. So inflation has really caught the Biden administration by surprise. And because their majority in the Senate is so thin, it only takes a few Democrats in the Senate to say, look, we need to worry about inflation more than any of these other things. And that's where we're at right now. So I think Congress could do, Congress doesn't really have much of a role on foreign policy. They can, impose some certain types of sanctions or things like that. But this is really the president's bailiwick. And Congress has to fund the government and pass domestic legislation. So they can do all of this at the same time. It's really inflation that is interfering at this point with Biden's domestic agenda.
Given the razor thin nature of the Senate right now, Rick, with the tiebreaker going to the vice president, Kamala Harris, with all of that in mind, it's going to be a midterm election year. We already know that. And so how broadly, especially considering the breakdown of Build Back Better that you just mentioned a moment ago, how much tougher does the administration's agenda get from this point forward after 2022?
Well, Brad, it's even tougher than you just described because the Democrats at the moment do not even have a majority in the Senate because the one senator from New Mexico, Senator Lujan, is recovering from a stroke in New Mexico. So the Republicans actually have a 50-49 majority right now. And the vice president doesn't get to break a tie if it's a 50-49 vote in favor of Republicans. And we're already seeing this handicap the Democrats because they're struggling to get a vote on Sarah Bloom Raskin for that top post at the Federal Reserve. And one of the reasons is the Democrats don't have a majority to get her vote out of committee onto the floor. This could also affect the upcoming Supreme Court candidate who President Biden has not yet named, but he said, of course, he would nominate a Black woman. And Democrats were hoping that would be a real moment of triumph for them. But it's possible that could get snagged with this problem that they don't have a working majority right now. And of course, we don't know when Senator Lujan from New Mexico is going to return. So Democrats had a weak hand at the start when they had just a 1-vote majority in the Senate at the beginning of last year. They have not played that hand really well. And I don't know that they're really going to get anything done in 2022 that they'll be able to brag about to voters as people go to vote in the November midterms.
And as you bring up the inflation concern being the big weight that we have right now for the Biden administration and approval ratings, what connection do you see between the Russia-Ukraine conflict that we're seeing now, that potentially driving up oil and energy prices? Is that the channel through which we could see some of these approval ratings and really take a hit here and stir up even more concerns for the Biden administration as we have inflation already at the forefront of Americans' minds?
That's it, Emily. And it's not just that. I mean, so in terms of energy markets, a couple things to keep in mind. I mean, this is complicated. So the dire scenario would be if there was a full-out shooting war, and let's say a full-out invasion of Ukraine by Russia, and then either Europe completely boycotted Russian deliveries of oil and natural gas, or Russia weaponized its energy supplies and just cut them off to Europe to make trouble for Europe. And that would cause a lot of trouble for Europe, which does not have enough natural gas to start with. So that would be the dire scenario. And we've had analysts like Dan Dicker was on our air this week saying we could see oil prices getting close to $150 a barrel. That I think they're now around 90. We could see gasoline prices here in the United States not just cresting $4, but approaching $5 per gallon. Now that's an absolute worst case scenario. And many analysts think that that's not going to happen because even if there is a full-on invasion, European countries really need that Russian energy, and Russia really needs the cash that they get from selling that Russia to many countries. From selling that energy to many countries in Europe. Plus, there are contracts in place, and Russia doesn't want to be seen as breaching contracts because then it would look like an unreliable supplier of natural gas, and over time, countries that need it might turn elsewhere. So. There's a chance that if there is an invasion, the gas will keep flowing and the oil will keep flowing. But even if that happens, we're for sure going to see another price spike in energy markets if there is an invasion.
Well, certainly a lot to watch there. Thank you for breaking all that down for us as we await President Biden. Yahoo Finance's own Rick Newman there. All right, it's Friday after a very long and volatile week on the markets. Let's check in with our very own Jared Blickery.
I thought we'd start with crude oil futures here since we're talking about energy. This is the 5-day price action down 4%, first losing week of the year. And I think it's instructive that the trend is actually down despite all these geopolitical headwinds and headlines that are coming out. Now, here's a 10-day look. And in fact, this big price spike to the most recent high, the highest price since 2014, that was on these geopolitical headlines regarding the Ukraine and a potential invasion. However, I think that the fact that prices have backed off since then means that we're going to need a new big catalyst. So what is that? Well, if we get a land war in Europe, as we've been talking about, probably that sends it up to test 100. But let's get a really long-term view. Let's get a max view of crude oil here and put some candlesticks on. This is going to go back all the way to 2000, about 2000, so over 20 years. And here's that $150 high that we were just talking about. Dan Dicker says we could get there, but it's probably going to take a while. Not this year, going to be next year, because at the $100 level, as soon as you start getting in here, there's all kinds of historical resistance, and you really need a huge catalyst to push through there. Could it be the Ukraine? If things really go bad, it's a possibility, but probably not. So let's turn to some other markets and see what we did during the week. We'll start out with the S&P 500, and we'll go to the 5-day price action here. You can see down 1.5%, but as I've been highlighting on the longer term charts, we are now probing these lows here and probably going to break them next week unless there's a dramatic reversal of fortunes, either with respect to the Fed or with respect to that geopolitical situation we've been talking about. Now, we can also take a look at the 10-year T-note yield. Now that is down to levels that we haven't seen in a couple weeks. Nevertheless, we are basing by the highs that we have had or that we've made over the last couple weeks that have been 52-week highs as well. So here's a longer-term view of the 10-year Treasury note yield, and you can see there are periods of consolidation and then advancement, consolidation and then advancement, and consolidation and advancement, and it looks like we're in a consolidation phase. So the fact that we don't have to deal with higher yields right now, probably a benefit for the market, but not really benefiting from it, at least as you can see today. Now, as I search for breath here, as we vamp waiting for President Biden, we can see the VIX has been very elevated recently. And let me dial this back to a 6-month chart. Now, we took out the recent highs here from December, and we took those out in late January. Are we going to trend higher? We're going to have to see here, but I think it's a trend worth noting. And if you'd like to look, if we have time to look at some heat maps, we can do that too. Rochelle.
Jared, I'll actually take it for a hot second here. Just briefly, as we're thinking about kind of this no man's land that you had laid out early this week, late last week, where do we find ourselves in relation to that? And especially if the situation does change, as you mentioned a moment ago, where might we see a relief rally push us towards?
Well, let's go back to the S&P 500. That is the benchmark, and that kind of determines the tone of the general market. Of course, the Dow is important. The people's market, the Nasdaq Composite, as it has all those growth stocks, also important, but this sets a tone. So we were in no man's land for about 2 weeks here. We broke down, and then we came back up to test the breakdown level, and we failed from there. So that's a pretty bearish chart pattern. That's why I think we're going to head lower, probably take out these lows next week. But here's a pain trade. The pain trade to the upside comes if there's a significant development that eases these concerns, not only with respect to the geopolitics, but also with respect to the Fed and maybe earnings, maybe some nice earnings surprises. S&P 500 has to clear 4,600 to get to these highs. But as we've been talking about with some of the guests today and throughout the week, I'm not sure that just because we test the highs, we get this new launch to, let's say, 5,000. I think we'll probably test the highs and fail and roll over simply because the Fed is in hiking mode. And I think the Fed does blink later this year in the second half. I think we get a relief rally from that. And that's when I think we go to 4,900, 5,000 in the S&P 500. I don't think this rally is dead yet, but I think we do go lower into the Fed announcement. All this prefaced by the statement that we have huge unknowns, not only on the Fed stage, but also on the Ukraine stage.
And Jared, the stock market is closed on Monday, but as you alluded to earlier, Bitcoin is still trading. We saw prices dip below $40,000 earlier today. We're back narrowly above that level now. How have things been looking for crypto?
Well, it's not bad, but it could be a little bit better. I'll put it that way. Let's take a 1-month view of Bitcoin here, and we can see the latest rally. Let me put some candlesticks on. This is how I prefer to see the market. Here's that 1-month chart. Now, we did get a rise here, and we have the makings of a potential short-term uptrend from the fact that we have a higher high and potentially a higher low, but we have to react from these prices. The fact that we weren't able to get through the 45 to 46,000 level, I think that's instructive. If you take a look at a 1-year chart, 45, 46,000 has been a sticking point. It's been in play a number of times. So the fact that the market is selling off from that, a little bit bearish. To get above this, it's going to take a catalyst. I'm not sure what. Sometimes Bitcoin doesn't need a catalyst, but the intermediate trend is definitely down. This is what we're seeing here. We have the makings of a short-term uptrend, but it is not confirmed. Have to punch through 46,000 and then come back and potentially not sink back below these levels at 40,000 again.
And Jared, also checking in on some of the movement that we saw with Chinese stocks after the United States Trade Representative really weighing in, focusing on Alibaba and Tencent, talking about their perhaps alleged use and selling of fraudulent or counterfeit items. How did Chinese stocks do today?
Pretty bad, and that's not even the news that was driving them. I mean, you put it all together. You can take and pick your headlines for why this cohort of stocks is down on any given day. But today it's all about the ride-sharing, Meituan and Didi in focus as Chinese authorities tried to reel in and force them to make their prices a little bit more competitive. And so here we're seeing this stock, that's Meituan, that's down 57% over the last year. And here's Didi. It didn't IPO exactly 1 year ago, but this is a total performance down 71%. I think if you're holding these Chinese stocks, you can flip a coin as to what the headline will be. A lot of these are oversold. I can't emphasize that enough. We're probably going to see a flashy relief rally sometime this year, and that would be in the K-Web ETF that I track. And let's see, we got that right here. It's down 5% today. Pretty bad day for K-Web, but being down 65% just sets it up for a short squeeze. So I think we're going to get that, but timing this is going to be tricky. And just because you get a short squeeze, probably going to attract new sellers at anywhere between these prices. We got another level here, and of course, the levels here. So I think there's going to be a lot of interest here, but I wouldn't get too excited about a short-term pop.
Yahoo Finance's Jared Blickery, thanks for breaking down everything coast to coast and around the world for us. Jared, we appreciate it in and out of cryptocurrencies as well. Thanks so much. And switching gears back to President Joe Biden as we're waiting for that press conference to take place within the White House. He spoke with NATO allies as Russia has amassed roughly 190,000 military personnel in and near Ukraine. And we're keeping a close eye on the shot here. But prior to the president taking the podium there, we want to bring in Yahoo Finance's Jen Schoenberger, who's got more on what she's hearing out of Washington, D.C. Jen?
Hey, good afternoon, Brad. Yeah, we're still awaiting the president here, who spoke with Western leaders, wrapped up that call about 3:30 this afternoon. So we're about an hour out after that call as the press pool awaits the president at the White House. The White House very skeptical of Russia and its efforts to want to pursue that diplomatic channel as their actions really say otherwise. Biden speaking this afternoon with Western leaders about that troop buildup along the Ukrainian border there. U.S. officials saying that they see somewhere around 190,000 troops. That's up from 150,000. So allies and the U.S. have been saying that they are preparing very strict sanctions to impose on Russia should Russia decide to move forward with this invasion. And we heard this afternoon from White House Press Secretary Jen Psaki saying that this will be one of the harshest packages in terms of sanctions on record. She says the U.S. and the West are going to squeeze Russia financially and isolate them financially, that they are going to face higher borrowing costs, major capital outflows, and extremely high inflation. We do know that President Biden has spoken with Germany's chancellor about cutting off access to that critical Nord 2 gas pipeline from Russia to Germany, which is a critical would be a critical source of cash for Russia, which is highly dependent on energy to fuel its economy. So they have the sanctions package ready to go the minute that Russia if they do decide to invade. So still awaiting the president here. We'll keep you posted as things unfold.
And Jen, as President Joe Biden, of course, earlier warned about swift and severe punishments to Russia, you laid out some of the potential sanctions that we could be seeing, that coordination with Germany on that Nord Stream 2 gas pipeline. I'm wondering what other specific sanctions are potentially on the table here? What have analysts been talking about? Because Russia, what I've been hearing is that the banking system could be taken down from the international SWIFT payment system, that there could be potentially personal sanctions on Vladimir Putin. Are you hearing similar or any other potential sanctions that could be coming down on the country?
Yeah, Emily, you nailed it. SWIFT is definitely one of the issues under consideration there. They are looking to really squeeze Russia when it comes to oil and gas, since, as I mentioned, that's a major driver of their economy. Of course, that could have repercussions for the U.S. as well. And so I do want to note that the administration says that they have been talking with energy providers about ways to troubleshoot that and guard Americans against an increase in gas prices at the pump. But they're sort of holding their cards on the specifics of those sanctions, but they have spoken very sternly about those sanctions, and they do expect, as I mentioned, this to be the harshest package as far as sanctions are concerned in history.
Well, thank you very much. Yahoo Finance's own Jennifer Schoenberger there. As we await President Biden to speak on Ukraine-Russia tensions, I want to bring back in Yahoo Finance's Rick Newman. Following up on what Jen was saying there, in terms of the timing of this, is it possible that Russia is waiting for the Olympics to end before pursuing an invasion?
That's one theory. Emphasis on nobody knows what Vladimir Putin is thinking, but Vladimir Putin and Chinese leader Xi Jinping did get together around the time the Olympics opened. And of course, there were no Biden administration officials there. They had this political boycott of the Olympics. And there's some speculation that Putin and Xi Jinping made an agreement that Putin would not make any kind of aggressive move until the Olympics ended, simply so he wouldn't steal the spotlight from President Xi, who obviously wants the world attention that comes with hosting the Olympics. Now, the closing ceremonies for the Olympics are this Sunday. So if that is part of the calculus with Vladimir Putin, that might explain why he's adding more troops to all these locations surrounding, or at least on 3 sides of Ukraine, and building up his forces instead of taking forces back. So the end of the Olympics possibly is one trigger.
Rick, as you mentioned earlier, it's very difficult for anyone to really predict the next move here by Russia. But what are some of the potential next moves, courses of action that are on the table at this point?
Yeah, and this is an important way to think about it for financial markets too, Emily. So what do investors really need to price in here? So everybody's talking about this invasion scenario. If there is an invasion scenario, then that could go a couple of different ways in itself. Will Russia just try to perhaps annex parts of eastern Ukraine that it hasn't already taken, because that's where Russian influence is the strongest and people identify most with Russian and speak Russian? So could they just try to take a chunk of eastern Ukraine and be happy with that? Or could they go all the way to Kyiv and seize the capital and install their own government, a puppet government? And how far might they push forces into western Ukraine? So there was an article in Foreign Affairs just this week that said, people in the West should be prepared for the possibility that Russia wins. And Russia winning would mean that they take over Ukraine in its entirety, and it becomes a de facto Soviet republic again, much the way Belarus is right now. So that would extend Russia's military presence and political presence further into Europe. It would force major reconsiderations by NATO and by the European Union. It would have major implications for Poland, perhaps for Finland and Sweden, and also for the Baltic states, Latvia, Estonia, and Lithuania. So this has all been fairly calm since the Soviet Union dissolved in 1991. And many of these nations began moving toward the West, and some of them joining the European Union, a few of them getting membership into NATO. But it's possible that what Putin wants to do is destabilize that entire security and economic arrangement in Western Europe and into Central Europe, and kind of roll back the clock and try to undo some of the things that happened after the dissolution of the Soviet Union.
Hey, Rick, considering the metal exports from Russia, titanium, aluminum, platinum, what type of broader impacts could that mean if we did see some type of sanctions on those exports?
Right. Most of the European economy and the U.S. economy, let's call it the Western economy, does not depend on Russia for very much. Obviously, it does contribute significantly to world energy markets, but not for most other things, except for some metals. Aluminum is a big one, and I think Russia exports about 10% of the world's aluminum. So the expectation is, if there is an invasion and there are sanctions by Europe and the United States, those sanctions will probably include prohibition on Russian exports of those products, many of those metal products, including aluminum. Others you mentioned, titanium, palladium, and some others. Those are pretty important to certain manufacturers, and many of those manufacturers already have problems with supply chains and availability of components that have pushed prices up. I mean, think about all the things that have aluminum in them. Cars and appliances are two big categories, and we've seen big price increases for both of those things. So if there is a further shortage or supply chink in terms of something like aluminum, that is just going to mean more inflation. And we talked about earlier in the hour, among the things Biden would have to prepare Americans for if this whole situation goes south is we're going to see worsening inflation, not improving inflation, at least until markets can get a handle on what's really going on here.
Certainly a lot of different scenarios that could play out, though we do appreciate you breaking those down for us. Yahoo Finance's own Rick Newman. All right, turning now back to Jared Blickery, who's going to give us his worst earnings reactions in 2022, and there's been quite a few.
Yes, it has. Facebook is a standout, but many others, and I've been plumbing the depths of not only the S&P 500, but also our top trending tickers here at Yahoo Finance to see some of the worst performers. I just took the top 20, but there are at least 50 companies in my list that had worse than a 10% drawdown on the day following their earnings announcement. So besides Facebook, Facebook is right here towards the lower end. And by the way, on this y-axis, the farther down you go, the greater that loss was on that earnings day. Now here's Lending Club down here, down almost 30%. Then you have 1-800-Flowers. These are two meme stocks, almost there with it. Then we get into some of the bigger cap, well-known names like Roku, Roblox, Facebook, PayPal, all of those off more than 25%, goes all the way up, includes Paramount, the newly named company there, used to be Viacom, Draftkings, Spotify, Illumina, and it goes on, iRobot, Under Armour. So Under Armour actually the least worst off in this cohort, still off more than 12% on its earnings day, and that's just on the earnings day. Also taking a look at the performance year to date, you can see quite the number of drawdowns here. So these are some of our biggest earnings losers in 22, have this heat map carved up here. Facebook off nearly 40% in this year alone, Netflix off 35%, but those are not the worst offenders here. We got Shopify, Roblox, and Roku, each off more than 50%. Some of those just coming into this group today. You can add Draftkings to that, down 37%. So all in all, seeing some really big market moves. And I would say too, I like to pull up a 5-year chart of Facebook. Let's get that going and put some candlesticks in. We can see the last huge earnings drop. Now, at the time, this would have looked a lot bigger, but that red candle was about 20%. You can see the 6 months following that, steady drop down. We haven't even had 1 month of price action since that big drop on the Facebook earnings announcement. So going to have to see what comes, but it's going to take a long time to repair some of these stocks. So not just the geopolitical concerns, not just the Fed, also earnings, but on the flip side, we could also get some positive earnings surprises, which I guess we're going to be hoping for next week.
Absolutely, Jared. And I'm wondering, does the fact that investors are so severely punishing stocks of companies that miss on earnings signal anything about where we are right now in the market environment? And then as a second question, are we seeing potentially an outsized positive reaction to companies that beat on earnings consensus expectations?
Yeah, Alphabet comes to mind. And so let's take a look at Alphabet. That's going to be part of the Nasdaq 100. We saw a big gap up to a record high, not record intraday high, and here's Alphabet right here. There we go. So this is a 5-year chart. Let me actually put this down to a 6-month chart, and we can see here on this new nominal high, that was sold. So even this huge positive earnings announcement, which was more than 10%, that was sold into. So I think that's telling. Where are we in the investment cycle, in the growth phase, the rebuilding phase for a lot of these companies? That's the first part of your question. I think that's very important to consider. A lot of these companies like Roku are investing substantial amounts of money into their CapEx. They're planning for the future, but that's expensive. And as we've seen here, so many of these growth companies, we've seen their multiples compress. A lot of them look cheap, but these are falling knives, and you have to see some positive price action before we do that. Intel is another story. Intel impressing themselves at Investor Day yesterday, but not the analyst community, saying that they're a little bit too bullish on themselves. It's going to take years for Intel to execute on its rebuilding strategy. It's going to take years for Roku to really invest in its future. In the meantime, if you're stuck in these stocks and you still like them and you're willing to hold them, well, that's fine. But just understand they could be dead money for a long period of time.
Jared, while we're thinking about the earnings reactions, is there a sector that has won the hearts and minds of investors overwhelmingly over the course of this earnings season? And I guess to the other side of that spectrum, is there a sector that's lost out and big this earnings season? Yeah,
I'd say just off the top of my head, and we can check this on the Wi-Fi Interactive, energy. Energy is a big winner this year. Year to date, up 23%, flagging a little bit today, but nevertheless, that would be an impressive gain for an entire year. We're only about 6-7 weeks in. Financials also slightly in the green here, but not putting in an impressive performance. But really, it's real estate and communication services and tech and consumer discretionary. All of these sectors off more than 10%. Now, these three right here, these house the mega caps, and we've seen a lot of weakness there. Real estate, very interest rate sensitive. Not surprising to see real estate flagging as mortgage rates are rising. So really about the mega caps and those high growth stocks with those high multiples that are being compressed and their valuation simply coming back down to earth.
All right, thank you so much. Jared Blickery, they're getting us up to speed on all that's been moving markets this week. All right, I want to bring in our very own Jennifer Schonberger there to talk more about President Biden and the call that he had with world leaders. Tell us more about that and the details that are coming out.
Hey there. So we're just moments away from the president, but I did want to bring our viewers some insight into President Biden's phone conversation with many of the Western leaders, including from Canada, Germany, and France. Together, they are expressing deep concern over Russia's continued buildup of forces. And they discussed the importance of offering further economic assistance to Ukraine. They also pledged to consider pursuing that diplomacy path to try to de-escalate tensions. They also said, though, that they are ready to impose, quote, swift, coordinated economic costs on Russia should it choose further conflict. So the U.S. and NATO allies banding very closely together to try to put up a wall against Russia here and force Russia to back down. Again, we are just moments away from the president.
And Jen, while we have you, I mean, this comes at a time where Biden has already faced his fair share of international conflict and policy that he's had to either move forward or step back from. This another flashpoint in that going into the midterm elections. How critical is it for the president to strike the correct tone when he takes the podium today?
Absolutely. This is a critical moment for the president. He's showing a unified force with other Western nations. And if he is able to get Russia to back down on this, that would be seen as a considerable victory for the president. Of course, strong arming foreign leaders like Russia's President Vladimir Putin, obviously difficult to do. So we'll see how things play out here. But the president is taking a very strong stance against Russia here for sure.
And Jen, based on the readout from this conversation that you had a chance to go over, does this, do you think, move the needle on the outcome that we may see, or does this reaffirm previously telegraphed scenarios on where we are right now with Russia-Ukraine tensions?
Yeah, based on the information I just have from this readout, and again, we'll get more from the president, it appears that Western leaders and the U.S. are reaffirming their stance. I'm not seeing any major change here, but again, we'll hear from the president to see if they're escalating efforts.
And Jen, as we know, Ukraine is not part of NATO, but obviously you have a lot of these NATO countries trying to weigh in to really figure out a balancing act here. How are they managing that based on what you heard in the call?
Yeah, so as you mentioned, Ukraine not officially a member of NATO, but they have sort of a path forward to try to become part of NATO. And it's critical to ensure international peace and stability that the U.S. and Western allies try to align with Ukraine and get Russia to step back down against Ukraine, yeah.
And Jen, and as we're still waiting for the shot here, you know, just considering the call that the president has had, he's had the call now with the NATO allies. He had a call last weekend with Russia as well. And so what are we to make actually transpired through many of these calls?
Right. And I think to your point, you know, when we heard from the president yesterday, he had no plans to have another call with Russia. Then we got word that Secretary Blinken is set to meet with his Russian counterpart, Sergei Lavrov, next Wednesday on the condition that Russia does not invade Ukraine. So in the White House, very skeptical here, to be honest, Brad. It appears that Russia's saying that they want to take the diplomatic path. But when you look at their actions, they seem to be increasing troops on the border, and thus the U.S. very suspect. As I mentioned in my earlier reporting this hour, the U.S. has found evidence that Russia has committed cyber attacks against Ukraine's banking system this week, which could serve as a precursor for a on-the-ground sovereign invasion. And the U.S. officials believe that if that were to be the case, we could see even more aggressive cyber attacks on Ukraine leading into that. So that's sort of something to watch here.
Jen, we're just going to go live to the White House right now. We have been standing by for President Biden to take the podium, and we're going to listen in live.
Two vital calls, as I've been making for some months now. Two vital calls that on the situation in Russia and Ukraine. The first was to a bipartisan group of members of Congress who are currently representing the United States, along with Vice President Harris at the Munich Security Conference. The second was the latest in a series of calls over the past many months with the heads of state of our NATO allies and the European Union, to bring them up to date on what the United States thinks is the current state of affairs and what's likely to happen in Ukraine in the coming days, to ensure that we continue to remain in lockstep, that is, the European Union and NATO. Despite Russia's efforts to divide us at home and abroad, I can affirm that has not happened. The overwhelming message of on both calls was one of unity, determination, and resolve. I shared with all of those on the calls what we know about a rapidly escalating crisis in Ukraine. Over the last few days, we've seen reports of a major uptick in violations of the ceasefire by Russian-backed fighters attempting to provoke Ukraine in the Donbass. For example, a shelling of a Ukrainian kindergarten yesterday, which Russia has falsely asserted was carried out by Ukraine. We also continue to see more and more disinformation being pushed out to the Russian public, including Russian-backed separatists, claiming that Ukraine is planning to launch a massive offensive attack in the Donbass. Well, look, there is simply no evidence of these assertions, and it defies basic logic to believe the Ukrainians would choose this moment, with well over 150,000 troops arrayed on its borders, to escalate a year-long conflict. Russia's state media also continues to make phony allegations of a genocide taking place in the Donbass, and push fabricated claims warning about Ukraine's attack on Russia without any evidence. That's just what I'm sure Ukraine's thinking of doing, attacking Russia. All of these are consistent with the playbook the Russians have used before, to set up a false justification to act against Ukraine. This is also in line with the pretext scenarios that the United States and our allies and partners have been warning about for weeks. Throughout these tense moments, the Ukrainian forces have shown great judgment and, I might add, restraint. They refused to allow the Russians to bait them into war. But the fact remains, Russian troops currently have Ukraine surrounded from Belarus along the Russian border and with Ukraine to the Black Sea in the south and all of its border. You know, look, we have reason to believe the Russian forces are planning to and intend to attack Ukraine in the coming week, in the coming days. We believe that they will target Ukraine's capital, Kyiv, a city of 2.8 million innocent people. We're calling out Russia's plans loudly and repeatedly, not because we want a conflict, but because we're doing everything in our power to remove any reason that Russia may give to justify invading Ukraine and prevent them from moving. Make no mistake, if Russia pursues its plans, it will be responsible for a catastrophic and needless war of choice. The United States and our allies are prepared to defend every inch of NATO territory from any threat to our collective security as well. We also will not send troops in to fight in Ukraine, but we will continue to support the Ukrainian people. This past year, the United States has provided a record amount of security assistance to Ukraine to bolster its defensive, $650 million from Javelin missiles to ammunition. We also previously provided $500 million in Ukraine and humanitarian aid and economic support for Ukraine. And earlier this week, we also announced an additional sovereign loan guarantee of up to $1 billion to strengthen Ukraine's economic resilience. But the bottom line is this: The United States and our allies and partners will support the Ukrainian people. We will hold Russia accountable for its actions. The West is united and resolved. We're ready to impose severe sanctions on Russia if it further invades Ukraine. But I say again, Russia can still choose diplomacy. It is not too late to de-escalate and return to the negotiating table. Last night, Russia agreed that Secretary of State Blinken and Foreign Minister Lavrov should meet on February 24th. February 24th in Europe. But if Russia takes military action before that date, we'll be clear that they have slammed the door shut on diplomacy. They will have chosen war, and they will pay a steep price for doing so, not only from the sanctions that we and our allies will impose on Russia, but the moral outrage the rest of the world will visit upon them. You know, there are many issues that divide our nation and our world, but standing up to Russian aggression is not one of them. The American people are united. Europe is united. The transatlantic community is united. Our political parties in this country are united. The entire free world is united. Russia has a choice between war and all the suffering it will bring, or diplomacy that will make a future safer for everyone. Now, I'm happy to take a few questions. Nancy from Bloomberg.
Thank you so much, sir. Do you think that it is wise for President Zelensky to leave Ukraine if an invasion is as imminent as the U.S. says it is?
That's a judgment for him to make and a determination as to whether or not. I've spoken with Zelensky a dozen times, maybe more, I don't know. And it's in the pursuit of a diplomatic solution, it may not be it may be the wise choice, but it's his decision.
And do you have any indication about whether President Putin has made a decision on whether to invade? Do you feel confident that he hasn't made that decision already?
As of this moment, I'm convinced he's made the decision. We have reason to believe that.
There seems to be a unanimity of spirit to do between the United States and Europe to do some sanctions, the comprehensive sanctions. But is everyone on board with the exact same sanctions that you want to do?
Yes. There will be some slight differences, but none. There'll be more add-ons than subtractions.
And President Putin is going to oversee some nuclear drills this weekend. How do you see that happening? What's your reaction to that, sir? Thank you.
Well, I don't think he is remotely contemplating using nuclear weapons. But I do think I think he is focused on trying to convince the world that he has the ability to change the dynamics in Europe in a way that he cannot. But I don't, how much of it is a cover for just saying we're just doing exercises and there's more than that, I just can't, it's hard to read his mind.
Mr. President, to be clear,
you are convinced that President Putin is going to invade Ukraine. Is that what you just said a few moments ago?
Yes, I did. Yes.
So is diplomacy off the table then?
No. Until he does, diplomacy is always a possibility.
What reason do you have to believe he's considering that option at all?
We have a significant intelligence capability. Thank you very much.
Thank you, guys. Thank you.